Well, and just finally, Siemens Energy on course to pay its first dividend in around 4 years after replacing their German rescue package. So watch Siemens Energy as well, Guy.
In theory, it should be a quietish open, Lizzie. In theory, we should get everything kind of up and running fairly quickly. We'll see whether the German trade's a little bit more interesting and maybe actually things get held up a little bit there. But we are expecting a fairly flattish open. So here we go. Time for the opening trade. Let's see what we get out of the FTSE 100. First of all, it is delivering as anticipated. Barely a budge from the FTSE 100. We are seeing not much movement already. We don't even see anything yet from the stock 600. There it is. A staggering move to the downside. Of less than 1/10 of 1%. The IBEX is down less than 1/10 of 1% as well. We'll wait and see what happens with the CAC and the DAX. Be interesting to see how long it takes. Potentially you could see an effect into Adidas today, but maybe actually the German market isn't seeing much action. It's open early by its standards. The CAC Quarante is up by less than 1/10 of 1%. The German market is as flat as a pancake this morning. Lizzie, provide some excitement from the sector point of view.
Well, I wonder whether everyone just needs to wake up or they're just holding their breath until that jobs report. But if we break it down by sector, you've got just under half in the green. Energy's leading the gains. It's up 0.25%. You've got utilities up as well, real estate, healthcare. But at the bottom of the basket, it's basic resources. So they're down 0.7%. Autos and parts not far behind. And then consumer products and services also down 0.5%. So if we dive into some of those names that we thought might be affected by the Lululemon drop, you've got Adidas down 0.6%, Puma down 1.25%. So there we could see that reading into the DAX more broadly, and JD Sports down 0.5%. I mentioned HSBC because their chairman's going, Mark Tucker. HSBC actually flat to the upside, and Siemens Energy is up 0.5%. So I'd mentioned their dividend. Traders liking that.
It's not exactly a big move from Lululemon, though, is there? These aren't dramatic drops that we're seeing in the athleisure sector first thing this morning.
But as you say, it's more to the macro story and seeing, you know, the impact of tariffs and the hints of how it'll show up. You know, we talk about the job story, we see the job cuts at Microsoft and Disney. This is just the hints of further what's to come. It's
interesting that actually the luxury sector is under pressure. So we're seeing you got Hermes down this morning, you got LVMH down this morning. So actually there is some weakness in that space. You do have the pharma sector doing a little bit better, so maybe a sort of seeking of safety within that space too. So we'll just keep an eye on exactly what is happening from a sector breakdown point of view. But broadly, the market is going nowhere. In terms of the stocks we've got on the stock 600, 234 up and 270 down. 79 are unchanged. Nothing to see here.
Let's make this Friday more exciting, shall we? We've got Beata Manthi, who's European Equity Strategy Head over at Citi. She joins us around the table. Beata, I want to go back to the ECB yesterday. I was in Frankfurt. You had this surprisingly hawkish press conference, right? Surprising the market, knocking European stocks. If you don't see another cut from the ECB this year, how much is that going to knock European equities by the end of the year?
The market didn't love this rhetoric, right? I think it's knocked off almost 1% of the stocks from the highs on the day. And at the end of the day, well, the cuts from the ECB have been underpinning the equity market, but it was one of the factors. It's not the only factor, right? So let's assume they stop now. The question is, why do they stop? This is crucial, right? Because there were some bad rhetoric, but also some good rhetoric about surprising resilience and potential for GDP growth to recover. still lots of uncertainty. A lot depends on what is going to happen on the trade front and negotiations. But historically, we've been looking at what happens to equity markets in the environment when rates are, well, long end is going higher, which this is what you would expect to do as the result. And really, the only differentiating factor whether equities would go up or down from these levels was what the economy, what the PMIs were doing. So no matter the level of rates, no matter the level of inflation, if PMIs were picking up and inflation was in curbs, was no longer going up or was going down, this was a bull signal for equities. Now, if in turn we have stable inflation and growth is going down, it's going to be a problem, right?
Okay, so focus more on the data than reading it as a response to the tariff uncertainty. Don't see it as a wait-and-see approach. See it more as the ECB declaring victory. Okay, that's interesting. But then also you need to factor in, of course, the euro impact, right? And, you know, if you have a stronger euro, as we heard the ECB talking about pursuing, not just from Lagarde, but from Panetta as well, how much more of a headwind does that create for European earnings growth through the rest of the year?
So, for us, given the research that we've done, for every 10% move in the currency, you get around 2 percentage point hit on the EPS. But for European equities, it is more nuanced than that. It's not just bad, right? When you look at the exposure, revenue exposure of European equities, it's 50-50. 50 is domestic, 50 is international. So our review is you should be going for domestics right now. Euro strength would help that part and has been already. And of course, being more longer term, you should think about what the stimulus is going to do and which parts of the equity markets, of the corporate, it's going to affect the most in a positive way. And of course, it is domestics, right? So it's 50-50. Some regions in the world have a very strong relationship with the direction of the currency. UK, for example, but for the European index, it's more treacherous. But also, last point that I wanted to make about the direction of the dollar and of the euro. It really makes a difference when it comes to asset allocators. So from the global perspective or from the US investors' perspective, historically, when you have US dollar weakness, you feel more, you see more reasons to diversify away from the US, right? So we see another 5% on euro stronger by the end of the year, and we think it could be just another reason, among many others, to diversify a bit more into the rest of the world.
How permanent is that shift? How permanent is the decision by allocators? It started here in Europe, but it'd be interesting to see whether it shifts to the United States to move money out of the United States. Is the era of the last 15 years over? Can I categorically say this at this point?
There are tentative signs that it could be over, but I feel many investors push back against that, right? Many feel that we are going to back. There are no reasons to believe that we are going to go back, not going to go back to what we've been used to over the last 15 years. And that was the world with no inflation, no rates, and no growth, or weak growth, right? Why Europe could not outperform meaningfully in that environment? Because of the setup, the composition of the index, right? So it's very cyclical and it's very financial. Low inflation, big headwind for cyclicality. Zero rates, big headwind for banks. It was an impossibility for Europe to do well. Now, you've got to believe that inflation will stay with us, which are many reasons to believe that this is going to be the case. And with that should come the rate cycle, right? So what the ECB is saying is not necessarily as bad for equities as one could believe straight away. But what we need to make the proper, the good equation for equities over the longer term, European equities, is really growth. And this is where the stimulus should come in, right? It was always going to be backloaded. We wouldn't see the growth this or for most of next year, but there is a steady revenue stream and commitment for that to come.
At a kind of index level, at a top-down macro, from a top-down macro point of view, do you think equity investors are being properly compensated for the risks they're running in terms of the global economy, a downdraft, I don't know what the risk could be, a crack in the financial system. Do you think we're being compensated for that right now?
The question is, what risk are we talking about, right? Crack the financial system
but there are so many.
Like a big deal.
But are the left side tail risks, are equity markets being are correctly pricing left-side tail risk? Are equity investors being compensated for the plethora of risks that now sit out there that are higher than normal, it seems?
So equity risk premia around the world have been going up, right? In Europe, they are relatively high. In the US, they are still low. What we've been arguing, of course, you could have the situation that they have to go even higher, right? But if we get a trade deal and if we avoid recession or bigger slowdown, it's a lot about ifs, right?
Yeah,
the uncertainty really weighs on the sentiment right now. But if that's the case, you could imagine, and you know, we haven't mentioned the bill and the Section 899 and many other issues, right? And the direction of the dollar. You could believe there will be a set of circumstances going forward that would make ERP in the US slightly higher. I'm not talking big numbers, but you could have a compression, right? So if indeed going forward, not today, but over the next year or so, you have more reasons, investors start to believe that the reasons to come to Europe exist, i.e. the growth will be eventually higher, then you could see the compression of ERP in Europe, and the diversification could mean that the ERP in the US could go slightly higher. How about that?
We could go back to 899, but you know, you talk about the stimulus, the fiscal stimulus. When you look at the defence names, and some of them a bit up today, Rheinmetall up 0.1%, you know, how much more can be squeezed out of them when we just don't have any concrete plans really on this? We don't know if everyone's going to spend 5% of GDP on defence yet. If that doesn't come through, is there much to squeeze left out of the defence names?
So when it comes to defence names, you could have asked me the same question at each of the previous rallies, and probably everybody would tell you, well, they've rallied a lot, they price a lot of this future growth, right?
Sometimes you've got to sell a rally, right?
Sometimes you do, but defence stocks have a new paradigm, right? When you ask our analysts, they would tell you the next 5 years growth is already in the price. But when what we found historically, when you have a new paradigm, stocks re-rate, right? Because
but there's so many risks. Could there be a windfall tax? What would a windfall tax? So the Germans are already talking about a windfall tax on defence names because of the amount of money that's going towards them.
Of course, but you have to counter it with the amount of capex that is first needed to get this revenue stream, right? So the companies need to be convinced that commitment will yield, and so perhaps further down the road we'll have these conversations. But what is certain, 3% is certain, right? There is this revenue stream, and when you talk to our economists, they would tell you it's not only the next 4 to 5 years, it's much more to go, right? If we really go for submarines and so on, it takes a very long capex cycle to get all of that produced. So I get lots of pushbacks that it's not going to happen. Our view is going to happen. The question is what the valuation you're willing to pay for that. For us, in the space of European equities being an overweight in the global context, it's a neutral right now. But I believe it's something you want to have, and I do know that many asset allocators, for many reasons, still don't hold these stocks. So volatility possible for the entire market as well, but I know there'll be many investors buying the dips there, right?
Yeah, muscle memory on both sides, quite hard to deal with. Beata, thank you very much indeed. Nice to see you. Beata Manthi, European Equity Strategist Head over at Citi. The core six looks like this morning. Let's walk you through what we're seeing in terms of the numbers. You are obviously seeing a fairly quiet market, you could argue, and you're certainly seeing that on the screen in front of us as we head towards the US payroll number a little bit later on. There are some single names that are moving. You are seeing pharma doing better than luxury. Luxury is maybe back to flat, but this is not a market, I think, this morning with a clear sense of direction, Lizzie.
Well, next up, we're going to go to Switzerland. UBS set to be told it may need to put aside as much as $25 billion against future losses. So we'll dig into the capital conundrum that faces Switzerland's biggest bank. That's next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Up to the minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The risk was a downside surprise, the reality an upside surprise.
The shock has affected outcomes.
There's a pretty big cliff from an economic perspective.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
American exceptionalism continues.
This is not what we're going to experience in the upcoming months.
Is it going to be Biden data or Trump data?
The May Jobs Report, today on Bloomberg.
Let's call it 17 minutes into the session, we need to deal with the bottom-up news, which basically takes us this morning to Lululemon, which got dinged up pretty badly overnight after posting its numbers, signaling that tariffs are having an impact. You're seeing that coming through into, I'm never sure of the word athleisure, but we're going to use it this morning. The athleisure stocks, Adidas, Puma, JD Sport here in the UK. And as you can see, these stocks are down. They're actually bouncing a little off their lows right now. It took a while for them to get going, but they are definitely under a little bit of pressure after we saw that warning coming through from Lululemon. Tariffs are having an impact, and it is certainly impacting that stock, which rips through into European stocks this morning.
Yeah.
You got wind stocks.
Wind stocks blowing a bit more positively this morning. Vestas up 4.3%. This again comes back to Trump policy and the clarity perhaps that's coming on the big beautiful bill. You've had a note out from Martin Wilkie over at Citi saying that that policy clarity could come soon. It would support Vestas's outlook through 2028. You've got billions of dollars in incentives for the wind industry and the clean energy groups on this absolute lobbying blitz. So this could be putting the wind in the sails, shall we say.
But doesn't that require the big beautiful bill to pass? And isn't that thrown into jeopardy
by
Elon Musk yesterday?
Perhaps, and maybe Wilkie's note came make all of that, but maybe they'll kiss and make up and wind will get away with it.
Apparently there is a kiss and make up call scheduled for a little bit later. The Swiss government will propose a bill to Parliament today that could force UBS to maintain as much as $25 billion in extra capital to protect against possible losses in its foreign units. The company's CEO, the bank's CEO, Sergio Motti, says the demand could leave Switzerland's biggest bank at a huge disadvantage to its peers.
UBS is in a high-stakes showdown with Switzerland. The assets of the world's biggest wealth manager are twice the size of the Swiss economy, stoking fears among officials that a banking crisis like the one that brought down Credit Suisse would be all but impossible to control. So, Swiss lawmakers want UBS to boost its reserves to protect against 100% of any losses at its foreign units. The extra capital required could reach $25 billion. But CEO Sergio Motti says the plan would put UBS at a major disadvantage with peers. It could take until 2029 for any law to come into force, but UBS may not wait that long. Measures being considered even include moving its headquarters out of Switzerland. However remote, it's a possible scenario that will surely catch the attention of lawmakers in the Swiss capital, Bern.
Just trying to work out why the trams were red. Now I understand a little bit more. Okay, let's bring in Tom Metcalf to figure out exactly what we are talking about here. So how is this going to play out today? How big a day is this in this road towards potentially higher capital rules?
Yeah, it's certainly like the first really big set piece in what's probably going to be a multi-year kind of, let's say, discussion between UBS and the Swiss government. So expecting sometime this afternoon, the Swiss government will sort of formally lay out at least its initial proposal. And our reporting suggests they're going to go literally the sort of full-fat version, the worst possible scenario for UBS, which is that 100% capital sort of reserve against its foreign subsidiaries, that sort of $25 billion hit. And then, of course, the thing that's kind of expected, and what will be really interesting to watch, and I think should be the focus, is what is UBS's body language to this announcement. They kind of expecting it to happen. How aggressive do they go? Are they sort of going to play the long game? Because, as that report just pointed out, this is not going to happen tomorrow. This is going to happen, at the earliest in probably 2027, if not after.
So realistically, if it is the full-fat version, how damaging is it to UBS's business, and how realistic is it that they would, move their headquarters out of Switzerland if you're saying that they're not going to, retaliate immediately?
Well, certainly, yeah. I mean, I think, it's kind of the negotiation, it makes much more sense. They certainly wouldn't want to do anything drastic if they can. But I think, let's say it does go through, as the Swiss government currently say, and I do think that's unlikely, but if you're facing a $25 billion hit as a bank, you're going to have to make some changes. And, just from, speculating, right? Like, it's against the foreign subsidiaries, so do they do something to try and minimise that hit by changing the structure of the bank, perhaps? But it's really fascinating watching this sort of debate play out, and you can understand why UBS are, kind of considering even the most extreme versions, because obviously, perhaps that helps them get some leverage with the government, because I imagine the Swiss government doesn't want to see its biggest bank completely disappear.
Yeah, but it is big, so it is a problem vis-a-vis GDP. But the key thing here is that other jurisdictions are not proceeding at the moment with the latest Basel legislation, and that's so the European Union is waiting for the US to react. Yep. The UK kind of in a similar position as well. So other jurisdictions are not at this point imposing such onerous requirements on their institutions, and may never impose such onerous. So how different is Switzerland in terms of its approach vis-a-vis the other banks and the other jurisdictions? Context is important here.
No, and I think Switzerland is the outlier there. They are certainly on the regulatory side, seemingly in terms of what they're saying, the most aggressive. So, as you say, the UK, EU, they're all delaying various Basel rules in a bid because everyone needs to know what the US is doing, because, UK banks, EU banks are freaking out that, hey, if the US goes very lax or easy, we're going to be at a massive disadvantage. But so far, at least, Switzerland has sort of struck the sort of most stringent tone and said, no, we're going to move ahead, we're trying to apply this thing. And that reflects to this situation as well. Like, from them, as you say, UBS is absolutely gigantic. They're in kind of this unique position.
But Credit Suisse is still fresh memory.
Yeah, exactly. So there's a lot of scars from that. Yeah. And so it's understandable, but I think you'd be pretty frustrated if you're a Swiss banker, at least.
While we've got you, can we talk about HSBC? The chairman, Mark Tucker, leaving. What does it mean for HSBC?
Yes, intriguing. He's going back to AIA. He's going to chair it there. I think for me, just how quickly this has sort of developed. So last month, they flagged he would be leaving by the end of 2025. And, normally these situations, it runs right through to that time frame. So the fact he's going to be leaving at the end of September to take on this new job shows, I think he wasn't hanging around and obviously found this plum job that he's keen to take. And for me, the big question now is, HSBC have this hiring process ongoing. Who do they find? Is it an internal candidate? Is it an external candidate? And that's the most interesting thing, to see what names start floating around. And Can they move quickly enough to get someone in place by October the 1st, or will they keep an interim chair in place for that a little bit longer?
Okay, well, the shares are up a little bit this morning, 0.3% for HSBC here in London. Bloomberg's Tom Metcalf, we thank you. All the latest in banking. Now, let's turn now to central banking. President Christine Lagarde says that the European Central Bank is coming to the end of its campaign of interest rate cuts following the 8th reduction in a year yesterday. With the Eurozone suffering repeated blows from US tariffs, the deposit rate was lowered by a quarter point to 2% amid all of the tariff uncertainty.
Higher tariffs and a stronger euro are expected to make it harder for firms to export. High uncertainty is expected to weigh on investment, but at the same time, several factors are keeping the economy resilient and should support growth over the medium term.
So hawkish message, more hawkish than we were expected. Traders paring bets on future cuts. But the other thing that happened, of course, was the furious denial that Christine Lagarde's going to leave and go to the World Economic Forum.
Yeah, that had been floating around for a little while. It did seem a little odd, and it's interesting that she came out so strongly and has basically said, no, I'm going to serve through to the end of my term.
That's all she said. She's determined to serve the term. She didn't outright deny it, I should say.
No, that is true. She's going to, but I think we can now move forward from here that she is going to be sticking around, which takes you on to the kind of the policy question and takes you on to the personality question. Why was the statement and the press conference so different? Is the statement a reflection of the governing council? Is the press conference more of her interpretation of it? It's interesting that sometimes you get this with Powell and the FOMC as well. Why the difference? Why was she so hawkish when? Because I read the statement, I saw the statement yesterday. I was like, that sounds quite dovish.
Yeah.
And then you get the press conference, which wasn't. Why?
Well, actually, don't you think that supports the argument that maybe she is contemplating moving over to the WEF because job's done on the euro area economy?
I think that is a stretch to make that argument. But I'm wondering why the governing council does seem reasonably divided at this point. Is she putting? Is she putting an interpretation on the outcome of the meeting? Why was the statement as dovish as it was? And did she feel a need to correct that? I don't know why you end up with these slightly different, because it did catch the market by surprise when she came out with some of those more hawkish lines. The market basically had been put to sleep by the statement, which felt like it was a nothing, and then you got a something. And I'm wondering why you got a something.
Well, speaking of the divisions on the governing council, yeah, it was the first non-unanimous cut. And we're going to dive into what's actually happening on the governing council. We're going to have an exclusive conversation with Greece's long-serving central bank governor, Yanis Stanaras. That's coming up next on the programme, so do stay with us. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. Welcome back. 1:30. We are 30 minutes into today's equity session. As you can see, equity markets aren't going anywhere in a hurry. The reason for that, probably we are waiting for the non-farm payroll number to come out of the United States a little bit later on. The survey number points us to somewhere in the 120s. The Whisper number points us somewhere in the 110s. The Bloomberg Economics estimate points us somewhere towards 90. Are we set up for a weak number? So that's what the macro picture is going to be all about today. Yesterday, though, it was all about, of course, what we got from the ECB. The central bank lowering rates for an 8th time, inflation dipping below 2%. We know all that. We did, though, get a slightly more hawkish press conference than maybe some of us had been led to believe by the statements that we got out from the Governing Council. So let's try and clear up what is happening here. We have an exclusive interview with Greece's long-serving central bank governor, Yanis Stournaras. Very nice to see you.
Morning. Very nice to meet you too.
You and I first met during the Greek financial crisis, which seems like such a long time ago, and the country's come such a long way since then. We'll come back to that in just a moment, but I want to get your take on what happened yesterday, first of all.
Well, it was an expected decision, I think.
It was an expected, okay.
Yes. I think we have achieved what we can call soft landing in a difficult world situation. So inflation now is 1.9%. Our medium-term forecast is close to 2%. So we have cut. Now interest rates are at 2%. We have cut 8 times in the last year.
The question is now what? So
now what? I think now the best thing is wait and see. As we know, we are now data dependent.
So you're not necessarily done. So, because the question going around this morning is the ECB done?
It is nearly done. Nearly done. But with such uncertainty worldwide, you can never say that it is done because we have tariffs, we have geopolitical tensions. So we are very, very careful.
So maybe another cut. What kind of data would you need to see to trigger another cut?
Well, if the economy weakens more, if inflation falls in the medium term sustainably below 2%, then we might cut. But this is not expected. I mean, we have our new forecast. We are confident. But of course, it's we are data dependent.
I mean, a lot of people were thinking about July. Now people are more thinking about September for the next cut. Do you think that there's inherently a problem for the market getting confused if it's a long pause between?
No. I mean, if you remember, I have talked about a pause for a long time now, and so it's not something unexpected. And well, our forecast is that there are risks, there are downside risks to growth. On inflation, we are more balanced. So we are quite confident about our forecast now. So wait and see. We are keeping options open. Meeting by meeting, data dependent.
there seems to be some surprise at the statement yesterday, which kind of appeared quite dovish, and Christine Lagarde's press conference, which seemed to be a little bit more hawkish. Is that kind of, was there any difference between the two? Were you surprised by how hawkish Christine was yesterday?
No, because perhaps this time the difference between what you call dovish and hawkish is not that big. I think we have converged. There was almost unanimous decision yesterday. I mean, it was not surprising that Christine said that, the president said that we are nearly there. And if we are nearly there, the best thing is wait and see.
Okay, so
she did not exclude anything, in my view.
Okay, fair enough.
Yeah.
There's a lot about to happen. We don't know what's going to happen with tariffs.
Absolutely.
We don't know what's going to happen with economic data. We still haven't seen evidence of a tariff impact, particularly into the US economy. We haven't certainly seen it in maybe some of the data that we're seeing into the European economy. What's your degree of certainty right now? You talk about kind of there are lots of different options, but how can you quantify? Is it possible to quantify the degree of uncertainty?
Well, we tried in our 3 scenarios yesterday, the baseline, the mild and the severe. The differences are not that big. That's why we are quite confident about our forecast and about our stance. But I fully agree with you.
If they're not that big, then the degree of certainty is quite high.
It is quite high. Yes, it is quite high. And it is not only tariffs, it's the bond market worldwide. There are mismatches of demand and supply. So the bond market worldwide is also something that we should look at. But you're absolutely right. With the introduction of a tariff war, things have changed dramatically in the world economy and in the euro economy. The big picture is that, at least for Europe, the effect of tariffs is deflationary. For the United States, if I can say, it's stagflationary. So there's a difference here.
But Governor, in those...
Which complicates monetary policy.
In those scenarios yesterday, even in the most severe scenario, you didn't see US tariffs on the EU going up to 50%, back to 50%. What if that happens?
No, the severe scenario is not 50%, it's a bit less.
Exactly.
It's less,
But
yeah.
what if it is, let's say, very severe, and it's 50% and the EU retaliates?
If it's very severe, that means the effect on demand will be even harder, so more deflationary. If it's a retaliation, I don't think that Europe will retaliate horizontally, but in specific sectors. But I don't expect that, to be honest. I think at the end of the day, things will normalize, because I think, first of all, it is in America's interest not to have tariffs. If I can give my advice, 0 for 0 is the best. The best for America and the best for the world.
But what about China in this equation? Because I heard a few thinly veiled references from President Lagarde yesterday to essentially China dumping. If that happens, or what level of US tariffs would really need to concern you about the deflationary impact of China dumping on the euro area?
Well, you already know that the effect of tariffs, as I said, in Europe is deflationary, highly deflationary. The higher the tariffs that America imposes, especially on China, the higher the risk that China will try to substitute the American market for other markets, and especially Europe, because European consumption is the second biggest in the world after the US's. So it's likely that China will try to sell its products to Europe. So it means more deflation in Europe.
I mean, are you worried about deflation? I mean, you know, the new 2026 inflation forecast is 1.6%. Are you concerned that actually there's a persistent undershooting of the inflation target?
We think that it will come back to 2%. Energy prices will help here. The CO2 emission tax will help bringing inflation back to 2%. So yes, for 2026 we have 1.6%, but for 2027 we have 2%. So in the target. But of course, this is a forecast.
Are you surprised? The euro's got stronger as you've been cutting, which seems slightly contradictory if you kind of think about it from an interest rate point of view. The US hasn't been cutting, well, it's cut a little bit, and the ECB's cut more. In theory, the euro should have gone down, but it's gone up. What do you think is going on here? Do you think we are seeing an end to the dollar's exceptionalism, its role as a world currency? Do you think the ECB, the euro, has the potential to fill some of that gap left?
First of all, nobody is happy about what's going on in economic policy and trade policy in the United States. But if it continues, I'm afraid the dollar will lose some of its status. Not automatically, of course, not overnight. It will take time. So the euro will not become automatically a substitute for the dollar. It will take time. But also, Europe needs to act. It needs to complete its banking union, to complete its capital union, to consolidate even more its public finances. But I think the prospect for the euro is better now.
Do you worry about the impact of a strong euro on Greek exports? I'm thinking about tourism.
Well, we have to take into account everything. We talk about a general equilibrium situation. So, okay, a strong euro is bad for exports, but also it's good for other things. The financing of our public debt, for instance, because there is now a reversal of capital flows. Up to 6 months ago, it was money flowing out of Europe to the United States. Now it's coming back.
Final quick question on the financial sector. Greek banks are in focus at the moment. There is interest in Greek banks once again. I take us back to the beginning of our conversation.
Does it surprise you?
No, it doesn't. No, it doesn't surprise me. But in some ways, you could argue Greece has come a long way back, and the fact that we are now talking
it has actually.
Greece is people being interested. So UniCredit is now interested in taking stakes in Greek banks. Do you welcome? Are you on the side of cross-border takeovers? Do you believe?
Yes, strongly, and for many years now. When I was governor of a commercial bank in Greece, I had invited a cross-border transaction, and Crédit Agricole became a shareholder. So I'm very happy that we are now continuing this policy of cross-border transactions.
So we have welcomed banks being taken over?
Both the government and the supervisor of the Bank of Greece, we have welcomed UniCredit in Greece.
Others are taking a different view in different countries. Yeah.
I'm sorry about that.
Yeah, this is great to see you. Thank you very much indeed for coming to
You're welcome. Thank you.
Appreciate it.
Thanks a lot.
The Bank of Greece Governor, Yanis Stounaras, joining us around the table this morning. Up next, we're going to take the conversation in a very different direction, I can assure you. We are going to tap in, and it is Friday, to the world of non-alcoholic beers. The Carlsberg CEO is going to be joining us next to discuss. That conversation is coming up. This is Bloomberg.
Another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Morning, folks. Welcome back. Friday morning. We are 45 minutes into the equity market session. European equities, I hate to say it, are going nowhere in a hurry. So we shall look for a buzz elsewhere. And this time we are going to look for it in the beer markets, particularly the non-alcoholic beer markets. A new forecast from IWSR, which I have no idea what that is, but we'll come back to that in a moment, suggests that the booze-free beverage market is set to overtake ale as the second largest beer category by volume this year. So it's something that we should be talking about. Carlsberg's CEO, Jacob Andersen, and Bloomberg's food editor, Kate Crader, joining us around the table this morning. Welcome both. Good morning. Lovely to see you in London.
Good to see you.
Stopping by to see us. Of course. This is structural, right? This isn't just a fad. This is a shift that is taking place within your market. It is an opportunity. It is a big change, but it is an opportunity.
We think it's a massive opportunity, and you're spot on, Guy. It is structural. So what we've seen is quarter in, quarter out, we're seeing the highest growth rates coming from alcohol-free. This quarter we just reported, we had 15% year-on-year growth in alcohol-free beer. And we do continue to expect that alcohol-free beer will be the highest growing segment within our categories.
In terms of, therefore, how your business changes, what does Carlsberg look like in 5 years, 10 years' time? How do you think this is going to evolve?
Well, we think the overall moderation wave as such has a great momentum. And that's also why when we've been structurally allocating our capital, we've over the last couple of years also done significant acquisitions within the non-alcoholic sector. So we did a massive acquisition of Britvic here in the UK within soft drinks. And when you look at our footprint today, already a third of our entire business is soft drinks. We have non-alcoholic beers growing fast. So I think when you look 5, 10 years out, you're going to see a business that is much more balanced towards alcohol versus non-alcohol. And for us, that's a great development.
But isn't it a societal shift? Like, what does your sales data teach us about the non-alcoholic movement, the teetotal movement? Because, you tend to think that it's Gen Z that's converting, but surely you have growth markets in the Middle East. It's a massive opportunity there.
So the data is incredibly exciting because I fully buy into what you're saying in terms of the overall feeling around what this movement is. But actually, I think the most interesting data point is we're seeing as much growth and penetration of alcohol-free beer across all generations. I think that's the first important point. The other element is we're seeing it especially, as you say, Middle East is a growth market, but so is Western and Central and Eastern Europe. It is a growth market in alcohol-free beer. Asia less so, but we think that will come. So moderation as a theme is a theme that's here to stay. But alcohol-free beer gives people that ability to also do what we call zebra striping, which basically means that they move in and out of alcoholic beers and alcohol-free. So And I think that's the most important data and insight. That is 80% of the people who drink alcohol-free beer, they also drink alcoholic beers. So they use it more to moderate than staying teetotal.
Okay, that's interesting. Kate, it's something that you've been covering a lot.
Yeah, but I was going to say it's still like a small fraction. It's only about 2% of the overall beer consumption category, isn't it?
Yep.
So where do you see opportunity to push it even farther? Like, will you go to football stadiums? Do you see more opportunity with, I mean, Gen Z is obviously a huge consumer of it. Where do you see the most opportunity going forward?
So I think you're spot on. What we're seeing right now is the curve has been increasing, and I think it's going a bit more exponential in some areas. Also because we as an industry, we're embracing this. We don't see this as a challenge. As you said, Guy, we see it as a real opportunity. We don't necessarily wake up in the morning and we have to sell alcohol to you. We want to sell you a beverage that suits the occasion that you have. And if you look at it, the big festivals in Europe this summer, where we sponsor many of them, you're going to see much more the non-alcoholic choice next to the alcoholic choice. We're actually doing at the biggest festival in Northern Europe, Roskilde, we're doing zebra striping, which basically means you get zebra striped 6-packs of beers that are alcoholic, non-alcoholic, etc.
What, like roulette?
Yeah, no, exactly. Well, you know what's in it. So I hope you're
so
sober
you can
enough
go
to
from one to the other. Not which one am I going to pick?
Thank you for that. And you will see at all the big festivals in Europe, we will have a day beer and a night beer as well. So a non-alcoholic for day and an alcoholic for night. So there's a lot of initiatives going on here, and so I think it's just the beginning of the wave.
Kate, how do you see this developing? I guess, is taste getting better? Does the product taste better? Does it need to taste better? What needs to happen to keep it going?
It's such a good question, because I think that's where a lot of people stop. They've had bad taste experiences with NA beer in the past, and so they'll do it just because it's the daytime, because it's 10 o'clock in the morning in the airport, right? And you think, I can't really have a beer in good conscience. So
clearly I've met some of my friends, but okay.
Well, we'll talk to them later.
Yeah.
But I think I think that once someone has one and it tastes good, and they're like, oh, this actually isn't so bad, it doesn't taste like bad water, then all of a sudden people adapt farther. But I think that is like the biggest, I would think that's the biggest.
Is the flavour developing?
I think Kate is spot on. So if you look at the last 5-10 years, the development of flavors and taste, it's just exploded. So I fully agree. If you go back 10-15 years, a non-alcoholic beer was not a great taste experience. It was almost a punishment. If you're there today, many of the great brands, ours and our competitors, great brands in non-alcoholic, you can hardly taste any difference. And there's a lot of award-winning non-alcoholic beers coming through. So I think you're right. It's a completely new category. It's opening up new occasions. It's also bringing in new drinkers who would not be drinking beer, but just enjoy the non-alcoholic beverage.
Can I tell you, as the person around this table who doesn't drink, do you know what I drink? Water. Are you not afraid of the teetotal movement? I know it doesn't make
the business
money.
model isn't going to work.
I get it. Surely you don't want this movement to take off, even though you're kind of encouraging it with non-alcoholic beer.
So actually, I disagree. So I hear you on that. Water is a great tasting liquid, though.
Keeps you hydrated.
Yeah, no, it keeps you hydrated. So exactly. But we do see globally, if we look at it from a company perspective, we see globally that packaged drinks is a constantly structurally increasing segment. So, but people are moving between different types of categories. So yes, there is a moderation going on. You do see mainstream core beer being under pressure, but we see strong growth in premium beer, strong growth in non-alcoholic, etc. And soft drinks is a very, very fast-growing segment. People will drink a non-alcoholic beer, not just for the hydration, but for the great taste, for the food pairing, and all of those things as well.
Do you see, are you, in fact, as you say, like the category is getting so big, so Athletic Brewing Company is coming in. That's a big U.S. brand that has made a big splash here, so to speak. Do you see a lot of competition from them? Are you worried about them? Are you learning anything from what they're doing?
Listen, we've done this for 178 years, and there's always been new competitors coming in. I think one of the reasons why we have the size and the scale and the breadth we have today is we have that ability to constantly innovate. Of course, we look at, I'm not going to talk specifically around those guys, but we look at everything that's coming through. We have a lot of innovations ourselves. It's important for us to constantly make sure that we're relevant for the consumer also the next 5-10 years. So we're testing a lot of concepts and innovations all the time. There's no doubt that the category and the industry is developing very fast, but it has been for many years. And I think that's just what big scalable companies like us, that's what we do. We constantly adapt.
In some ways, I just want to come back to Lizzie's point about water. Water is generally, if it comes out of the tap, fairly free. You can buy it. It does cost more. But prices, I'm really, one thing that always kind of surprises me about this segment is that it basically, I can have a pint of alcoholic beer and I can have a pint of non-alcoholic beer. They're basically going to cost me the same thing.
Exactly.
Right.
And I'm wondering how, is that something that is impeding this segment, or in some ways continuing, because it just continues the narrative that that there's no difference?
I mean, I think you're the person to answer that question, but I would say from my point of view, from a consumer point of view, I think at that level, if the beer costs the same, you think they're doing something special to it. I think there's actually resistance when an NA cocktail costs the same, costs like, 18 pounds or 20 pounds, and you're like, what is going on here? But with beer, I think the price point is such that people will say, oh, they're putting some effort. However, they're de-alcoholizing it is working. But how do you see it?
But I think you're spot on. So if you look at the technology that goes into brewing non-alcoholic beers, it's a very complicated process. And
is it more expensive to produce a litre of non-alcoholic beer than alcoholic beer?
So it's a tough comparison, but it's definitely not cheaper. It really depends on the brand, et cetera, et cetera. But especially if you look at some of our best-selling non-alcoholic brands, there's a lot of craft that goes into this, and there's a lot of added ingredients to also mimic the alcoholic elements that are important in terms of the taste experience, etc. So it is a very complicated process, and that's also why the quality of the non-alcoholic beers have gone up so much over the last years. So I think our consumers, if you look at the growth rates, our consumers are definitely not saying the price point is the wrong price point, but they are saying that this is a super exciting proposition when you look at the growth rates. So you have classic mainstream core beer in the industry is basically flattening in Western markets, non-alcoholic growing double digit. I think that says something around the fact that the price point is not the issue.
Just finally, Guy asked about prices. We've got to talk about how the trade war is impacting you. I know that you have a different kind of exposure, but are you going to have to raise prices?
So first of all, I would not announce price increases so I live on TV. Then my lawyers would have an issue with me.
Feel free.
No, but if you look at it more generically, so of course, trade wars, it's not good for anyone when you're doing business and you're a global company. We operate in 150 countries. Our U.S. exposure is very small, and therefore we don't get a lot of direct exposure.
China exposure there.
But we have China exposure, and what we get is the indirect exposure. So we are a consumer goods company. We basically, our heartbeat is the global consumer, and the global consumer is being impacted if this continues over the coming years. So we're, of course, hoping for a stabilization in the turmoil we've seen recently, because, of course, it will impact consumer sentiment and hit us as a consumer goods company. But it's not a direct impact, it's more an indirect impact.
We're going to leave it there. Great
Thank
to see
you.
Thanks for it's a genuinely fascinating conversation. As a parent of teenage children as well, it's fascinating to see how they are adapting to it as well. Carlsberg CEO, Jacob Andersen, thank you very much indeed. And Kate, great to see you. Thanks for stopping by. Kate Crader, joining us around the table. It is the weekend, which is the perfect kind of jumping off point from the conversation we just had. Big weekend of tennis coming up. I think it's... What? No! That's the wrong reaction. So I think you've got Queens this weekend. I think you've also got...
Beyonce in London.
Okay.
Ludovic Subran is a fan of Beyonce, as I learned on LinkedIn. A guest of ours earlier in the week.
Okay. Anyway, there's also some great coverage coming up on Bloomberg Weekend as well. Have a fantastic weekend, everybody. Hope you enjoy the...
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the U.S. and China.
No one covers geopolitics like Bloomberg.
Elon Musk moves to cool tensions with Donald Trump after their public spat drives down the value of Tesla shares by $150 billion. A phone call between Presidents Trump and Xi calmed markets. The two agreed to further talks to resolve the trade war. Plus, UBS is set to be told by the Swiss government it may need to put aside as much as $25 billion against future losses. Happy Friday, everyone. We've made it to Friday. There's a lot of data to get through. There's, of course, the ECB, and then there's politics getting in the way of some valuations. Now, U.S. futures actually climbing a touch, nothing to write home about. But again, it's a nice day for the moment to finish the week. Look, there are signs that this Trump-Musk rift will ease. We saw a massive sell-off yesterday. Again, uncertainty and political turmoil really filtering through some of the stocks. Investors will now turn their attention later today to the key monthly non-farm payroll report. Earlier data this week from the U.S. really signaled a cooling labor market, therefore reinforcing expectations that the Fed will cut interest rates at least twice this year. S&P futures getting some 0.4%, and the 10-year 4.3808. Quickly, let's also look at the European markets map, although a lot of the risk-on or risk-off mood is definitely starting in the U.S., so then it filters through here in Europe. A little bit of a mixed bag. Here we talk politics and some of the by-elections in the UK. The CAC 40 and the DAX down between 0.2 and 0.4%. Now, Tesla shares plunging yesterday. The spat between President Trump and Elon Musk played out. By the time the markets closed, Tesla shares had fallen 14% since, well, the biggest decline since March, now gaining 4%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, just last week, President Trump and Elon Musk stood side by side in the Oval Office to proclaim their lasting friendship. A few days later, the feud between the world's most powerful politician and the world's richest man played out dramatically as they traded barbs, insults, and even threats in real time on social media. Now, Musk has since signaled he will move to cool tensions with Trump after the very public unraveling of their bromance. Well, Musk went as far as agreeing with an ex-post calling for Trump's impeachment. The president, in turn, hinting he may terminate U.S. government contracts given to Musk's companies worth billions of dollars.
I've always liked Elon, and it's always very surprised. You saw the words he had for me, the words of, and he hasn't said anything about me that's bad. I'd rather have him criticize me than the bill, because the bill is incredible. It's the biggest cut in the history of our country. We've never cut. It's about $1.6 trillion in cuts.
In a moment, we'll find out what markets make of all of this with Emmanuel Kuhl from Barclays. But first, let's bring in Roz Matheson, our EMEA News Director. Roz, it was really pretty incredible. For those who woke up to all of this, how did we actually get here?
Well, it's been a culmination of months of tension between these two men. I mean, there have been disagreements that they've had before, but they've been very careful to not target each other directly. And as we saw, that all built up and burst into the open overnight over Donald Trump's big tax and spending bill that he's trying very hard to get through Congress and the Senate in the US, and fundamental differences over that. And there have been signs, as I said, of friction between them before, but a sense that they also need each other in a way, so they didn't want to criticize each other too personally. But there's a strong sense on either side here. Elon Musk feels that he spent many months of his time on his Doge cost-cutting effort, and whatever you make of that effort, he believed that he was doing something and it was taking time away from his businesses, so he really felt strongly about this tax bill. Meanwhile, Donald Trump really needs it to get through Congress because he wants to show the American people he's making good on the promises that he made during the campaign, which is that he was going to cut taxes, he was going to do things like avoid taxes on tipping, and so on. And so he really needs to demonstrate that going into midterm elections. So in a way, a collision here was probably inevitable. It was just a question of whether they could keep it from blowing into a really personal public dispute. And that's clearly what's happened.
Roz, I mean, first of all, you know, Elon Musk is absolutely not afraid of standing up to Donald Trump. But why is there such urgency to patch up this relationship as fast as possible? Can it be saved, or is it just that it's impacting too many people?
Well, it does have knock-on effects. It's not just the two of them it could impact. It could impact the party as a whole, the administration, and to the American people. It's not a particularly good look to have this very public feud going on, but it does impact potentially the trajectory of this bill through the Senate. It's already having a very difficult time. It's possible it's going to get heavily amended, which sends it back to the House for further conversation. And so its passage is very fraught either way. Republicans are very divided on it. Some say it doesn't go too far. Some say it goes far enough. And so, you know, putting Musk in the mix on that and saying to Republicans, if you don't walk this bill back, I'm not going to support you with campaign funds into the midterms. But they also do need each other. It's like mutually assured destruction. You know, Trump needs Musk, Musk needs Trump. So they have to find a way somehow to walk this back, which is what they seem to be now trying to do.
Roz, thanks so much. As always, Rosalind Matheson there on this very public fight between Elon Musk and Donald Trump. Now, we're joined by Emmanuel Kuhl. He's head of European equity strategy at Barclays. Emmanuel, I'm not going to get you to comment on Trump v. Musk, but you had this wonderful insight saying, look, resilience amid uncertainty. Now, when you get to the point where it's trading insults on the internet that also moves markets, I don't know how difficult it is to see what happens to equities from here.
Yeah, absolutely, Francine. I mean, there's a lot going on social media. And we just don't know what to make of it. And because we don't know what to make of it, we try to stick to what has been our mantra since the start of the year, which is to ignore most of the noise, not of all of it, because it does have an impact on sentiment, and sentiment can have an impact on macro and the economy. But we focus on fundamentals. And what we've been seeing in our recent research, that despite all the noise and this kind of political circus in Washington, the economy is holding up. It's not great, but it's not cracking. Earnings are growing, the economy is growing, and there's somewhat a backstop for the equity market for now.
But I mean, the fact that the economy is holding up, given the bad service that we had, I don't know whether there's a transmission mechanism lag or whether actually the economy indeed is holding up. Like, how do you match the two?
I mean, we are seeing a sign of softening, right? And definitely this week was the first week where the data in the U.S. is showing some cracks. And I think today is a big day, not just because of this fight between Trump and Musk, but because of the payrolls report. And what you want is good data. There's a little bit of silver lining with the softness of the recent data, because it has put a lead on bond yields. And if you remember, the narrative 2 weeks ago was very much about the bond market getting out of control and rising yields starting to hurt the equity market. In the last 2 weeks, we've seen calm coming back in the market, the bond market, which has helped the equity market to shrug off a lot of this policy noise. But you don't want the soft data to become bad data, because if you start to see any kind of recessionary red flag, I think the equity market will start to get nervous about, look, all this political uncertainty is indeed, I think, an impact on business sentiment, on the consumer, and ultimately on earnings.
I mean, so I know a lot of traders are talking about the taco trade, which is Trump always chickens out. And you can see this being priced in the markets. But is there a similar resilience with chief executives and business that actually they go around, doing what they want to do because they think trade will settle? And do you agree with that assessment?
But we are seeing a lot of businesses talking about uncertainty. That was a main word that came up in a lot of these transcripts after the Q1 reporting season. So there is a lot of uncertainty, but we are not seeing businesses really retrenching, stopping spending, investing, or putting things on hold, right? Again, the data will be important, and I think June is almost a pivotal month for the market because, we have the beautiful tax bill, being discussed at the Senate. We have the 9th of July tariff deadline approaching, and we have a lot of data which will give us a clue about how the economy coping with all this uncertainty into summer, right? So there is a lot of caution going on, but we are not yet seeing companies stopping spending or stopping hiring. If you start to see a sign of that, that might be a question mark and a source of risk for the market for sure.
Emmanuel, I want to come back also to earnings per share, but let's also talk about China. Now, the Trump-Musk feud has stolen the thunder from China, from news that China and the U.S. have agreed to resume trade talks after a long-awaited phone call between the country's leaders.
I think we have everything. I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points. By the way, he invited me to China, and I invited him here. We've both accepted. So I'll be going there with the First Lady at a certain point.
Well, let's go straight to Alan Wong, our China economy and government editor. So, Alan, what can we actually take away from this call? How productive is it concretely?
Well, first of all, we have to remember that this call was a long time coming. It was exactly 136 days since Trump's inauguration that the two finally managed to pick up the phone at the same time and talked. And Trump had previously signaled that he would talk to Xi very soon or preview such a call, but it never happened until yesterday. So the fact that a call happened was a big deal, and because it just signaled that U.S. and China relations are at least back to literal talking terms. The second takeaway is that the trade talks that has stalled previously can now finally move on. Remember that the Treasury Secretary, Scott Bessent, said that the trade talks couldn't proceed without the leaders having a chat, and they're given the lower-level officials the green light to proceed. And being able to continue those talks matter because remember that the trade truce was supposed to last only 90 days after they struck that agreement in Geneva. Yeah. So the time is ticking, and who knows what's going to happen when the time runs out, and if Trump is going to put the tariffs up to 145% back on, or extend the deadline for the tariffs to kick in. We really don't know. But the fact is that now that the trade negotiators from both countries can continue talking, and maybe there'll be some easing going forward. And then third thing is just look at the content of their talks. Trump said that they reached some sort of agreement on rare earths, which there were a lot of uncertainty about. So at the very least, those two countries, they came to the same idea about what China needs to do in terms of export controls of those materials that a lot of American companies need to manufacture. Maybe they will get the license that the exporters need to send those goods to America to support those industries. And lastly, what's very important is that in the coming negotiations, Trump's team will have a new member, Howard Lutnick, the Commerce Secretary, and he oversees the sort of export controls that decide what kind of technology that American companies can sell to China. And those things matter a lot to China's President Xi Jinping, and maybe it means that they will be talking about that in the coming negotiations.
Alan, thanks so much. Alan Wong there from Hong Kong. We're back with Emmanuel. Emmanuel, it just feels like, as Alan's great reporting there showed, it's one step forwards, two step backwards. We're unclear whether this holds, but at least it's something that's been coming in a long time. Again, put all of this together, what does it mean for equities? Are earnings per share revision done and dusted?
I don't think they are. I mean, look, clearly they are coming down, but I think there's still this window open for the escalation, and this is what is keeping the hope trade alive, right? The market has gone a long way up since Liberation Day. You know, we are pretty much back to new highs. Fundamentally, it's quite hard to justify more upside with incoming data we are getting, but there is this glass half full view of the world, which is coming from this ongoing negotiation, and Team Trump is in damage limitation mode, right? They're really trying to get those partners on the negotiation table. I don't think they have the upper hand on all these negotiations. That's what we saw with China. You know, the U.S. depends a lot on China for a lot of very strategic imports, rare earths in particular. So there's this negotiation process in place, and I don't think those deadlines matter a lot. You know, as long as negotiations are on and there's a path toward the escalation, I think the equity market will continue maybe to give it the benefit of the doubt.
What's priced into equity markets right now?
I think a lot of good news are pricing on tariff. Right? Probably tariff back to where market was expecting them to be before Liberation Day, call it 15% in aggregate. Now, I think there is a question mark about whether the market is too complacent about the economy. As I said, today will be very important with payrolls. As long as the data doesn't crack, I think the market will continue to give Trump the benefit of the doubt, but we don't think there is much upside to pay for.
Is there upside to earnings per share, or actually, you know, company earnings in Europe? Europe seems to be at a crossroad. It could be the moment of Europe if there's a chance that's taken, but so many question marks.
Yeah, so many question marks. I think there is a lot of appetite for from global investors to diversify away from US and go to Europe. So the bar for Europe to surprise positively is not very high. This year, you know, is all about tariff and trade uncertainty. I think for next year onwards, we should start to see the benefit from fiscal expansion in Germany. So to us, the big story into 2026 is about growth convergence between US and Europe. And by the end of next year, by the end of 2026, Germany should be growing more than Europe. And that should provide some support to earnings. So the domestic story for Europe is getting better. That's largely a Germany-driven story. What we need to see for a broader participation to the upside is some kind of resolution of this trade impasse, because Europe is a global economy. The European equity market is very exposed to China, to US, and the currency, don't forget it, the currency is a drag on earnings. A stronger euro is somewhat a drag on European earnings. So what you want is a strong growth domestically, but also some kind of clarity on the global growth outlook, and ideally a more stable currency as well.
Emmanuel, as always, thank you so much for joining us. That was Emmanuel Coe, the head of European equity strategy at Barclays. Coming up, we discuss treasuries, US debt, dollar, and much more with Greg Peters, co-chief investment officer at PGIM Fixed Income. That's next, and this is Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
even in this time of uncertainty, we've remained as certain and deliberate as ever in our approach. I think so. This is why I am very supportive of the recent decisions from the FOMC to keep the policy rate steady.
Well, that was Philadelphia Fed President Patrick Harker there. Now, joining us now is Greg Peters, Co-Chief Investment Officer at PGIM Fixed Income. Greg, I'm so happy to see you because every day we talk about treasuries and you can make sense of it all. So first of all, I mean, one of the patterns that we're trying to figure out is whether there's going to be a lot more divergence between the ECB, that yesterday was pretty hawkish, and actually Fed policies going forward. I know we have the jobs report later, but does that create opportunities in the markets?
It absolutely does. So there is divergence, and it's driven by multiple factors: difference in inflation, difference in growth, and then there's moves that are happening from a correlation standpoint that kind of feeds upon itself. And so what I mean by that is U.S. Treasuries has been questioned kind of the efficacy of a hedge versus risk assets, right? And so what investors are doing is that they're moving outside of Treasuries into gilts and bonds and other markets as kind of a diversifying factor. And so it's all together.
What are you expecting from the jobs data today? Again, this seems the first week where we've had a little bit of pressure on the American economy.
So there's been a divergence, speaking of divergences, between the soft and hard data.
Yeah.
All right. And so there's been a questioning of whether that soft data matters anymore. I think it does. It takes time. But there's a lot of white noise in the system. But the one factor that we have to focus on is the labor market. That's really what matters. And so, this type of data coming out today is important. And if it comes in soft, well, I think there's a bias. If the data come in softer than expected, then I think that's going to have an outsized reaction versus the opposite.
Yes. So if there's soft data today, will you favor treasuries over anything else actually in Europe?
I would. The way I think about it is you want to be as close to central bank policy as possible. Yeah. So you look at what's happening in long end of rate markets. It's becoming disconnected, right? It's being driven by risk premium, kind of politics, all these other types of factors. As you get closer to central bank policy, it's much more known or let's say better understood. So the way we think about it is, kind of 10 years in is where you want to be because it's a cleaner play around central bank policy.
Right. I mean, talking about politics, we're all distracted by this, massive fight between Elon Musk and Donald Trump. But actually, it all started on fiscal troubles, right? It was basically because Elon Musk says, look, we can't afford this. I've done all this Doge cuts, and with your tax bill, it goes against it. I mean, do you worry longer term about fiscal troubles and what that means for long bonds?
Absolutely. And I think the market worries about it, too. And so this is not just a U.S. phenomenon. This is global. So there's too much debt everywhere on the sovereign side, which is why kind of back-end curves are behaving so poorly. But one of the ironies or perversities of this battle is that maybe it will bring more attention to the debt and deficit, which I think is a really big issue as we kind of go down this path over the next few years. And the Doge cuts never really manifested, right? So that was more kind of fake than reality. And this bill being put forth is far from a deficit reducer. So we need more pressure on politicians to attack this problem.
Yeah, I mean, I was reading a quote by someone saying, I want to come back. If I wanted to come back as the most powerful person on earth, it wouldn't be as a king or a queen or even a president. I'd come back as a bond market. Yeah. When does the market really, start to wake up to all these troubles? I know we've seen a couple of auctions. There was a bit of concern over Japan this week. But again, it kind of freaks out and then it's fine. So are you expecting a credit event or is there, I don't know how it plays out.
I don't think it's a credit event, but I do think it manifests itself in risk premium. Term premium, however you want to define it. And that just puts more pressure on the back end of these yield curves. You're seeing it in Japan. You're seeing a buyer strike, really, in effect. And why is that? Because the uncertainty is transferring into kind of higher bond yields. And with the debt and deficit where it is, it makes more sense to be more circumspect in the back end. So, this is a story that's not going away. But it's important to keep in mind that this tax bill was thought about as a positive going into this year. And it's just the opposite because the focus on the debt and deficit.
For the first time this week, there was, someone saying, well, we've always assumed treasuries were the safest. Are they? Do we need to ask ourselves what happens? Are you having some of those conversations tied to whether, American exceptionalism slows down or even comes to an end?
I think it's more passive than active. And so I just think there's a natural diversification going on at past level. So over the next 3 years, about 30% of foreign holdings are maturing in U.S. Treasuries. Yeah. And so our expectation is that a portion of that will move outside of Treasury. So it kind of feeds upon itself, but it's not this cataclysmic type of event. I think it's more of a slow burn.
Okay, your highest conviction, given all of this, we've been around the world in like 10 minutes. What are your top 3 plays right now?
Yeah, so I think the cleanest expression of everything that's going on is in the currency markets.
Okay.
So I still believe that the dollar is poised to weaken here. So that's the cleanest. And I think the other one is what we call in fixed income the curve steepeners. Yeah. What you have it in the U.S. And Japan as well. So there is this real pressure on back-end yield. So I think that will continue to play out. And the third is yield and carry in safe form. And what I mean by that is high-quality structured products, short carry, credit instruments like investment grade and high-yield bonds. But you want to be in a safe environment. I think leaning into risk in this environment is a fool's errand.
What do you do with the UK? I mean, do you spend a lot of time thinking about the UK, or is it one that, just is there?
Well, a little bit of both, I'd say. I mean, the UK has a kind of a different set of issues relative to Europe and relative to the U.S., so it's kind of caught in between, right? But in the same dynamics as far as curve steepening is concerned, dealing with kind of inflationary pressures and growth at the same time. So I think about it as far as avoiding the back end there as well.
What happens to euro? I mean, if you look at dollar, yesterday, I don't know if you were surprised by some of the hawkishness in ECB, but it seemed to, at the margins, to indicate something that we hadn't really heard before.
It was. We're done.
Yeah.
Not quite mission accomplished, but we're done. It was a much more hawkish read than I think what the market was expecting. And I think that helps kind of push the euro higher here. But, is it a euro story or is it a U.S. dollar story? I think it's more of a U.S. dollar story than a euro story, but events like yesterday helped kind of push the euro up, not down.
I know it feels like a long time away, but then we have the defense, package from Germany. Does that change the trajectory for Europe, or is it wishful thinking?
A little bit of both, once again. So, the markets were really excited around the prospects of increased spending. But once again, politics often get in the way of that, so we'll see what that bill looks like. But all else equal, that is something that will benefit Europe, but we'll see if that money actually gets spent.
Greg, thank you so much, as always, for joining us. Greg Peters, our Co-Chief Investment Officer at PGIM Fixed Income. Coming up, why confidence amongst chief executives is plummeting. We discuss a new report by the Conference Board. That's coming up next. And this is Bloomberg.
case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Elon Musk moves to cool tensions with Donald Trump after their public spat drives down the value of Tesla shares by $150 billion, while Tesla rebounds in pre-market trading. A phone call between Presidents Trump and Xi calms markets. The two agreed to further talks to resolve the trade war. Plus, UBS is set to be told by the Swiss government it may need to put aside as much as $25 billion against future losses. I'm not sure why we're seeing pictures of Nigel Farage, but we're all also looking at a by-election here in the UK, so maybe that's something to do with that. Just ignore the pictures and focus on what we're saying. Now, Tesla shares sinking as Elon Musk and President Donald Trump simmering feud devolved into a public war of words between two of the world's most powerful people. Now, Tesla shares rising in pre-market trading this morning. Joining us now for a look at the business impact is our Tom McKenzie. Tom, I'm so happy to speak to you. I mean, it was quite a fallout, right? I mean, I know we were all like on social media at 10 p.m. London time, figuring what it was, if it was real. But aside from that, there's also just like a business impact.
Yeah, absolutely. Look, they both went, both barrels blazing, really, in this very public spat, as you say. The business impact was there, and we just saw the moves lower on Tesla stock during that whole debacle between President Trump and Elon Musk, who, of course, was kind of responding live on the X platform. So the Tesla stock ended down 14%. As you say, that wiped off $150 billion off the market cap of Tesla. It knocked about $34 billion off the value as well, the net worth of Elon Musk. It's likely more than that, because you have to fold in what's SpaceX and XAI, both, of course, private companies, and what it means for their attempts to fundraise and their valuations as well. SpaceX most recently valued at about $300 billion. So the impact on Musk's business empire is far beyond just the impact on Tesla, and it was clearly very notable. And no doubt it's a factor that's led into his decision, prompted by some on Twitter or on X, to cool tensions, and it now seems they're going to be setting up a call, at least White House aides apparently going to be setting up a call between themselves, possibly President Trump as well, and certainly with Elon Musk later today, according to reports. I mean,
what I find incredible, and actually, you know, the chatter is he really stood up to him despite losing all of this valuation, because he just thought it was wrong. So I don't know whether it brings others to actually stick up when they see something that doesn't work. So there's the empire of Tesla. Yep. I mean, do we know what the White House could be targeting?
Well, so there's all sorts of implications. I think you make a really valid point in terms of Elon Musk continuing to go at this, even as he saw the drawdown in the stock. And it's a reminder for investors that he is willing to sacrifice his company's brands and reputations for causes that he believes in, rightly or wrongly, whether it's getting involved in the politics of Germany, for example, and the backing of AfD and what that's done for Tesla sales in Germany, but also in France as well, and whether or not, of course, it's his involvement with Doge and the political backlash and what it's done to the brand image in the US as well. In terms of the levers that Trump would have at his disposal, he could use the levers of government to end contracts, for example. It would be complicated, legally complex as well, for SpaceX and Tesla. They have both companies benefited by about $20 billion in terms of federal contracts. It's not nothing over the last 2 decades or so, as far as we know, on Bloomberg reporting. There are the questions, of course, of the EV subsidies. Those are going to be written off as part of this tax bill. Doesn't seem like Trump's going to be walking back on that. There's scrutiny as well of California's carbon credit scheme that benefits Tesla to the tune of about $2 billion. That is another potential pain point. There's regulation when it comes to autonomous driving and mobility that Musk has said is really important for his robo-taxis. If they don't push ahead with that regulatory easing, that could be really consequential as well. So on all manner of fronts, all number of fronts, there are potential pressure points here for Musk down the line. He needs to be working with this administration if he wants to achieve those goals.
Tom, thank you so much. Terrific briefing there with Tom McKenzie. Now, confidence amongst chief executives in Europe has plummeted. That's according to a new report by the Conference Board, which says pessimism is likely being driven by geopolitical tensions and trade uncertainty. Well, let's unpack all of the details with Maria de Mertzis, Economy, Strategy and Finance Center Leader for Europe at the Conference Board. So, Maria, thank you so much for joining us. I mean, if you're a CEO today, I don't know what you look forward to. There's so much uncertainty out there. Is there anything that they're feeling confident about?
Difficult to find. I think cost cutting is really a very big objective in CEOs. Are very worried about the implications of tariffs, geopolitics, just uncertainty really, and that is reflected in the sentiment that we saw on the latest vintage of the survey, where we saw actually the biggest decline in CEO confidence about the euro area. Certainly, when it comes to global conditions, also things have changed dramatically by comparison to the results of the last vintage in December of last year. In December, CEOs in Europe were actually pessimistic about the European economy, but they were very upbeat about the global economy. That is completely changed now, and CEOs in Europe are very, very negative about the global economy. And perhaps more importantly, I think, the corresponding survey that we do in the US has a very interesting result this time around, where CEOs in the US are extremely negative about the US economy, when actually just at the start of this year, they were very, very optimistic. A very tremendous drop in US CEO confidence, and the largest drop in the 50-year history of the survey that we do. So this is really notable. Something is different.
So, Maria, what exactly do they worry about? I mean, it's trade, it could be, backlash and all of that. But is there a longer-term worry that even if, trade settles, there'll be longer-term implications of what we've lived through on the economy?
Certainly, but I think the first part, what we call policy uncertainty, that is really now what is dragging down the confidence in CEOs and quite clearly in the rest of the economy as well. Policy uncertainty is so high, it is historically high. Policy uncertainty is simply we just don't know what decisions will be taken. If that part of the equation were to be resolved, I think things would be different. Yes, you're right, there are underlying factors that are structural factors that remain uncertain, that adds to the uncertainty. But what is really unprecedented is the policy uncertainty. That we can fix and we should fix.
Maria, what's the one thing that surprised you the most, actually, in terms of putting this report together? If you look at defense, there is maybe a little bit more optimism out there. But what of, the three subcomponents of the confidence that dropped? And what's the one thing that you thought would have gone differently?
Actually, I think I was quite surprised to see how CEOs changed their views about the rest of the world. For the longest time, CEOs in Europe are quite pessimistic about internal conditions. We know that Europe has productivity problems, investment problems. However, CEOs, invest in the rest of the world, and they're quite quick to move to where the investment opportunities are. What's really interesting this time around is that is no longer the case. They're very worried about investing in the US, about investing in China, because they see that there are structural problems that need to be resolved. This is actually quite surprising, and what was surprising, the speed at which CEOs changed their mind about this. Now, we need to see also how they will decide differently, and that, of course, the survey does not capture. Will they invest less globally, or will they not? Will they return to Europe? These are kind of interesting questions that will play out, and we are monitoring the data when it comes particularly to investments to see how this will play out. But I think that the other thing about the confidence survey that we did is that they're really worried about the single market, and they're really asking, pledging actually, for the Europeans to actually make a difference in the single market and advance some of the policy recommendations of the Draghi report.
Maria, I mean, I was going to come to actually the single market, because is there too much noise about some of the external things, some of the uncertainty out of the U.S., that we forget to really focus on some of the structural concerns that we have in Europe that have not been addressed?
Indeed. Well, we had two reports at the end of last year that, they lay the groundwork for what needs to be done. In the survey, the CEOs are insisting that progress in the single market can start with defense. Really, procurement is the issue here, and this is something we can do and we should do. There's a lot of movement here in Brussels in terms of, advancing this issue. So I think there is, dare I say, optimism in terms of actually doing some of the promises when it comes to investing on defense. But there is a long road to cover here, and of course there remain a promise. I think the European Commission is working on particular issues on also advancing with bits of the Capital Markets Union. That would certainly help. And of course there remains the issue of fiscal participation in all of these expenses on the background of huge debts. So that is a difficulty. It remains to be seen how much Europe will be able to pull this through, particularly when it comes to joint borrowing, which is the one thing that will actually make a difference.
Maria, I mean, one of the other things is that, that we talk a lot about technological advancement. I know this was a big chunk of your piece and your report as well, and the need to accelerate it in some of the key industries. When you look at AI and robotics, what was the answer from CEOs on that?
Well, there's not much there, I think. I think the emphasis on the single market is not so much on this, even though the Commission is actually advancing and putting, even yesterday we saw some new initiatives putting down on how we are going to advance on the AI. We have to understand that these are not something that can be done in the short run, but we need to lay the groundwork for this to happen in the medium term. In the short run, I think the European Union remains a laggard when it comes to its relative position globally. We are hoping that we will make some steps forward, but in the short term, this is very difficult.
Okay, Maria, if you look at your report and actually some of the confidence crisis that you've seen from CEOs, what's the prescription to make it better?
I guess the European economy needs to deliver on promises, the productivity puzzle that we have, investing on defense. These are the things that will judge the success of Europe in the next 2 years, the important years, in order to advance on economic security as well. Now, next to that, of course, is the climate and energy issues. But we are working very hard on relieving ourselves from dependency on Russia. And on advancing on the energy transition. So there I would also say we need to see some concrete steps on advancing with the energy union and ensuring the energy security in Europe. And beyond that, all the other things that are mentioned in the Draghi report, of course, we need to deliver on them. The priority right now, however, is finishing the war in Ukraine and ensuring that we have a higher defense spending.
Maria, when you look at all of that, does that come before or after trade wars? Basically, is the trade wars and the uncertainty a catalyst to get that done, or is it a hindrance?
Well, it's definitely a hindrance. I think we would prefer if we didn't have the trade wars, and that comes back to my original point about trade uncertainty and policy uncertainty in more general. It would be very helpful if by beginning of July we have some decision on what is the relationship between the EU and US when it comes to trade. Hopefully less tariffs than more tariffs. But at this point, we just need clarity. And we hear that a lot from businesses. They just want to know what's going to happen, and they will adjust when it comes to costs.
Yeah. Yeah, it's really interesting, Maria. I've had a lot of people actually come on the TV show saying actually it's the contrary, is that Europe is really good in a crisis, and it's only in a crisis when attacked from all sides that they come together. Maria, thank you so much for joining us. Maria Dermartzis, their Economy, Strategy and Finance Centre leader for Europe at the Conference Board. Now, the UK's ruling Labour Party has unexpectedly won a by-election in Scotland. The Scottish National Party had held the seat in Hamilton, Oracle and Stonehouse since 2011. The victory for Prime Minister Keir Starmer's party also challenges reform. Well, UK's growing influence in Scotland coming in the same 24 hours that the chairman, Zia Yousaf, resigned from the party. Well, for more on all of this, we're joined by Bloomberg's Adam Blanford. Adam, I'm so happy to speak to you. What does this by-election actually tell us about the state of the parties?
Good morning. Well, it's interesting. It's important to note, of course, that this is a by-election in the Scottish Parliament and not the Westminster Parliament, and it's got its own dynamics up there in Scotland. In general, Labour has been celebrating the fact that, as you know, it's the governing party, and they've been having a difficult time in the opinion polls recently, having also just lost a Westminster by-election not very long ago. They've actually been able to take a seat from the Scottish National Party, which has been in power in Scotland since 2007. So the SNP were looking to try and retain that seat. They've been trying to bolster their position in Scotland ahead of wider elections across their next year in 2026. But Labour has been, bullish and saying that this is a great result for them, that they've been able, despite their national travails across the UK, to get into a winning position. Reform, on the other hand, is a really interesting story there. They've been surging in the polls nationally across the UK, and they're looking to make big inroads in Scotland and opening up a new possibility there from where they didn't really have a presence before. They came very narrowly behind Labour, just 1,500 votes or so behind Labour to come in a close second. Close third, making it a really tight three-horse race. That has implications potentially for electoral races in Scotland if they're able to drive a wedge in various of these the Scottish constituencies, and could perhaps open up a path for the SNP to win a majority in that election next year. Those are the sort of cross currents that are concerned there, and of course, where the SNP goes, discussion about Scottish independence always follows.
Yes, and I mean, this is very significant, and actually it's not what a lot of people are expecting. So just for our international audience, what's the importance of Scotland to the rest of the UK?
I mean, Scotland's been an integral part of the UK for many, many years, in terms, but for hundreds of years. But of course, as well, in political terms, the Labour government, governs, has many seats, did very well in the national election last year, and so its position nationally is bolstered by having won a significant number of Westminster seats. More generally for the UK, of course, there was a referendum back in, I think, 2014 now, on Scottish independence, and that issue has come up again and again. Opinion polls now putting the issue, support for the issue, at a higher level than it's been for a very long time. And if the electoral dynamics shift in Scotland towards a position where the national parliament there wins, is controlled by the Scottish National Party, that reopens up that position, possibility of an independence referendum. They say, you can always need to be very caveated on how you say these things, but that's always the conversation around what happens when Scottish politics starts to shift.
Yeah, I mean, the other big development is, of course, reform. The party's chairman quit yesterday, rather unexpectedly. What does that signal about the party's prospects?
It shows, it's an interesting indication that this party, which has been developing and growing really quickly, just last year taking 5 seats in Westminster in the wider general election, and now riding high in the opinion polls, appearing to take support from both the Labour governing party and the Conservative opposition. That this is a young party that continues to really be dominated by its very famous leader, Nigel Farage, and that those in positions of authority within the power don't always really have that authority, and there have been a number of falling outs. An MP, Rupert Lowe, left the party not very long ago after being involved in a dispute over his behaviour. Now Zia Yusuf, who has said in his departure tweet post yesterday that he was responsible for, involved in building up the party and quadrupling its membership in recent times. And of course, it did very well in local elections recently, but is now being put to the test, and how does it have a deep enough bench to run councils and sit on councils and make a real impact in the UK. So we need to see whether reform keeps growing or remains Nigel Farage's vehicle.
Adam, thank you so much. Adam Blanford there, who leads our EMEA news desk. Now, the UK has banned 6 water companies from paying bonuses to senior executives in an effort to make them do more to tackle pollution. Now, regulator Ofwat has powers to stop unjustified payments for poor environmental and customer performance as part of new legislation that comes into force today. Now, coming up, traders price in a rate cut in September after U.S. jobless claims unexpectedly jumping to the highest level in 8 months. We'll look ahead to today's key jobs reports. That's next, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
UBS set to find out whether it will be forced to drastically beef up the amount of capital it holds when the Swiss government publishes a draft law this afternoon. Now, Switzerland's biggest bank faces having to maintain as much as $25 billion in extra capital if the government decides it should be able to fully cover losses at its foreign subsidiaries. Well, we'll also talk U.S. payrolls in a second with Rachel Evans. But for more on this capital requirement for UBS, we're joined by our finance and investing editor, Tom Metcalf. Tom, finally, we've been talking, I feel like we've been asking the leadership at UBS about this capital requirement for at least 2 years. So finally, the day is here. What do you think will happen?
Yeah, it's kind of the moment we've been waiting for, and we're expecting the Swiss government to come out sometime this afternoon with its proposal, and we're expecting them to, at least as their initial proposal, to be pretty hard line. So basically going for this $25 billion hit, which obviously for UBS would be, absolute nightmare, and they'll be looking at ways to push back on that. And then obviously in the longer term, if they really can't persuade the Swiss government to take a different tack, who knows what might happen in terms of, there's even been floated, they might even relocate out of Switzerland. That's the nuclear option. But it's going to be really interesting to see what happens, and perhaps most interestingly, how UBS respond today to this official announcement.
Yeah, I mean, and we were speculating about, what they could do with the investment bank. I mean, if this is if you need to have $25 billion extra, it's an existential threat, actually, to UBS.
Yeah, exactly. And the interesting thing is it's all about the foreign subsidiaries, right? So that's what's, presumably if they're looking to change things, are there ways they can move things around or change the locale for those things? But obviously, I would say this is a long way off, right? The law is going to take years to come in. And so what I suspect will happen is there'll be a moment, almost like a cooling off period. Both sides are going to probably sort of prepare their arguments. And then, as I say, over the coming months, it'll be really interesting to see how UBS try and, get what they want out of this situation.
Tom, thank you so much. Tenterhooks, all of the community in Zurich, and all bankers worldwide looking at what's happening in Switzerland. Tom Metcalf, they're in charge of finance. Now, bond traders will dissect the May jobs report for any signs of a softening labor market as they gauge the timing of Fed interest rate cuts. Joining us now is Rachel Evans. Rachel, I mean, I guess, the point is that there has been always a little bit of a difference between the surveys that the economy is getting bad and the data points. But this week we started to see some of the data points in the U.S. going slightly bad, which is why the labor market today is such an important number.
Yeah, 100% agree. I mean, I think bond traders have shown just how much is riding on this report. Yeah. As we've kind of been coming into it, we saw the biggest one-day rally for the bond market in about 2 months on Wednesday after that weaker ADP print. Yesterday, we saw those initial jobless claims also prompting gains in the bond market before those were eroded after the ECB meeting. So I think there's a lot hanging on non-farm payrolls today. It's always a big number for the market, but I think this time in particular, just given everyone is focused on kind of how the jobs market is holding up, people are going to be very, very focused on it.
Yeah, so what are they looking at? What are traders looking at in this report particularly?
Yeah, so I mean, the number that's sort of expected is 126,000. That's kind of the base case. I think if we're getting below 100,000, that's sort of a number that's kind of been flagged by analysts as where they would really start to worry about cracks in the labour market. It will also be interesting to see whether we get any revisions to kind of the previous month's print. That was 177,000. Does that get lowered at all? And I think also worth keeping an eye just on kind of those average hourly earnings numbers, just given we know the Fed is so focused on inflation. And I think that's going to be the big question mark. Even if the labour market starts to falter, will the Fed move, given that the inflationary part of their mandate seems to be taking precedence?
Yeah, Rachel, I mean, we had quite a lot of, again, change in what the markets are expecting, numbers of Fed cuts, right? And we're at 2 this year. So it could, again, this could change dramatically, and then you see this differential between what the ECB, that was quite hawkish yesterday, and what the Fed could do.
Yeah, it's 2 at the moment, and yesterday we saw a bit of flip-flopping between whether that first cut would come in September or October. Currently, it's not fully priced until October, but I think, if you do see a weak labour print, you could see that becoming more firmly entrenched as a view for September, and even the potential for some of that starting to get priced into July. I think the bar for a summer cut is pretty high, but at the same time, you could start seeing the market speculate that maybe that's the direction they need to head.
I mean, were traders expecting the ECB to be so hawkish yesterday?
I don't think they were. I think there was a lot of anticipation that the ECB was kind of nearing the end of its cutting cycle. But the fact that kind of, Lagarde pretty much said that.
That's it.
Thank
you so much.
Exactly, yeah. And that July was kind of, off the table, based on kind of some of our sources reporting. I think that went slightly further than people expected, and kind of some expectation that we could see kind of further sort of shifts to the growth picture kind of coming through that would mean that potentially the ECB could kind of call it.
Yeah, and Rachel, I mean, it was actually just a big week overall, right? Also because of some of the longer concerns about bond auctions, like the long end bonds.
Yeah, and I think that's kind of the angst that's sort of lurking in the background. Like, this week we've been focused a lot more on the macro. We've been thinking about the US economy. Is it weakening? Do we need to see cuts? We've been thinking about Europe. Where is the path of cuts there? But the long bond picture is very much unchanged. We've seen weak auctions in Japan, and we have a big 10-year and 30-year US auction next week that could really tell us more about long bond demand.
Wonderful. Thank you so much for joining us, Rachel Evans, with all the things you need to watch out for. Smart analysis. Don't miss the new edition of Bloomberg Weekend Newsletter, where you can get deeper analysis, feature pieces, and profiles that provide unique insight into the latest news from around the world. It's also quite fun. They talk about restaurants. It'll be a nice relief after the jobs data tumult that we'll see this afternoon. Up next, it's Bloomberg Brief, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
What would it mean for India to host the Olympics?
Heslinda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. It's 5 a.m. in New York City. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Cooling down. A public feud between Elon Musk and President Trump may de-escalate with a scheduled call today. Back in the green, stock futures climb. Tesla bounces back after falling 14% yesterday, and all of that ahead of the latest jobs report after jobless claims rise to the highest level since October. So in terms of what we're looking at on markets, S&P futures now up 0.4%. NASDAQ futures gaining about the same. Russell 2000 small caps have really been winners this week, outperforming the benchmark indexes, the bigger benchmark indexes. In terms of treasuries, we've been watching for turmoil, especially at the long end. Really haven't seen it. The 2-year yield at 3.90, 3.91. The 10-year yield still at 4.37, 4.38, and the 30 yield at 4.86. So a long way down from 4.50 and 5, which are the levels that caused a little bit of angst. For some stocks to watch, let's get over to Valerie Teitel in London. Valerie?
Good morning, Matt. Let's start with a check on Tesla. Those shares recovering somewhat, up 5% so far in pre-market trade. Some optimism for the stock after hearing that the White House aides have scheduled a call with Musk. Politico reporting that has been boosting the stock after the worst market cap slide for Tesla yesterday on record. Let's move on to the retailers who've reported earnings, that being Lululemon, cutting its full-year profit outlook. Again, those shares are down 21% pre-market. There was also a warning in their earnings about their profitability due to tariffs. That's going to be one to watch on the open. Lastly, let's move on to tech. Broadcom are giving a tepid forecast. This is the chip supplier for Apple and Alphabet, falling some 4% so far in pre-market trade.
All right, Valerie, thanks very much for that. Valerie Teitel looking at some of the stocks moving for us. Obviously, Tesla is front and center. And The jobs number is going to come out, may overshadow that feud between Elon Musk and Donald Trump, doubtful, but we're going to speak to Monica Defend of the Amundi Investment Institute on markets, as well as Citi's Veronica Clark on today's upcoming jobs report. But a week ago, President Trump and Elon Musk stood side by side in the Oval Office to proclaim their lasting friendship. Yesterday, tensions between the world's most powerful politician and the world's richest man flared up spectacularly as they traded insults, hurled accusations, and made threats in real time in the town squares of social media. Musk went as far as agreeing with an X post calling for Trump's impeachment. The president, in turn, hinting that he may terminate U.S. government contracts given to Musk's companies worth billions of dollars. He spoke about the feud in the Oval Office yesterday.
I've always liked Elon, and it's always very surprised. You saw the words he had for me, the words of, and he hasn't said anything about me that's bad. I'd rather have him criticize me than the bill, because the bill is incredible. It's the biggest cut in the history of our country. We've never cut. It's about 1.6 trillion in cuts.
In response to a user of X urging him to cool the feud, Musk has signaled a move towards cooling tensions with Trump after the very public unraveling of their relationship. For more, I'm joined by Bloomberg Weekend America's editor Kevin Whitelaw and senior editor Bill Ferries, who has covered national security for us here in the States. Kevin, let me ask you first about this feud. It was pretty spectacular. I mean, allegations about ties to Jeffrey Epstein came up. How did that erupt?
Well, you know, I think that it all, first of all, these are two incredibly, strong personalities, and I think there was a certain amount of betting in various parlors and casinos around the world about how quickly this and how long this thing could last, because these two men were obviously very were bound to clash at some point. In this case, it does seem to be that the spending bill, which Trump was praising, ultimately really is projected to add a huge amount of money to the deficit, rather than really sort of cementing the kind of spending cuts that Elon Musk was really trying to push in his role at the Department of Government Efficiency. But also the bill really zeroed out very quickly electric vehicle credits, which is something that is near and dear to the heart of Elon Musk's Tesla. And so this the bill not only didn't sort of cement what Elon Musk's government legacy was going to be, but it was also threatening his company. So it does seem like those two things sort of made him really tee off against the bill in a very strong way, and that obviously triggered the reaction we saw from Trump and sort of the spiral that then went. And I think the ultimate question is this beyond repair at this point?
So I guess the most important question here, Kevin, is how influential is Elon Musk when it comes to congressmen, when it comes to senators? Can he actually kill the bill?
Well, I mean, the bill was already in a fair amount of peril because of the Republicans have an extremely slim majority in the House. In the Senate, there's a number of senators that have some very fundamental concerns and problems with it. So it was always going to be a very, very difficult lift to try to get this bill through in any kind of form. And obviously, when you have someone with the kind of wealth and potential influence of Elon Musk teeing off against it and pointing out the inconvenient truth for Republicans who had been wanting to talk about the spending cuts and talk about how this really actually is adding this enormous amount to the deficit, that's really an inconvenient thing for them to hear at a time where they're trying to find some consensus on it. So he can definitely throw a monkey wrench in it, but ultimately, the Republicans in Congress are going to have to decide who's more important, the president, who has shown that he still has control over the heart and soul of the Republican Party, or Elon Musk, who obviously, whose purse strings could be used either to help or to harm them down the line.
Kevin, thanks very much. Bill, let me get to you on the national security side, because Trump has put Musk's businesses in the firing line. Obviously, SpaceX incredibly important to what we're doing with the ISS. Starlink has been very important to the Ukrainians in the war that Russia started 3.5 years ago. What would the implications be of the U.S. government cutting off Musk's companies?
Yeah, they would be huge. It's hard to see that even happening. I mean, the U.S. government and Musk-owned or Musk-run companies are so intertwined. One doesn't function well in some realms without the other. I mean, Bloomberg government did a quick look at it. Tesla and SpaceX have gotten about $22 billion in unclassified federal contracts since 2000. There's billions more likely in classified contracts that we don't have a lot of insight into. The entire space program is hugely dependent on SpaceX and its capsules and rockets, getting astronauts to space, resupplying them, bringing them home. There are potentially some alternatives out there, but they're not great ones. Boeing's Starliner had some issues when it delivered a pair of astronauts to the space station last year, where the U.S. is trying to avoid reliance on Russia's Soyuz space rockets for obvious reasons, given the relationship between the two countries. It's hard to see how the U.S. space program goes forward without SpaceX. Listen, Matt, you're a car guy. If you just look at Tesla's attempts to try to get driverless taxis, driverless vehicles out on the roads, the U.S. will have a huge influence on that. So it's a two-way relationship, and I think both sides, as we're seeing already, are trying to find ways to kind of dial back the temperature because they see it's in both their interests to not have this feud, at least not be so public and brutal, really.
So, Bill, what's your take on, Musk's ability to kill this bill and also on the DOGE cuts? I mean, does Trump walk some of those back? Does any of that get undone? Or after a détente, does everything continue on as usual?
Yeah, I mean, I think Musk has put the wind in the sails of some of the Republicans who want to see much bigger spending cuts. As Kevin pointed out, it's a super slim majority. I think Republicans can only afford to lose 3 votes, perhaps in the Senate, and a roughly similar number in the House. So they don't have a lot of margin for negotiation. But I think, in the short term, Republicans are going to fall in line behind the president. But just looking a little bit past the next few weeks, Republicans know this is the world's richest man. He poured $290 million into President Trump's campaign last year, helped him win Pennsylvania, helped him win the presidency. They want him on their side in 2026 when it comes to the midterms. That's not a relationship they think they can afford to lose either.
Bill, thanks very much. Bill Ferry's there, and Kevin Whitelaw talking to us about what has to be, at least yesterday, one of the most important feuds in the world. In terms of Tesla's stock reaction, that was also a case of $200 billion of lost market cap without any corporate news. I don't think I've ever seen anything like that. The shares closed down 14%. They were off as much as 18% at one point. You can see in the pre-market, Tesla shares are bouncing back a bit, recovering about 5%, as Valerie was telling us earlier, up to almost $300 a share. Let's get to the other top stories trending on the terminal this morning, if you care about anything else at all. BlackRock is planning a second round of job cuts this year, cutting about 300 people after a similar move at the beginning of 2025. It comes after the world's largest asset manager splurged on $28 billion of deals to wade deeper into private markets. The job cuts represent a little bit over 1% of BlackRock's workforce. HSBC Chairman Mark Tucker will leave the bank in September to take on a non-executive chairman role at AIA. Sources say the insurer has been holding informal discussions with Tucker on a role for at least a year. He will take over on October 1st. And the U.S. Treasury has called on the Bank of Japan to raise interest rates to strengthen the yen in its semi-annual currency report. The report is likely to support market speculation for the BOJ to raise borrowing costs again later this year. The BOJ holds its next policy meeting on June 16th and 17th. That's a 2-day meeting. Coming up, we're going to look ahead to the payrolls report with Monica Defend of Amundi Investment Institute. Next, will the U.S. add 120,000 jobs for the month? This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The risk was a downside surprise, the reality an upside surprise.
The shock has affected outcomes.
There's a pretty big cliff from an economic perspective.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
American exceptionalism continues.
This is not what we're going to experience in the upcoming months.
Is it going to be Biden data or Trump data?
The May Jobs Report, today on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York. After a week of mixed jobs data, we end the week with May payrolls coming at 8:30 Eastern time this morning. Joining us now is Monica Defend, head of Amundi Investment Institute. And Monica, you know, to me, the most notable figures in the jobs picture this week have been really down arrow stories, right? ADP, a big disappointment, and then you had one of the worst weekly jobless claims figures in months. How do you expect that, or what does that tell you about what we're going to see today in the non-farm payrolls number?
Well, we frame it in our outlook that actually project progressive cooling of the job market, not cracks, but definitely a job market that is slowing down. So this is our expectation for the day. In the idea that the trajectory for the U.S. economy is towards a softening in the growth rate. We have 1.6 as a projection for the year. That is coming from a softer consumer side.
So you don't expect a recession, because a lot of people have posited that we may, because of the pull forward demand ahead of the tariffs, see more imports leading to another drop in GDP and a technical recession. Others, like David Rosenberg, yesterday tweeted that the recession has been confirmed by the Beige Book. You don't see that happening this year in the United States of America?
Not actually. It is not our base case scenario. Obviously, it will depend on how the discussion on tariffs will unfold. But I would not forget the sequence that the administration has in mind, which is tariffs, security, but then tax cuts and deregulation that somehow should be growth positive. So the balance will be between how much they can cut on taxes and how much they might raise on revenue. So I don't really see tariffs as a reciprocity, but it's more as a revenue seeker.
Yeah, that makes sense, since Donald Trump has been a fan of tariffs pretty much his entire life, and has been very clear about the fact that he wants to replace tax revenue with tariff revenue, regardless of what Howard Lutnick may say when testifying in front of Congress. How do you think that all works out? I mean, the CBO says we're going to see a $2.5 trillion deficit over the next decade, but at the same time, $2.8 trillion in tariff revenue. So that would seem to offset the hole in the budget.
Well, it's also a matter of timing, because there is a mismatch in the timing you get the revenues and the timing that you cut the taxes. So taxes will come before you'll get revenues. Having that in mind, we really think that the debt levels will stay high and deficit larger. But eventually, it will depend on how this will engineer growth, because you can sustain higher debt as long as you have growth. This is not exactly what the fixed income market, right, is pricing, with the movement that we have seen, particularly in the long end. Over the last month, the swing has been really huge.
It's been pretty interesting to me to see us really come back from the precipice of the danger zone in terms of yields, right? We were above 5% on 20s and 30s here. We were above 4.5% on the 10-year. And now the bond market seems pretty sanguine at 4.38 on the 10-year, 4.88, 4.87 on the 30-year. Does that mean we aren't as concerned in terms of debt and deficits?
Well, the risk premium is building up, and therefore the steepening of the curve is probably one of the biggest conviction we have. While it is really difficult to find a clear directionality on the rates front, so this is particularly difficult to allow us to have a strong duration positioning. So probably the 5-year at this point is better than a long duration of 10 years, whereas the expectations are quite wide. I mean, the 10 years can go from 4 to 4.75. So it's really a big range. And what we are looking and monitoring is that this pressure on bonds is not only something U.S. denominated, but look at what is happening in Japan. So debt levels are high everywhere. At a time where you have central banks that started quantitative tightening and probably will be asked to reduce it. Think about the Bank of England, and a mismatch between supply and demand. So there is a lot more beyond the worries on the debt levels that is going on the bond market now.
By the way, I was thinking about what it means to the world when countries with massive deficits start to refinance those with all at the front end, in the U.S. and Japan if they don't have a lot of long-end demand. And then I thought about Europe. Well, there really there isn't a Eurobond market, but there have been more and more calls for that. How does that look to you? When are we going to see that? Because it seems inevitable.
Well, I think there is a tremendous opportunity for Europe now to take the lead on the financial market and also on the trade side. The idea of the Eurobond not only or not necessarily to finance more defense, for example, but really to get a deeper and liquid market is coming from very vocal authors. So I think the opportunity is there. It is just a matter to take this opportunity and play it out.
Monica, great to have you on the program. Thanks so much for joining us. Amundi's Monica Defend there talking to us about what to expect on jobs and how the fixed income market views the global economy. Coming up, the big, beautiful breakup, the Trump-Musk rift headlining all major news outlets this morning. Obviously, that's all anyone wants to know about waking up. That's next in your front page news. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York. Time now for our front page news. There's only one story dominating front pages this morning, and it's the very public feud between President Donald Trump and Tesla CEO Elon Musk. The New York Times reports Musk's friends and associates said they were in a state of disbelief over the abrupt break, despite knowing it wouldn't last. The friendship wouldn't last forever. The Washington Post wrote that Trump anticipated that Musk's criticism would become personal, saying he thinks Musk misses the place, and he suggested such hostility was common among officials who leave his administration. On the Wall Street Journal, Vice President J.D. Vance's post on X, writing, President Trump has done more than any person in my lifetime to earn the trust of the movement he leads. I'm proud to stand behind him. That from the vice president who once compared President Trump to Adolf Hitler. A check on the markets right now. S&P futures are higher, and we see the U.S. dollar also rising after a slight decline yesterday. U.S. 10-year yield at 437, 438. Coming up, we're going to get more on the world's richest man's feud with the world's most powerful man, President Donald Trump, and what that means for Musk's business next. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we
we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Cooling down. A public feud between Elon Musk and President Trump may de-escalate with a scheduled call today. Back in the green, stock futures climb as Tesla bounces back after closing down 14%. And all of that ahead of the latest jobs report after jobless claims rise to the highest level since October. Let's get a look at what's going on in markets this morning. We're looking at S&P futures bouncing higher, about 0.5% there. You can see S&P futures up to 59.72. NASDAQ futures also up 0.5%. Russell 2000, those small caps have been outperforming the S&P, NASDAQ, and the Dow Jones Industrial Average all week. Right now up another 0.6%. For some of the stocks that we're watching this morning, let's get right over to Valerie Teitel. She's in London with the latest. Valerie?
Good morning, Matt. Let's start with a check on Tesla. After the biggest market cap slide on record yesterday, that stock is recovering in the pre-market, up nearly 5%. The Politico report that White House aides have scheduled a call with Musk, also helping some sentiment to help this stock recover from yesterday's slide. Moving over to the retail sector, Lululemon having another disappointing quarter, a second disappointing quarter in a row. They also slashed their full-year profit outlook. The shares are declining 21% so far in pre-market trade. Lastly, let's go to the tech sector. Broadcom reporting earnings after the bell yesterday gave a weak outlook. This is the chip supplier to Alphabet and Apple. Those shares are declining 3.5% in pre-market trade. They have outperformed a lot since their previous earnings announcement. They're up 30% in that time frame, so giving back some of those gains so far this morning.
All right, Valerie, thanks very much. Valerie Teitel there running through some of the stocks we're watching this morning. Mainly, I think front and center, people are going to be looking up Tesla shares to see how they're reacting, because at the end of May, President Trump and Elon Musk stood side by side in the Oval Office, warmly celebrating the end of their political partnership, exchanging messages of love. We're not even a week into June, and the whole world witnessed a spectacular meltdown, a war of words, a back and forth of accusations that even involved Jeffrey Epstein. The world's most powerful politician took to his social media platform, and the world's richest man took to his subtweeting Donald Trump as he was making comments in the Oval Office. Trump sparked Musk's tirade when he spoke about him yesterday during his meeting with the Chancellor of Germany.
I've always liked Elon, and it's always very surprised. You saw the words he had for me, the words of, and he hasn't said anything about me that's bad. I'd rather have him criticize me than the bill, because the bill is incredible. It's the biggest cut in the history of our country. We've never cut. It's about 1.6 trillion in cuts.
Well, he got what he wanted. Elon did criticize him then instead of the bill. Then a user on X who had like 114 followers urged Elon Musk to cool the feud, and Musk actually answered, signaling that he will calm down the tensions with Trump, saying, you know what? good advice when he responded, "We won't decommission Dragon," talking about a SpaceX project that he does for the United States government. For more, I'm joined by Bloomberg White House reporter Akayla Gardner in Washington and transport and aerospace reporter Danny Lee. And Akayla, let me first, before we get to the whole SpaceX thing, just ask you how this elevated so quickly. What do we know about this, how this Trump-Musk feud developed?
Well, as you just heard in that clip, President Trump said Elon Musk had not made any personal attacks against him up until that point, and that was true. Except while he was speaking, Elon Musk was clearly watching because he fired off a series of posts on X, which is, of course, the social media platform that he owns, criticizing the president and specifically his claim that Elon broke from the administration because of provision in that one big, beautiful bill that scaled back tax credits for electric vehicle mandates. Elon Musk strongly denied that and then went on to endorse a tweet that said that President Trump should be impeached, that Vice President Vance should take over. Then you had President Trump saying that he was going to cancel all of Elon Musk's contracts. And then, of course, after that, Elon Musk said that he would decommission Dragonfly. But really late last night, it seems that tensions seem to have cooled. President Donald Trump gave a brief phone interview to Politico where he was very nonchalant about the breakup, saying that it was okay and talking about his favorability numbers. But you have this real tension with Republicans because Elon Musk was the single biggest backer for President Trump's campaign, and yet President Trump still remains the most animating figure in this party, and Republicans still very much want to be aligned with him.
So what do we know about the détente then, Akayla? I mean, I've heard they're going to have a phone call today that the White House is scheduled. You can understand why Musk would be eager to fix things after losing $34 billion in one day yesterday. He's lost over $100 billion since President Trump came into office. But I guess Donald Trump is eager to fix things too, since Elon Musk's money has helped him and his fellow Republicans come to power.
I mean, if there's anything that we've learned from the White House's feud with universities is do not take their threats lightly. And I think this has a huge part to deal with the fact that Musk has millions of dollars in contracts with the government, with the Defense Department. And I'm sure he's taking that threat for those contracts to be potentially pulled very seriously at this point. And as you mentioned, he's already lost billions of dollars in wealth, and I'm sure he doesn't want to see that number go down anymore.
All right, Akayla, thanks very much. Akayla Gardner there covers politics for us here. I want to get over quickly to Danny because, as Akayla mentioned there, Donald Trump threatened to cut funding, essentially threatened to cut funding for a lot of Elon Musk's projects. He's made billions of dollars in defense and aerospace from the United States government. And then Musk, for a moment, threatened to decommission Dragon, which I guess is what, the only way we have to get people and stuff back and forth from the ISS and even to bring that ISS safely out of orbit when it's decommissioned, right?
Yeah, I think both sides are looking for some kind of play here, some kind of leverage, because both sides have really risen up together since Donald Trump's come back into power, and Elon Musk has really benefited from that. And so the threats to Tesla and to SpaceX around the government contracts, and also just the dispute around potential subsidies around electric vehicles that could really put Tesla under pressure, right? $7,500 worth of tax credits that benefits the likes of Tesla, and that could threaten eventually $1.2 billion worth of Tesla's profits. And if you widen that out, up to half of Tesla's potential profits this year are at threat because of the various cuts that could be made to electric vehicle subsidies that it has benefited from. So clearly the anger and the frustration is there from someone like Elon Musk, but then also the Wall Street is very much taking notice, given that 14% drop in its share price yesterday. Clearly has recovered a little bit because of the news of the talk. So, very much, the business of politics and the politics of business very much coming up to the fore here. And yes, we are seeing the calm after the storm.
And in terms of SpaceX, I mean, how difficult, Danny, would it be for the United States to untangle itself from Elon Musk's rocket company?
It would be very difficult at this point because of how much success SpaceX has had and how much it's relying on the government is relying on SpaceX, but it does have an option in the likes of Boeing and the Starliner. Clearly, that has had issues in the past, and given its troubles and Boeing's kind of reticence to continue with space in some shape or form, it would be quite challenging. And given the importance of space in terms of the politics of space, I think this is something that the government would want to try and settle sooner rather than later.
All right, Danny, thanks very much. Danny Lee covering aerospace and defense for us. Kayla Gardner covering politics. Let's get to the other top stories trending on the terminal. This morning, Harvard University won a temporary reprieve from President Trump's ban on its international students entering the U.S. A U.S. district judge granted a temporary restraining order saying Harvard would face immediate and irreparable injury if the proclamation went into effect. She set a hearing for June 16th. And Circle had one of the splashiest debuts in years, with shares surging 168% in its first day of trading. Shares of the stablecoin issuer more than tripling from the IPO price of $31 apiece. Circle's market value is now $18.5 billion, with a fully diluted valuation of about $22.1 billion. HSBC Chairman Mark Tucker will leave the bank in September to take on a non-executive chairman role at AIA. Sources say the insurer has been holding informal discussions with Tucker on a role for at least a year, and he will move over there to take the job on the 1st of October. Coming up, we count down to the jobs report with Citi's Veronica Clark next. Does she expect us to get an inline release of 126,000? That's the current consensus. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah,
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is Bloomberg Brief. I'm Matt Miller in New York. It's just under 3 hours until the jobs report comes out, the granddaddy of all economic statistics. Joining us now to break down what to expect is Bloomberg's international economics and policy correspondent, Michael McKee. Mike, normally this would be the biggest news of the day.
Yeah, well, we're going to have some kind of weird number to displace Trump and Musk from the top of the news agenda these days. It's always possible. And certainly the markets are expecting a kind of weak report in comparison to what we've had. As you mentioned earlier, 126,000, which is definitely down from what we've seen. It's not, the Fed wouldn't think it would be bad, but it's not what we have been watching. 4.2% for the unemployment rate and average hourly earnings actually slowing down a little bit on a year-over-year basis, even though they're up on a month-over-month basis because it's kind of a base effects kind of thing. And I'm sure you've pointed out the whisper number is only 110,000. So Wall Street leaning negative here. We're going to watch the unemployment rate because that's what the Fed is watching. It's their sign of whether or not the economy is slowing down. And labor force size, it may be too early, but with all of the people who are no longer coming across the border, the labor force shouldn't be growing very much. And if that's the case, that will help hold unemployment down some. And then this hasn't gotten a lot of publicity because it really doesn't matter all that much, but there are huge revisions coming to the household survey today in all kinds of areas except for the unemployment rate. When they updated numbers, they made a mistake in the Excel spreadsheets, and it has changed a lot of the numbers, but only by 1,000 or 2 in all kinds of areas of the report. So economists can have fun parsing through that, but the BLS says it does not change the unemployment rate.
All right, Mike, we're going to be watching for sure, and I will encourage viewers who have Bloomberg Terminal, if you type WHIS GO, you can enter your guess at the number, at the headline number, and I think you get some sort of prize if you're correct. We have breaking news on the Bank of Japan, by the way, which is you've got to do some mental gymnastics to get your head around this. The BOJ is said to consider smaller reductions to its bond buying program. So I guess they had considered larger reductions previously, and now they will reduce the amount of bonds they buy at a lower amount. This, according to people familiar with the matter. We'll see if that has any effect on JGBs. Right now, not a lot of movement in that market. Let's talk more about the non-farm payrolls number. Joining us here on set is Veronica Clark, U.S. economist over at Citi. And Veronica, great to have you on the program. What's your expectation, first of all? I mean, as Mike mentioned, the whisper number is 110, but the consensus is 126.
Yeah, I think we will probably see some slowing in job growth. We've had a couple months where we've seen very resilient labor market data again, but we're at around 120, so that's right around consensus. That is slowing, but that's still a healthy monthly pace. But I think the more important part, and Mike said this also, of this report is that unemployment rate. So it's not that headline payrolls number, but the unemployment rate. It's been very steady in this 4 to 4.2% range for about a year. I think this could be the report where we see that breaking higher. We're expecting 4.3%.
4.3% is, I mean, that's going in the wrong direction, obviously, and I guess, could it be worse? I mean, that will take people's attention off Musk, Trump.
Yeah, I think it's, it's a very measured pace of increase still. It's not, something that's necessarily going to alert the Fed to weakness. But
we've seen bad numbers out of ADP this week. We've seen bad numbers out of the weekly jobless numbers. So this would just add to that sort of slowdown in labor.
Yeah, it's very gradual so far, but the risk is that at some point it's not so gradual, and that would be the highest rate that we've seen this cycle so far. And I would even say that there's upside risk to that increase in the unemployment rate, basing that particularly on what we've seen in that weekly claims data, where initial claims, they've come up some, but they're still low. But where we've seen the clear trend higher is in continuing claims, which is essentially if you do lose your job, go on unemployment benefits, it's taking you longer to leave those unemployment benefits. It's taking you longer to find a job. I think that's telling us that there's been this additional leg lower in hiring.
So, by the way, Mike also mentioned we could see a drop in hourly wages. And inflation seems to be dealt with, right? PCE was 2.1%. So if the labor numbers are going the wrong direction and inflation is cool, doesn't the Fed need to come in and cut?
Yeah, I mean, it's obviously about balancing the risks around all of that, and we have had some more favorable inflation data recently. There's always a start of year volatility, and we saw that January, February, March, and April. The issue for inflation is that we haven't really seen the effect of tariffs yet. We're expecting to maybe start to see that in May, but really more late summer, early fall. And the Fed knows that that's coming, so they're going to be cautious for now. I don't think this is a jobs report that will get them too concerned, but the direction of travel is not great. And I do think that slowing wage growth, the loosening labor market, it does present just a very different labor market demand backdrop than the inflation of the pandemic, where we had very strong wage growth then. We had home prices rising, labor markets were very tight. We had a supply shock that led to persistent inflation. This time I think we'll have the supply shock of tariffs, but we don't have that demand backdrop. We won't have that persistent inflation.
What do you expect to be the effect of tariffs? Because, on April 2nd, people were freaking out about it, and now it just doesn't feel quite as bad. I cover the car industry very closely, for example, and right now, pre-tariff inventory is starting to run out, so you're going to see cars on the lot that have been imported post-tariffs, but the price increases we've heard about, Hyundai, for example, 1%, not a lot.
Yeah. I think the tariff backdrop, April 2nd got terrible news, and it's been walked back to still some pretty bad news on tariffs. The issue is just it's a bit too soon to see it in a lot of the hard data. Obviously, we've seen very volatile import data. We've seen that in trade, got that earlier this week. And at some point, I do think, tariffs themselves will weigh on, ability to import, ability to spend. We will see higher consumer prices, but it's, we're not seeing it yet is the issue. We are seeing maybe before we see that direct effect of tariffs, maybe we'll see the effect of uncertainty, and I think that could be that low hiring dynamic.
We have business owners and investors who are pragmatic and maybe right-leaning come on this program or my show all the time and say, 10% isn't so bad. That's something we can deal with. And that seems to be the baseline assumption. But then I know, 10% is the level that Europe put on U.S. imports that basically locked U.S. car makers out of that market. So how bad would a 10% baseline be?
Right. We really have no good historical comparison to know, unfortunately. We were going into this year, obviously we had tariffs from Trump's first term, so we were going into this year with an effective tariff rate around 2 to 3%. And increasing that by 10% is a lot. We haven't had tariffs this high in many years, so we don't know how the modern economy will react to that. And I do worry that maybe 10% is a bit of a floor for an increase that we'll see this year. Obviously, a lot of uncertainty with court decisions and whatnot, but we do still expect there to be sector-level tariffs that have yet to been announced. We might be looking at something higher than 10%, and that is every incremental percentage point will matter, I think.
I got to ask about the bill. How much do you expect it to increase the deficit? Because the CBO was out yesterday saying, actually, we're going to get $2.8 trillion from tariff revenue.
Right.
So
exactly. So the bill itself, when you're scoring it, it's not going to include the tariff revenue. So, it is wider deficits in the bill, extending those tax cuts, some new tax cuts, obviously some spending cuts in that too. But when you consider what we're expecting to raise in terms of tariff revenue, it can kind of offset that. But the issue is we are already looking at very wide deficits, 6% of GDP, whereas in a normal peacetime, we would be looking at maybe 3%. And if those two things are offsetting, well, then we just stay at 6% of GDP, which is still a really wide deficit.
Veronica, great having you in here. We could go on, obviously, for a long time on this, but we've got to get you to work. Veronica Clark there from Citi. She's their U.S. economist. Coming up, we're going to get you set up for your trading day in What to Watch. Next, this is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York City. Let's get a look at what's ahead through the weekend. The main event obviously comes at 8:30 a.m. New York time, and that is the May payrolls report that we've been talking about. Then one Fed Speak event scheduled before the blackout period. Governor Michelle Bowman, Mickey Bowman, who bank regulators are watching very closely, will be speaking at 10 a.m. this morning. And we're going to hear from ECB President Christine Lagarde on Saturday. So if you follow that market, she got pretty hawkish yesterday and signaled that the end may be near for a rate cuts. In terms of movers, Tesla obviously front and center this morning, leading the Mag 7 stocks higher after closing down 14% on Elon Musk's public feud with President Trump. Also, Broadcom is down, extending its post-earnings decline. It gave a tepid forecast, missing the loftiest expectations. Lululemon down after earnings showed growth is slowing, and it trimmed its profit forecast, and it is down big, off by more than a fifth. In terms of the big macro numbers that you want to be watching around the non-farm payrolls report, the dollar is an interesting one. You can see, well, actually, I don't have the dollar here. The 2-year yield at 391, but the dollar is bouncing back up a little bit after a drop yesterday. The 10-year at 438, crude at $63 a barrel, and gold up near a record high at 33.56. That's it for the Bloomberg Brief. Surveillance is up next. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
The labor market's in a bit of a holding pattern.
Demand for labor has actually slowed quite significantly.
The estimates are rather tight. There's a very tight range of estimates.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
It's the labor market that matters most.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. This is Bloomberg Surveillance. Welcome back. It's Payrolls Friday, but first, a not-so-beautiful breakup.
I've helped Elon a lot. Elon and I had a great relationship. I don't know if we're well anymore. I was surprised because you were here. Everybody in this room practically was here as we had a wonderful send-off. He said wonderful things about me.
Cheers, turning positive on signs the feud between Elon Musk and President Trump does appear to be easing. The psychology of the White House once again dominating Wall Street discussions with China-U.S. trade talks in focus, sort of, after a Xi Trump phone call for about 5 minutes. But at least in one moment, all eyes will be on the U.S. payrolls report due at 8:30 a.m. We would be talking about Payrolls Friday. We might have been talking about what happened between Xi Jinping and President Trump. We might have been talking about the bill or even the fact that President Trump had been talking to Vladimir Putin of Russia. But we are not. We are talking about a spat between 2 one-time besties.
Absolutely. Spectacular display of events yesterday. This friendship unraveling, imploding between the president and the richest man in the world, his once first buddy, the individual that was supposed to cut all this government spending. It started about the big, beautiful bill. And it even then became very personal, going into things like Elon Musk insinuating that the reason why the Epstein files aren't released is because the president is in them. And then the president coming out and saying, you want to see government spending cut? Maybe I'll pull back on your contracts. It was on and on for hours. Today, there's a little bit of a détente. We have political reporting that the White House is going to be scheduling a call, I just think with aides and Elon Musk, but potentially that's why we see Tesla shares actually getting a little bit of reprieve this morning.
And we'll get into the amount of money that's being involved in some of these, the fact that you saw $150 billion of market cap wiped off Tesla in one day, whipsawing the entire broader U.S. index. But there's a broader point here. And I think it's really important on Payrolls Friday to consider the fact that investors have no idea where they should look. And this is important, this idea of, is it the real economy? Is it the question of the future of trade? Or is it personal scuffles between the president and specific leaders of major companies? It raises a specter of uncertainty anew that really has not been in the equation before this era.
Luke Kawa yesterday took to Twitter when all this was going down and saying this is feeling EM-y, like an emerging market economy when you see the president of the United States having this open feud with the CEO of Tesla. What I would say is that in Washington, D.C., no one is exactly surprised about this blow-up. People have just been taking wagers behind the scenes on when this would happen, when these two individuals might explode and be head-to-head with each other. I think going forward, though, it does show what kind of basically vulnerability you could be in a CEO if you take the opposite end of this administration, whether it comes to policy or legislation in Congress.
This won't be the Elon Musk versus Donald Trump hour or 3 hours. This is going to be a discussion about Xi Jinping as well and what's going on with China. And of course, payrolls, which do arrive in about 2.5 hours. The estimate in the Bloomberg Economic Survey is 126,000. The range is across the board from 190 down to 76. Coming up this hour, as we look at futures that are trying to figure out, can they claw back some gains after what we saw yesterday? Julian Emanuel of Evercore on the latest market swings. Ed Mills of Raymond James as the U.S. and China agree to more trade talks. And Dan Ives of Wedbush eating popcorn in his bright suit on the fallout from President Trump and Elon Musk's breakup. We begin this hour with stocks climbing again as investors await payrolls due out later this morning. Julian Emanuel of Evercore writing, with this degree of uncertainty, we think the S&P 500 is ripe for, at a minimum, a stalling out of the rally within a bull market that will make new all-time highs in due time, but likely not until 2026. Julian joins us now. Julian, welcome.
Good morning.
So you're head on straight after the past 24 hours.
All you can do is chuckle, really.
Well, is that true? I mean, honestly, this is actually a really big question mark. Is it just eat popcorn and watch something that, as Anne-Marie said, was inevitable and wait for it to blow over before you continue? Or is this a new type of risk that any high-profile CEO is increasingly in the hot seat if they say something that seems at odds with the current presidential policy?
Well, the risk from a corporate perspective is there. We know that social media is very powerful, and there are consequences in things that one says or does not say. But the bigger question is, as an investor, how do you deal with this? And what we're saying is, what you really have to do is sort of barbell your horizons. Because if you look at yesterday, okay, when the tweets started, obviously first Tesla started falling, and then it infected the rest of the market, particularly a lot of the larger cap stocks. And then, of course, this morning we've bounced back. Great. In a bull market, there's lots of trading opportunities. But what you also have to do is, if you're thinking long term, you really have to think long term. Just set the noise aside, but increasingly more difficult to do.
War yesterday, potentially peace between these two today. Do you just buy the dip yesterday when you see Tesla shares down, I believe, at 1.18%?
Well, again, the market has been in mode now for the last several weeks where all the dips are getting bought. Our view here, again, is that when you see the degree of the reaction on a day like yesterday, it's telling you that it's becoming increasingly more of a challenge and that we're getting to the point, and frankly, we're going to see, perhaps in the payrolls report this morning and then next week's inflation data, news that may not be quite as favorable as it's been. So we think there's likely a transition coming here where the market is going to need good news to continue moving higher, and it may be mixed.
Is there a jobs number today that gets people off of staring at their screens, waiting for the next tweet or truth to drop between this feud between the president and Elon Musk?
I would bracket it sort of below 100,000, which will be a bad news is bad news response. Because if we look at the last couple of days, it hasn't been clear that lower yields are a positive for the market. And we think, again, under 100,000 will bring home the fact that, yes, all this economic uncertainty is starting to have consequences, even if they are minor and even if they are slow in developing. Conversely, over 150 would be a major, surprise and argue for a test of 6,000 on the index.
To build on what AMH is talking about, this idea of looking long term, how do you do that when there is such a huge question mark around the trajectory of the U.S. economy and, frankly, where we are globally? There has been discussions about whether we are heading to a lower inflation kind of period of time versus the pandemic, but that is pocked by also, just tepid growth, this idea of, yes, we have inflation, but also lower growth profile. Are we looking at possibly gangbusters growth, as the administration is talking about? How do you even gauge that at a time where the data is messy and it's very hard to get people to look more than just the next couple of hours ahead of them?
So all of that involves sort of scenario modeling, but let's set that aside. as a long-term investor, you really want to stay overweight the names and themes that have secular earnings growth power. And, we've been on enough in these last 2 years, and you'll hear it again, AI-centric names and themes. If you think about it, right, and this is sort of the proof in the pudding that what we saw from the February peak to the April trough was a cyclical bear market within the aspect of a structural bull market, is that the same names that were leading into the peak also got hurt the biggest and frankly have been leading. And look, unspoken, undiscussed was the fact that in all of yesterday's noise, the biggest software company in the world made a new all-time high yesterday.
Well, and this actually does speak to the question of NVIDIA and its relationship globally versus the relationship in the United States. And I know you're talking also about Broadcom and some other companies that have come out, but it raises this question about the connection between the U.S. and China. It raises the question about whether these tech companies can be global tech companies or whether they can be domestic tech companies at a time when there's a lack of clarity around what the ultimate destination between the U.S. and China actually is. How much is that relevant? How much should that have been the main story today? All things being equal, given the fact that Xi Jinping and Donald Trump did have an hour-and-a-half phone call and hashed through a whole host of things and have planned a visit for Donald Trump in Beijing.
I don't know, but when you think about the totality of all that, if you're mayors, you're probably happy that all this stuff happened around him.
Absolutely.
Because his meeting was quite uneventful. But in reality, again, it's the sum of the complication of the picture, but with the backdrop that we know two things, right? We know that the demographics globally are slowing. We know that that is going to cause, upward pressure long-term on wages, X of, the ups and downs of sort of a near to medium-term economic cycle. And that means that the AI race is on. And think about it, right? You had the DeepSeek moment, the stock sold off, but none of the companies pulled back their CapEx spending plans. And then lo and behold, the president goes to the Middle East and becomes, the single greatest salesman for the AI revolution that we've seen. So it really points to the fact that this is an inexorable long-term trend.
Is it a long-term trend, even if China is not part of the equation?
Yeah, it absolutely has to be. It goes back to the demographics, and if you think about it, is what we're seeing this year in particular is that it's starting to apply. We were worried that there weren't going to be adoption and applications across industry, and you think of an industry like healthcare, where the cost structure is still incredibly inefficient in the U.S. We're starting to use AI to rationalize that business. And when you think about the challenges inherent in balancing the budget or getting the big, beautiful bill done, you think about a place like that where it's going to be really necessary to figure out how to get costs under control.
Julian Emanuel, you get to sit with us this entire hour and try to make sense of all of these different headlines, and we are wonderfully grateful to you for that. Julian Emanuel of Evercore sticking with us for the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. We start with the big story of the day. Elon Musk signaling he's ready for a cooling off period with President Trump after their public feud yesterday. Tesla shares plunged yesterday as Musk called for Trump's impeachment and threatened to decommission the SpaceX Dragon program. That after Trump said he would cancel Musk's federal contracts over criticism of his tax bill. Musk posted this morning he's ready to take a step back and won't decommission Dragon. Meanwhile, Trump getting along better with Chinese President Xi Jinping. After a 90-minute phone call yesterday, the two agreed to additional trade talks. Trump acknowledged their relationship had gone off track, but says it's now in good shape with trade talks set to happen shortly. And a check on shares of Lululemon. They are down nearly 21% in the pre-market. The company posted a second straight quarter of disappointing results with projected sales and profit below estimates. Lulu blaming rising competition and tariffs and said it does plan to raise prices on some items to offset the impact of new levies. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We'll be talking more about Lululemon in just a little bit. A question about execution versus macroeconomics. Up next, back on track with China.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things.
Ed Mills of Raymond James joining next. This is Bloomberg Surveillance. Is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. Futures snapping back, looking for a weekly gain after yesterday's turmoil that stemmed from a feud between Donald Trump and Elon Musk. Today, a bit of a reprieve from that, up 0.4% on the S&P and NASDAQ. Russell 2000 doing better than that, up 0.5%, as people look to potentially something of a détente between the U.S. and China. Under surveillance this morning, back on track with China.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things. He invited me to China, and I invited him here. We've both accepted. So I'll be going there with the First Lady at a certain point, and he'll be coming here, hopefully, with the First Lady of China.
Here's the latest. President Trump and Chinese leader Xi agreeing to more trade talks during a phone call yesterday. Trump saying Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and Trade Representative Jamieson Greer will handle the negotiations shortly. Bloomberg's Tyler Kendall joins us now. Tyler, just can you tell us what led up to this phone call and what was accomplished in it in terms of both arranging another meeting as well as ratcheting down tensions in specific areas?
Yeah, hey, Lisa, good morning. Well, China says that this call was met on the invitation of President Trump. So he had wanted to have this phone call with Xi Jinping for a while. That tracks with the long-held position from this White House that they really felt that these tensions could be eased down if the leaders had direct contact, which doesn't necessarily go with our reporting when it comes to China's point of view, which is that they would have much preferred to have key advisors really iron out those details before putting Xi Jinping on the phone. And there were a lot of details to iron out. President Trump said that this phone call really centered on trade and suggested suggested that they addressed one of the key sticking points for the U.S. when it comes to rare earth minerals. As you well know, the U.S. has been accusing Beijing in recent weeks of slow walking those critical and rare earth exports to the U.S. that are so essential to supply chains here. But in a statement after that call, China says that they have not violated any part of that agreement reached in Geneva when it comes to this. So it really does remain to be seen if we're going to see a speeding up of these export licenses, since it's not totally clear on exactly what the leaders did agree to, nor what President Trump offered, though, in the Oval Office. He did say that Chinese students would be welcomed in the U.S. amid heightened concerns from Beijing about the State Department's plans ultimately to revoke certain Chinese student visas. Lisa, as you well know, there's still a lot of issues that need to be addressed. And there was a pretty interesting split screen here in Washington yesterday as Commerce Secretary Howard Lutnick testified on Capitol Hill that he actually wants to see a tightening and more enforcement when it comes to some of those export controls that China has been concerned about.
Tyler Kendall, thank you so much. A split screen and triplets or maybe quadruplets, because it seems like the focus was all over the place. When does this guy sleep?
Well, exactly. The point is, this was really an incredible week in terms of meetings the president had. He had a meeting with the president of Russia, who's in the middle of a hot war for his invasion of Ukraine. This is the first time he has gotten on the phone as president with Xi Jinping, basically, since inauguration for an actual discussion on trade. You had the Chancellor of Germany, the biggest economy in Europe, in the Oval Office, and all of this completely overshadowed by this blow-up between him and Elon Musk.
Joining us now is Ed Mills of Raymond James. Ed, I do want to start on the China and U.S. trade negotiation, just simply because maybe it has a bit longer legs. Maybe. We don't really know. I just am curious about your takeaways yesterday from what we know about that phone call and what we don't know.
Yeah, Lisa, I think it's so fascinating to see this focus on the rare earth minerals. The day after some of these restrictions came in from China, I got a phone call here at Raymond James and said, do you realize that we have about 6 months supply of this? And at the end of that, we can't make a missile. We can't build a car. We can't build an airplane. Our industrial capacity is permanently impaired if we do not have access to these rare earth and critical minerals. So China and Trump 2.0 know exactly where those choke points are, and they're using them, Lisa. And so because of that, I am optimistic that we ultimately get a deal, because we cannot sustain this. And I do think that longer term, we are going to see a lot more production here in the United States, and a lot of these trade deals look to get those rare earth and critical minerals from other sources from China. We had a Defense Production Act signing last week from Trump, where it says you can bypass a lot of the normal routes to make sure we can get that. And so focusing on that and realizing that that's important is where we get the deal. The final piece here is Lutnick getting added to the list of folks that will be in the next trade delegation. Lutnick's Commerce Department has been putting a lot of restrictions on semiconductors and other exports into China that China also really needs. So working on that, but I'm not quite sure that the Commerce Department, Lutnick, and the Trump administration is going to ease up on our restrictions. So China is going to be very tough on theirs.
Can we just stick for a second with the rare earths? Why do you think that actually there's going to be a loosening of these restrictions and the ability for the U.S. to get licenses, given the fact that the easing of the controls was not in the Chinese readout?
So I think because we need them, because there's not really another alternative. I do think that the United States is probably going to have to ease up on some of the things that we are doing. First and foremost, it was easing up on that 145% tariff rate. I think that China is going to be able to ask for more in some of these negotiations than I think that Trump expects. I do think that there's ultimately other sources of this globally. Rare earths are not actually all that rare. What is rare is where we are willing to extract them, where we're willing to refine them. But that is going to take years, Anne-Marie. So I do think that they are willing to provide that, as long as the United States is willing to provide other things to China, such as some of the technology that we're restricting. But politically, that's a really tough thing.
With Commerce Secretary Howard Lutnick's inclusion now in the trade negotiations, and we're waiting for a time and place, do you think it's going to ease Beijing's ability to get a handle on these semiconductors, or actually potentially make it harder, because he's quite hawkish?
Yeah, if I had to choose something, it's harder. What we are seeing is we've had a lot of conversations about IEEPA, this International Emergency Economic Powers Act, which has been used to put the tariffs globally, challenged by the courts. But look for IEEPA to be used next to further restrict a lot of technology that is going into China. Since that meeting in Geneva, there has been a worldwide ban on Huawei Ascend chips from being used from our allies. If they use that, that's a violation of U.S. export controls. We are going to see an uptick in other semi-cap equipment, EDA software, things that are important and critical on making semiconductors in China. All of those things have bipartisan support, and if you look to the Hill, they want the administration to go even further. Geolocation on any chip that goes into China to make sure that chips that shouldn't be going there do not go there, Anne-Marie.
Ed Mills of Raymond James, thank you so much for being with us this morning as we try to figure out which story has staying power for the next couple of hours. Interestingly, Michael Hartnett talking about how all of these things, the Bank of America, talking about how all of these potential restrictions are not being factored in right now to global markets, saying that global stocks are close to triggering a sell signal with fund inflows and market breadth both running too hot. Julian Emanuel of Evercore ISI is here. And I'm curious, you seem to agree, seeing that maybe it is a time for there to be some sort of breather.
So if you look at it, the Bloomberg Trade Uncertainty Index and the S&P 500 have literally been moving in inverse lockstep, going back to February, actually. And clearly the rally in the stock market off the April low was contingent on some of the lessening of this tension. But at 23 times earnings, we are still extremely expensive in terms of valuation. And, you know, when you listen to that last discussion with Ed Mills, one cannot help but think that this is going to take a longer time to play out. You're not going to have headline gratification from subsequent China-U.S. meetings like you did in Geneva.
Just to put a bow on that, does that mean that big tech is the most susceptible to potential ratcheting up of tensions once again between the U.S. and China?
Well, look, and again, to our thesis, you always have to deal with more volatility in big tech, period. That comes with the territory of higher multiple secular grower stocks, which have been embraced over the course of time. But obviously, you know, it is ground zero for where the political conflicts are going to lie.
Yeah, and we don't really understand exactly what the ultimate goal is, Anne-Marie, of what the U.S.-China relationship looks like, especially when it comes to tech.
But we do know what the choke points are. China wants access to these advanced semiconductors that the United States has export controls on, and the U.S. needs these magnets and rare earths. And I think Ed Mills really displayed that, obviously. The issue is the timing of this. Phase 1 trade deal started 2018 and ended in 2020. This isn't going to be done in just a few months.
Well, up next, this might be done in just a few hours. President Trump and Elon Musk's bad breakup. Tesla bull Dan Ives joining us next. He's got quite a bit to say. This is Bloomberg Surveillance.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Futures positive this morning after the turmoil yesterday that sent both stocks up in response to cooling tensions between the U.S. and China, and then down between heating up tensions between Donald Trump and Elon Musk. Right now, we are up. NASDAQ futures up about 0.5%. Russell 2000 up 0.6%. 3 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Tesla bouncing back up nearly 5% as signs emerge of a possible thawing in Elon Musk's strained relationship with President Trump, which, as we know, was on full display yesterday. But in a series of posts on X, Musk seems open to de-escalating. We also have that political reporting that White House aides have scheduled a call with Musk. I look forward to what your next guest, Mr. Ives, has to say about all of this. Meanwhile, we have shares of Broadcom. Those are falling 3% after the chip giant gave a revenue forecast that failed to live up to the hype. That's because it came in just a touch higher than estimates, but expectations were sky high heading into the report, with the stock up nearly 80% since an April low. But it's not AI-related demand that is the problem. That jumped 46%. CEO Hock Tan says the problem is demand outside of AI is still sluggish. And we end with Lululemon, those shares still cratering more than 20% after it issued another weak outlook, another weak quarter and a gloomy outlook because it says tariffs will hit profitability. And if you thought your Lululemon leggings couldn't get any pricier, well, they're planning price hikes in order to offset those costs. But that, of course, could backfire as U.S. shoppers continue to pull back at their stores. Lisa?
Thank you so much, Yahira. And Marie, do you think that you'd spend $200 on a pair of leggings?
If I really loved them, but I think there's been more exciting brands than Lululemon. I think that then they're going to blame it on tariffs.
That might be part of the issue. We'll get into that in just a second. On our radar this morning, Elon Musk signaling he's willing to cool tensions with President Trump after their very public feud. This after Tesla shares fell 14% and Musk suffered a $34 billion loss to his personal net worth. You couldn't take your eyes away. A real question of who has more to lose in this fallout.
Well, I think yesterday you saw Elon Musk had a lot more to lose in terms of Tesla shares down at 1.18%. He lost millions of dollars when it comes to his personal wealth. At the same time, the President of the United States, and I think members of Congress know how influential he is, you know, the helm of Twitter and X, and also the fact that this is someone in the future, if you're looking at midterm elections, if you're looking at 2028, someone in the future that could actually be a source of political campaign donations. So I think it depends who you are in Washington, D.C. I think we'll have to see how far the feud goes and whether or not this phone call the White House aides have set up will actually work.
Julianne, before we were talking about the premium in being close to President Trump. Is it now a liability or an advantage to have that kind of close relationship with President Trump at a time where it could bestow you with quite a few favors, but also could sour and turn the opposite direction?
I think it's a case-by-case basis, and it really depends on how big the other person's megaphone is and how they wish to use it. And you know, when you look at it, the problem here, among the number of problems is that, you know, you're basically coming out, and the big, beautiful bill is the nexus of the controversy, and that's the thing that has to get through, because as much as we are averse to having the deficit expand, the alternative, a debt default, is, you know, failure is not an option territory.
Julian is trying to focus on the things outside of this drama, which a lot of people market are President Trump and Chinese President Xi agreeing to more talks on tariffs and rare earths, among those things that are happening elsewhere. Trump saying the negotiations would occur shortly at a location to be determined. More questions than answers, perhaps. But Anne-Marie, markets took a positive signal from this discussion.
Well, it was the first known phone call we've seen the contact since Trump took office, and Trump has been teasing out this fact that he wants to get on the phone with Xi Jinping, and he finally was able to do it. The two choke points that Ed Mills talked about are really seen here. The rare earths the United States needs, but also this idea that Secretary Howard Lutnick is now going to be part of the fold, coming into these conversations. What does this mean for China's ability to access semiconductors? Are we going to see a ratcheting up of export controls or an easing of export controls? And if anyone thinks this is going to be done in just the next meeting, which we don't know the time and place yet, I think, you know, hold on to your hat, because when Trump won, phase one, which was a purchase agreement, just a purchase agreement, took years.
This is one reason why people are looking at the big, beautiful bill down in Washington, D.C. instead, because that maybe is something more tangible and that has a deadline. The SALT cap, one of the focuses of this particular bill, and it is under threat. Sources telling us here at Bloomberg that President Trump is open to scaling back the SALT cap, a major threat to his one big, beautiful tax bill.
I am crossing the Grand Canyon on a piece of dental floss, okay? The equilibrium that we reached here took quite a bit of time to get to where we are, and you can't load me up on either side. And if you go and slash the SALT cap that we negotiated carefully for over a year, it's going to make it very difficult for me to deliver the necessary number of votes.
Julian, just quickly, I'm curious how closely you're watching these negotiations and what particularly stands out to you that you want to see either remain in or get taken out of this one big, beautiful bill.
Well, first of all, the imagery of crossing the Grand Canyon on a piece of dental floss, it just tells you how difficult this is. And it's not just, you know, Speaker Johnson is worried about the interplay between the House and the Senate, which is something we really only have to worry about very infrequently. And it just points again to the difficulty of getting this, and the fact that, and Trump himself, as I probably quote in The Art of the Deal, is that the best deals are when nobody is fully happy, and we have to accept that we have to get to a place where nobody's going to be fully happy.
Well, talking about nobody being fully happy, Elon Musk signaling he's open to cooling tensions with President Trump after the disagreements boiled over into an all-out public feud.
I'm very disappointed in Elon. I've helped Elon a lot. Elon and I had a great relationship. I don't know if we're well anymore. People leave my administration and they love us. And then at some point they miss it so badly, and some of them actually become hostile. I don't know what it is. It's sort of Trump derangement syndrome, I guess they call it.
The back and forth sending Tesla shares plunging, its market cap seeing its biggest one-day drop on record. Dan Ives of Wedbush writing, this view does not change our bullish view of Tesla and the autonomous view, but clearly does put a fly in the ointment of the Trump regulatory framework going forward. Dan joins us now. Dan, great to see you.
Great to be here.
Very curious to hear what you have to say about this. The fact that you do not change your bullish outlook on Tesla, even though it seems like there is a massive key man risk. Please explain how you dismiss that.
Look, I mean, this is it's like a frenemies in junior high school that's essentially going on between Trump and Musk.
Poor billionaires and leaders of massive empires.
And look, the reality is that our view is that this is something where the friendship, it doesn't end. In other words, I still believe that this will be resolved potentially by the end of the day or by the weekend. And it's not our view that this changes the regulatory landscape for Musk when it comes to autonomous and the broader vision.
How do we even talk about the fundamental backdrop, though, when you have a war of words whipsawing this company by more than $150 billion of market capitalization? Does that introduce a risk that a lot of institutions just won't take?
Look, but we always talk, and we've talked about it on the show for decades. It comes down like with Tesla, that's the reality. I mean, you're going to have the volatility. It's part of what we've seen with Musk. But in our view is that you have to sort of see through the noise, understand the autonomous vision. It's our view, ultimately, Waymo's at the kids' table when it comes to autonomous and the AI future. And look, it's Rod Serling. It's an episode out of the Twilight Zone yesterday. I mean, in my opinion, in all my years covering Tesla, it might win the prize, top 3, maybe top 1, for one of the strangest days that I've ever seen.
So last year, Elon Musk said, take away the subsidies, it'll only help Tesla. Why does he, or based on reporting out of the Speaker Johnson, out of President Trump, why has there been this reversal from him regarding the EV subsidies?
He's no longer in the White House. I mean, and you've talked about it. It comes down to, like, he's now trying to distance himself for a few reasons. One, that would hurt Tesla, not as much as the others in terms of the Detroit Big Three. But then you also look at what's happening here. I believe there's some poker going on as well, is that he's trying to distance himself from Trump because of China, because he also needs to play nice in the sandbox in Beijing with everything that we see as given the China market, raw materials, how important that is from a demand perspective. He's trying to be sort of, I think, balances. And for Musk, even though some of it could come out sort of spur of the moment, I do believe potentially there's a longer game here.
Is he rebranding for a midterm election where most people think the Republicans are going to get an absolute shellacking?
Well, look, and the reality is that that's why in D.C., I mean, you know, if you're a hater or lover of Musk, he is going to be a huge player. And that's why for all parties, that's why White House, you know, it seems trying to put together this phone call, because no one's a winner, Trump or Musk, in this frenemies battle. I think it's two kids in the sandbox. I do think the play date will be back on at one point. It's just going through definitely some little tension here.
Wait, you're actually suggesting something that's pretty important, that there is an aspect of deliberateness to this by Elon Musk to revive the brand around Tesla, to try to paint it with a less MAGA type of brush after a lot of blowback and a lot of fall off in sales, particularly outside of the United States. Do you really think that actually this is a vocal way of his distancing himself and that he can get back in good with President Trump, but this is an effort to revive a brand that suffered a black eye, just like Elon Musk?
Look, I think there's some of that potentially at play, but you don't burn the house down just so you can meet the firefighters. I mean, the point is you need to navigate this situation very carefully. You need Trump as a friend, not a foe. And that's why Tesla down so much, is because the fear on the regulatory, it's going to be a green light for when it comes to autonomous, and especially Tesla. You know, I view as a huge advantage there. You can say Waymo a little as well. You don't need Trump now as an enemy. You need him as a friend. Hopefully by the end of the day, the candlelight dinner's back on. I just do not believe that these friends become enemies. It's a frenemies junior high school situation between two, as we know, very stubborn individuals.
Let's say in episode 6, they still haven't gotten back together. Do you change your view and become more bearish on Tesla?
Look, if this continues to play out longer and longer term, obviously that would be a huge negative. But my view, just like junior high school, they will get back together as friends, but it's going to take some intermediaries. That's why the White House, there's a lot in D.C. on the Republican Party and everywhere else.
Well, the distance is already there, and there's some things that happened yesterday that potentially the White House are really upset with and maybe are going to create a lot of tension for a long term, even if they start playing a little bit nicer. Is this an opportunity potentially for China to use BYD? Are we going to see BYD cars made in the United States?
Look, I think this is just a broader game of poker going on. And Musk and Trump are key players at that poker baccarat table, however you want to think about it. China definitely is watching this carefully, because also remember, Musk is, I'd say along with Cook, I mean, know the China market better. They also play nice in Beijing as well. So there is some balance going on here. But look, Musk, we want him to distance himself from Trump, still be a friend. It's been a very strange few weeks, few months, and obviously a lot, 24 hours. But I do believe by the end of the day and going into the weekend, I don't expect this to get worse. I do believe this will start to be cooler heads prevail. And that's why Tesla stock will be up there. I think Tesla is way oversold. Like, unless you think draconian, this goes into like a dark period, to me, I think we view this as an opportunity.
So, Dan, let's get back to the American consumer for a second. So what I hear you saying is you're assuming that Elon is not going to form a third political party, which I think we can all say we're relieved about. Has what's happened caused a measure of irreversible damage? And if not, how long is it going to take for the American consumer to disentangle him or herself from the politics of all of it?
And first, I'm disappointed in you. I thought we were matching today, but I'm not going to hold that.
Sartorial splendor, I can't even come close.
But it's fine. We'll pass it. Look, I don't view that as. I think it's something. There is brand damage, and there is things that Musk needs to turn around in terms of U.S. We said 5, 7, potentially 10% brand damage. The American consumer, look, I think there's confusion when it comes to Musk, because obviously alienated, many in the Democratic Party. Now you're actually alienating the Republican. So now it's like, if you want to alienate everyone, you've actually done a great job. Okay, so now it's the point, like, okay, how do we sort of build this back? Does the board get involved? Because again, it goes back to, like, the board needs, I think in a situation like this, they do need to play a hand in some way to make sure that this doesn't go off the rails.
If it's a junior high school situation, then there needs to be an adult in the room.
You need an adult in the room. You need an adult in the room at the prom.
Yeah, come on. Get home. It's your curfew. Dan Ives of Wedbush, thank you so much with your sartorial splendor, Julian. I love that phrase. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. The U.S. Treasury has called on the Bank of Japan to raise interest rates to strengthen the yen in its semi-annual currency report. That is likely to support market speculation for the BOJ to raise borrowing costs again later this year. The BOJ holds its next policy meeting on June 16th and 17th. Meanwhile, Nippon Steel and U.S. Steel are on track to finalize their $14.1 billion merger ahead of a June 18th deadline. Sources telling us here at Bloomberg that talks between the two companies and the U.S. government are ongoing as the companies and their investors await final terms. The deal will clear Japan's Nippon Steel to own U.S. Steel with measures of American control. And Harvard University won a temporary reprieve from President Trump's ban on its international students entering the U.S., marking a legal setback for the administration in its fight with the school. The judge granted a temporary restraining order saying Harvard would face immediate and irreparable injury if the administration's proclamation went into effect. The next hearing is on June 16th. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the labor market's uneasy equilibrium.
We also expect a deceleration in the pace of employment growth this year. We have this uneasy equilibrium in the labor market where firms are not hiring. Demand for labor has actually slowed quite significantly, but they're not firing either.
Sarah House of Wells Fargo joins us next because that's right, it is Payrolls Friday. You might have forgotten. This is Bloomberg Surveillance.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Building on the week's gains this morning, heading into the open with a bit of a lift pretty much across the board. You're seeing 0.4% gain on S&P, on NASDAQ, Russell 2000 up 0.5%, a bid into bonds. This has been a story for the remainder of this week as we get some sense that maybe globally there is going to be a response by central banks in Japan in particular. 30-year yields, once hovering near 5%, now 4.87. Under surveillance this morning, the labor market's uneasy equilibrium.
We also expect a deceleration in the pace of employment growth this year. I think that's been quite well telegraphed because we have this uneasy equilibrium in the labor market where firms are not hiring. Demand for labor has actually slowed quite significantly, but they're not firing either. Companies are very cautious about talent.
Here's the latest. Investors counting down to May payrolls out in under 2 hours. Bloomberg survey forecasting 126,000 jobs added and unemployment to hold steady. Sarah House of Wells Fargo writing, we suspect it will show the cloudier outlook starting to weigh on hiring, with payroll growth moderating to 125,000 in May. Sarah joins us now. Sarah, thank you so much for being with us. We almost forgot that it is Payrolls Friday. I'm curious about how we understand this number of 125,000 in an environment that a number of people have said is just going to be a lower number kind of reality with lower churn, but that's okay.
Right, so I think this number really will reflect the fact that, yes, there's tremendous uncertainty hanging over the outlook, whether you're a business that's directly affected by some of the trade policy or maybe some other businesses that are just thinking about, well, what is going to be the end demand for my business if consumers are getting squeezed. But with that uncertainty, I think while businesses are being reluctant to hire, and we see that in a lot of the demand indicators for new workers, they're also still being pretty reluctant to fire. And so we still have, I think, this kind of muddle along environment where you do see, I think, some moderate deceleration in hiring, just as you're not adding as many new. But until you see a big move up in layoffs, I think you can see the train stay on the tracks.
Sarah, I'm taking an unofficial poll today to find out what everyone thinks the number that we would have to see in the payrolls report to basically claw our eyes away from what is going on between this implosion between the president and Elon Musk. What do you think that number is?
Yeah, so I think something somewhere around 80,000. So when you look at estimates around what's the break-even rate where the Fed really starts to maybe get worried that you're seeing job growth slow to a point where you're going to see more upward pressure on the unemployment rate, most of those estimates probably center around 100,000, maybe a little bit lower. And we know that the supply side is slowing just given the pullback in immigration. We're not seeing as big a gains in labor force participation. So I think a sub-80 number is what would really get the Fed's attention and make them rethink maybe the timing in which they might have to dial back remaining restrictiveness a little bit more to help support the labor market and the broader growth outlook.
If we were to get a number that low, how soon do you think the Fed would be willing to cut?
Yeah, so I think June is, we're not going to see a move in June, but I think if you got a really weak number today, so maybe even worse than that, sub 80, let's call it sub 50, and then that was backed up by a weak number for the June number that we get at the beginning of July. I mean, I think you could see July be a real possibility, but you do need to see those payroll numbers lurch lower. Now, that certainly can happen, and I think this is a pretty tumultuous environment, so you could see that, but I think, you know, 1 week jobs report isn't going to be enough, especially as you think that this period is really going to capture, I think, in some ways the peak degree of uncertainty and sort of the immediate caution that we saw coming out of the April 2nd tariff announcements. And so the fact that we have seen the 90-day pause on China, you know, there's still, I think, some hope that we'll get some deals coming here that I think you could see maybe some stabilization in the next jobs report. But it's really going to take, I think, 2 back-to-back week numbers for the Fed to be like, okay, this is really deteriorating in a meaningful way. This isn't just noise.
Sarah, just quickly here, how concerned are you about the low response rates to the NFP survey?
So we've seen those, actually this year they've steadied a little bit, but they're certainly lower than what we saw a couple years ago. I mean, the good thing with the payrolls number is that this is still a very large survey. So it's somewhere around 120,000 establishments. So it's still capturing a huge swath of the jobs market. But I think anything that clouds the data quality that we're getting right now at such a pivotal time in the economy, obviously not helpful.
Sarah House of Wells Fargo, thank you so much for being with us. Julian Emanuel of Evercore ISI, I'm curious what you think is going to be a sort of a real market-moving type of number, to Anne-Marie's point, that could potentially change the narrative about the U.S. economy.
Well, again, I think it's sort of bracketed. Probably Sarah's number of 80,000 would get people in the bad news is bad news. And then, of course, to the upside, you know, no one is expecting a number sort of above 150,000. That would refocus us on the fact that we're about to have a big, beautiful bill that is going to expand the deficit. But I do want to just, for one thing, what's interesting is that actually we come into June and the small cap investing space has been totally unloved and abandoned. And you are in a so bad it's good area for the Russell 2000. And a weak payrolls number counterintuitively works because basically, if you think about smaller companies, they are much more prone to having difficulties when the labor market is as tight as it's been for the last 2 years. And then, of course, from the aspect of small caps, you don't have single stock tweet risk that you do in the larger cap brethren. So we think small caps are an opportunity this month.
Julian Emanuel of Evercore ISI, thank you so much. A really interesting call there, the idea that so bad it's good because ultimately it'll make it easier for them to hire people.
Although I would say never say never. You never know if a small cap CEO can potentially come in the crosshairs of this administration, given what we've seen play out in the last 24 hours.
Coming up next, we'll parse through what to focus on this morning. It is Payrolls Friday. Good morning, Priya Misra of JP Morgan, former NEC Deputy Director Everett Eisenstadt, and how to understand the China-U.S. Back and forth. Bloomberg's Ed Ludlow on the Real Housewives of the White House and Sarah Wolf of Morgan Stanley. All that coming up. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The labor market's in a bit of a holding pattern.
Demand for labor has actually slowed quite significantly.
The estimates are rather tight. There's a very tight range of estimates.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
It's the labor market that matters most.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. It should have been Payrolls Friday. Instead, we're gauging the fallout in a war of words between President Donald Trump and his ex-first buddy, Elon Musk, the psychology of a breakup. Meanwhile, China-U.S. trade talks in focus after a Xi-Trump call. It's Payrolls Friday, and Anne-Marie, we are all very distracted.
Very distracted, which is why I keep having this unofficial poll on the show, trying to find out from analysts, from guests, what is a number we could see in the payrolls that would distract us all from the feud that was taking place yesterday and potentially will bleed in today, or maybe there'll be a fragile truce today. When it comes to Sarah House and Julian Emanuel, sub 80 or north of 150 is the print that we may need to see in order to be distracted with something else besides this implosion of a relationship between the former first buddy and President Trump. With this time last week, there was that huge goodbye party for Elon Musk. How quickly things change in Washington.
Aside from the drama, it's important to take a step back and to understand that we're talking about massive swings in huge benchmark indexes of the United States on the heels of tweets and recriminations, and it raises a question about the risk premia assigned to certain stocks, certain asset classes on the heels of new policy volatility. And that has to be part of the conversation. If it isn't going to be the economic data, is it going to be discussions about the bill, or is it going to be something else that keeps driving people with this idea that maybe there is another risk that you cannot quantify?
Well, I think yesterday when the president put out a tweet saying the easiest way to save money in our budget is to terminate Elon's government subsidies and contracts. This just reminds you, if you're an executive, if you're a company, that you are potentially one social media post away from seeing your stock fall and end the day down some 14%, losing $34 billion of your personal wealth because of a flare-up you have with the Oval Office.
So all of this type of noise, how does it really play back to the consumer, and whether there is going to be purchasing power and ongoing willingness to commit, let alone companies, their ability to commit to big investment plans as well as hiring plans? And that ultimately is the question that investors are looking for. How much is this going to matter to the real economy, which is going to have longer legs than potentially the emotions of two people who have a lot of power? And we should mention this. We're talking about them as children or real housewives, but the reality is these are people with an immense amount of power and responsibility who do have a lot of clout.
Yeah, they have a tremendous amount of clout. The most powerful man in the world with the richest man in the world coming head to head over a number of issues. This could be over what happened with the head of NASA that the president pulled out that was a friend of Elon Musk that he supported. Is it really about EV tax credits? Is it really about the deficit? It really doesn't matter. Julian Emanuel is saying you have to take a long-term view because the volatility day in, day out is here to stay.
Right now, the long-term view seems to be all distilled down into some positivity for the U.S. economy. Looks like we're going to end the week with gains, although fading from earlier highs across the board, up more than 0.3%. You could see in the bond market, we have had a bid into bonds. Possibly one of the drivers of some ease in markets is that it hasn't been the deficit discussion, but rather this bid back into bonds globally, as there does appear to be a disinflationary feel. Coming up this hour, don't miss this. Priya Misra of JP Morgan as stocks look to rebound and signs of cooling tensions between Trump and Musk. Former NEC Deputy Director Everett Eisenstadt, as U.S.-China trade talks pick up, and Sarah Wolf of Morgan Stanley counting down to that payrolls report in about 90 minutes' time. We begin this hour with stocks rising ahead of key jobs data. Priya Misra of JP Morgan writing uncertainty remains very high. While the worst-case scenario has been taken off the table, we think the economy will grow below potential. Priya joins us now. Priya, great to see you. Thank you for being here with us for the full hour.
Morning. Thanks for having me.
So let's talk about the real economy and what the ramifications of this type of uncertainty is. And we're not just talking about uncertainty with respect to the Musk-Trump drama, but also with trade, also with the economy. What are you looking for to understand just how much has been a hit to growth?
Sure. So I think I'm glad you bring up uncertainty because, you know, as the markets have all rebounded, I think the markets wanted to, the equity market, risk assets have wanted to rally because they've said, well, we're not going into recession. But think about business uncertainty. Once you sort of, you know, try and remove the noise, which I know it's hard these days, and look at what is the underlying, we still don't know the trade deals. I mean, we're in that 90-day pause. We have a month left. We don't really have, we have one trade deal. So I think people don't know what that effective tariff rate is. We're all making assumptions. We're in the 10, 15% effective tariff rate. But if I'm a business, I don't know it, I'm frozen into inaction. Do I also cut hiring? Maybe I don't fire people because I remember how hard it was to hire people after the pandemic. But do I, you know, cut back hiring? Do I just wait on CapEx? So there's trade policy uncertainty. There's also fiscal uncertainty. We have the OBBB, which is not, the BBB is not the US government rating, I should clarify, but that's what we're all calling this bill. We have that bill, and we don't know the contours of that bill. Deregulation is another one. So I think with all of this uncertainty, we're in this wait and see. I know the Fed is also in this wait and see, but the longer it lasts and more broad-based it is, I worry that there's a non-linearity, meaning we can handle a month or two of uncertainty. If this is what Secretary Besson calls strategic uncertainty, it's going to live with us for a while, and then people pull back. Oh, remember all the talk of R star is going to be higher? Maybe R star is lower because we all cut back and wait. We don't do much. I mean, as investors, we have to trade this market, but I'm thinking from a business standpoint, this is not the time you do a big ticket CapEx plan. That's what we're seeing in the small business survey, that those CapEx plans are coming down. That's what I worry is going to filter through into the labor market, into spending.
I remember Mohamed El-Erian coming on this show and saying there are very binary outcomes, and it could be very good or it could be very bad. And people didn't seem to be pricing in the very good. And this was at the beginning of the year, that there could be some sort of rebalancing and growth and even a reduction in the deficit, that could have been a pathway that this policy mix could have led to. As the uncertainty grinds on, from your perspective, do you think that that upside tail risk has been taken down?
I really struggle with that upside tail risk. I can see it from productivity, I can see it from technology, But even there, it requires investments. It requires clarity of what the future will look like. I mean, we're not even sure who our, I think the rest of the world doesn't know, are we their friend or their enemy? I think that becomes an issue for a debtor nation like the US that actually needs the rest of the world to buy not just our treasuries, but our corporate bonds, our mortgages, our equities. So I think there's also, while we're trying to reset trade relationships, we're trying to figure out what are we doing with the debt, there's also this question of the rest of the world financing our consumption, financing our investment. I think that's why I struggle with the upside risk. I look at the one big beautiful bill and, I see a small fiscal stimulus in the next year or two, and then actually I see a drag. So unlike previous big increases in deficits, they were typically growth enhancing. This is just taking the tail risk of taxes going up. I think this is basically taking that off the table. I think the scenario of outcomes is really, hopefully, we muddle through. That's the hope trade, that we grow below potential, but we don't go into a recession, or that non-linearity I talked about where businesses just say, we're just going to hold off and we're going to start to cut costs as they're, if we're going to have a 15% tariff, that's a tax on the corporate sector or the consumer. Some of the recent Fed studies are suggesting most companies are passing on these costs to consumers. So now the question will be, can consumers take that? Well, if average hourly earnings, we're going to get that reading very soon. Today, if earnings don't grow, then as a consumer, I may have to pay for something. I may have to pay higher prices for some things. I'm going to cut back on other things. And as consumers make those tough decisions, you'll see that then feed through into the corporate sector. That'll also have to say, okay, where do we cut back? Because we're seeing that destruction in demand. We haven't seen it. We're in this wait and see period. But I think the patience of the economy is running thin. And I don't know if we'll see it today or we'll see it next month, but I think that hard data is going to start to soften in line with what the soft data suggests.
It certainly feels like we're treading water at the moment. If the market could have clarity on these multitude of uncertainties, which one do you think it would be?
I think trade deals would really help, because at least then we get to know that we can, how much do you have to rework supply chains? I mean, a lot of companies, not just manufacturing, service companies, do need that trade, need to understand where can we ship from. So I think trade would help. I think fiscal would help, particularly as we head into the debt ceiling. But that July 4th deadline, it's great if we get it done by then. That's sort of a man-made deadline. I think by early August, by the debt ceiling, we do want that done, or a backup plan. I can understand why they're not talking about a backup plan, but we need something to pass the debt ceiling. So I would put trade number one, this idea that we are not decoupling from the world. We may be trying to ring-fence China on a few strategic issues, but we can still work with the rest of the world. I think that would really help.
I'm glad you said trade, because Nikkei has some new reporting today that in the meeting with Japanese negotiators, at one point, they had to stop because Scott Bessent, Jameson Greer, and Howard Lutnick started fighting amongst themselves in front of the Japanese. When you hear and read stories like that, do you think we're actually going to get deals by July 9th?
I'm hopeful we get some agreement in principle. I actually think the market is pricing that in. I don't see any market that's pricing in continued uncertainty or a rolling 90-day extension, which keeps this uncertainty high. There's some talk, but so I'm hoping we get. But there's so many issues. You're right, right from the currency to the rest of the world buying our assets, to trade deals, to technology, and is there an attempt to try and get China to rebalance? There's so many goals to revenue raising. We haven't brought that up, but there's that hope as well. So I'm hoping that we get some agreement in principle so that we can have clarity on what is the tariff rate with Japan. I don't know if we're going to get that with everyone, though.
In the meantime, maybe if we want to end on a positive note, because this has been sort of gloomy, we have seen a bid into the 30-year Treasury, which you called a risk asset. Isn't that positive?
It is a risk asset, which tells you that it can move around a lot, and which is why you have to price in more risk premium. But yes, the positive for bonds came about because we got some slightly weaker economic data. ADP and the president posted about it. So that tells you that there's concern. I mean, I think the bond market is pricing in stagflation, which is a fair pricing in given tariffs, and this fiscal issue, and is really not pricing in weaker growth. So what I'm concerned today is, you get slightly weak numbers. Anything below 100, I think the bond market, including the long end, is going to say, okay, maybe this was all resting on a solid labor market, and it's not that solid. And then I think you will see rates fall. The steepener may not work because everybody has the steepener on for the fiscal reason. But this is why I would say being long duration and the steepener might be a structural view on, you know, the fiscal trajectory, the fact that the rest of the world might want to get paid more to give us money for 30 years. But the front end, you should be long that because the asymmetry really comes from the economic data. If any weakness, I think that front end has a lot of room to fall.
Priya Misra of JP Morgan will be sticking with us throughout the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump is open to lowering the SALT cap below $40,000 in his big, beautiful bill. Sources telling us here at Bloomberg that the president shared this new openness in a meeting with Senate Finance Committee Republicans earlier this week. Meanwhile, a check on Broadcom shares, those are falling 2.3% in the pre-market. The company, which supplies chips to companies like Apple and Alphabet, gave a revenue forecast for the current quarter that failed to impress investors. The outlook signaling that expectations for Broadcom's AI-fueled growth run were way too aggressive. And in other Musk news, albeit more positive, his company Starlink has received regulatory approval in India, making room for the company to roll out its satellite internet services in the world's most populous nation. The approval is a major step for Starlink after a years-long wait. It has signed deals with local wireless operators to assist with the rollout. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Trump and Xi talk it out.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things.
Coming up next, we'll be speaking with Tyler Kendall. Don't miss that. This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Piecing together all of the narratives and what people in markets are seeing is some positivity after a week of tumult, eking out gains for the week, up about 0.4%, pretty much across the board for the S&P, NASDAQ, and Russell 2000, a bid into bonds as people look to possibly disappointments in economic data and a real question mark going forward about what the nature of trade will be like between the world's two biggest economies. Under surveillance this morning, Trump and Xi talk it out.
I I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things. He invited me to China, and I invited him here. We both accepted. So I'll be going there with the First Lady at a certain point, and he'll be coming here, hopefully, with the First Lady of China.
Here's the latest. President Trump and Chinese leader Xi agreeing to further talks after Trump says the relationship got, quote, a little off track. Bloomberg's Tyler Kendall joins us now. Tyler, what do we know going forward about the path ahead?
Yeah, hey, Lisa. Well, there's still a lot of key details that need to be worked out, but our analysts here at Bloomberg say that by taking the call now, Xi Jinping may be betting that he could get some tangible wins going forward. The thing is, there's still just so much that needs to be addressed when it comes to some of these key trade matters. Now, you heard President Trump there suggest that they did address one of those sticking points for the U.S. when it comes to rare earth minerals. As you well know, the U.S. has been accusing Beijing of slow-walking critical and rare earth mineral exports to the U.S. that are essential to supply chains here. But it's not totally clear on what they agreed to exactly, though it's a sure thing the U.S. would like to see China speed up these export licenses. It's also not totally clear on what Xi Jinping ended up getting out of this call, though in the Oval Office, President Trump did say that all Chinese students would be welcomed in the U.S. This has been a really big concern of Beijing, we know, going into this call amid the State Department's plans to revoke certain Chinese student visas. So we're going to have to watch how this ultimately evolves. And Lisa, it's always a good reminder of the context that it ended up taking 18 months to reach that first Phase 1 China trade deal under the first Trump administration, but negotiators this time only gave themselves a 90-day reprieve to work this out from mid-May.
Tyler Kendall, definitely an ambitious timeline. Thank you so much. Joining us now is Everett Eisenstadt, former National Economic Council Deputy Director. Everett, thank you so much for being with us. I want to start by how important yesterday was to you and what you took away from that phone call.
Yeah, it's a very important phone call. It had been quite some time since the two leaders had spoken. And since that time, we had a little bit of a reprieve in Geneva with some settlement of this outstanding bilateral irritants, but it had really started to deteriorate again. So I think the call was very welcome and hopefully sets us on a path for good, solid, sustained engagement.
Who do you think has the leverage right now in this relationship?
It's not all clear to me. I mean, each party has different things they bring to the table. Of course, you mentioned one of them, which is the rare earth minerals and the magnets, which are a very, very important part of the supply chain. But what it does show is that each party has the ability to inflict pain on the other, that there are elements of our economic relationship that we can't just wish away, and that we need to find a pathway to work together. And so the call is a good help. It'll start, we hope, a long and hopefully fruitful negotiation. But yeah, there's a lot on both sides that can be done where it could deteriorate much worse than it has already.
Is this basically both sides agreeing the strategy of mutually assured destruction that potentially they want to avoid?
I don't know if it's, I don't know if there had ever been really this sense of mutually assured destruction. I think it's more a sense.
It seems like we lost the former NEC Deputy Director Everett Eisenstadt, but he's talking going forward about the path ahead and what this means for potentially some sort of off-ramp that could be sustainable.
He was there during Trump 1, so he understands how this negotiation works, the fact that Phase 1 trade deal took 18 months, as Tyler just mentioned, and how long this potentially will take. And the fact of the matter is, this isn't just a purchase agreement. There is a number of complexities involved with this agreement, like student visas. That was something that it seemed that the United States was willing to potentially be a little bit more lenient on with just days ago saying they're revoking this. So there's a number of different contours. What I would say, though, is that the two biggest choke points are also the red lines for Beijing and for Washington.
That was exactly my question. That would have been my question to him. What are the red lines? Is it immigration? Is it national security? Is it, trade? Is it technology? Remember those chips export curbs? How important are all of these issues to both sides? Because in order to get an agreement, a good agreement, neither side's going to get everything they want. I mean, you're talking about the world's largest manufacturing superpower and the world's largest consumer. So they're going to have to give in on some things. What are the red lines? And I guess we'll have to live this through as they talk. But I think over the next, I don't see how in the next 2 months we're going to get agreement on all of these issues, because it's not just one thing that we're debating.
And how it trickles into the fundamental data that we keep getting. There was ultimately a fissure between any sort of trade for an entire month during the initial salvos of this trade war between the U.S. and China. Now you're seeing ships come in. You see those sort of shipments and exports picking back up, but has there been permanent damage that is going to both increase the costs for consumers and also increase the risks for individual companies that are dealing with supply chain risks and inventory buildup?
Exactly. I think, there's definitely damage that's being done. People are having to rethink supply chains. If you're trying to invest in a new product, well, first, let's figure out your existing product supply chains. Is that happening? So, and I think the question is going to be, you're paying higher tariffs. If it's 30% from China, 10% from the rest of the world. And remember, we're still going to potentially get sectoral tariffs. We're still waiting for that. So the cost is going up. It's being paid by the importer. Now, who actually bears it? Is it the corporate sector or the consumer? I think that's what we're going to have to see it play out in the data. And at the same time, I think the economy was sort of slowing coming into this shock, and now we've created this, I would say it's a supply shock. Let's see if it translates into a demand shock.
And right now, we had a survey recently from the American Chamber of Commerce, and they're talking about the fact that 90% of companies are saying they're not leaving China, even though you see these high tariff barriers the Trump administration put in place. And at the same time, the Trump administration is trying to get a deal done with China. They're also working with dozens of other countries, because it is a trade war with China, but it's tariff negotiations and discussions with all these other countries that they want to wrap up by July 9th, which I think is incredibly challenging. We have the Nikkei saying that the top 3 negotiators argued amongst themselves in front of the negotiators. And I just got back from Switzerland, where the top trade negotiator told me that even though they are so far along in their discussions with Washington, even they were told, if we're not there by July 9th, there will be wiggle room, there will be an extension. So we're going to be treading water this entire summer, and what kind of damage is that going to do to the real economy?
It goes to what the ISM manufacturing survey and services surveys seem to show, and the services survey in particular had one commentary from one sector saying this was akin to COVID-level types of shocks with the supply chain. This is what they saw then, and this is yet again the same type of disruption. How do you determine, and this is something that we've been discussing a lot, what is idiosyncratic and an execution risk when it comes to specific companies versus something broader and an economic risk as you parse through those earnings?
And I think the issue is things will slow down, but is that normalizing to some 1% growth, or is it going to continue? And because this is policy induced, I think the hope in the market is, whether you call it taco trade or, the art of the deal, that policy will rein it back. But to your point, some damage has been done. And, I think there is an ideology here in the White House. There's an ideology and there's a pragmatic part. And the market's trying to figure out how ideological versus deal making is happening. But that uncertainty I'm going to highlight, there's an impact. At some point, people just step back and you continue to, do the bare minimum, but that's not what the economy needs to grow above potential.
Priya Misra of JP Morgan will be sticking with us. Up next, President Trump and Elon Musk's bad breakup. Bloomberg's Ed Ludlow joins us next as we parse through what the real ramifications are for the company, aside from the drama, whether this does make a material impact for some of Elon Musk's companies. This is Bloomberg Surveillance.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Still trying to reach that bull market, still trying to reach some sort of new record high. You see equity markets trying to climb their way into the open. We do see gains pretty much across the board, up about 0.4%. Meanwhile, you do see a bit into bond markets, a sense that maybe there is all calm in Washington, D.C. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with Tesla. Shares are higher now, 4.2%, as signs emerge that tensions between Elon Musk and President Trump are cooling after their very public spat yesterday, which we all witnessed. In a series of posts on X, though, Musk seemingly open to de-escalating. We also have that reporting from Politico that White House aides have set up a call with Musk to try and defuse the situation. But as you guys said earlier, best, this feels like a high school breakup. Next up, we have shares of Circle. Those are now higher 11%, climbing again today, extending their gains from yesterday after a blockbuster IPO that saw their shares surge 168%. That is the strongest first-day gain since 2021 among larger U.S. IPOs. And it also comes amid an upswing in the IPO market. We've seen companies like Hinge Health and eToro go public, so the IPO market showing signs of life. And last up, we have a check on Lululemon shares. Those are still cratering, down 21% after it issued another weak quarter and a gloomy forecast because it says tariffs will hit profitability. And if you thought your Lululemon leggings couldn't get any more expensive, well, they plan to raise prices in order to offset those tariffs, which could backfire, of course, since U.S. shoppers are already pulling back at their stores. And no, Lisa, I am not willing to pay $200 for a pair of leggings. Back to you.
Duly noted, Yahaira. Thank you. I think a lot of other people are also questioning that, which is part of some of the caution. On our radar this morning, President Trump and Chinese President Xi agreeing to hold more trade talks after a 90-minute call yesterday. Trump saying the leaders are, quote, straightening things out in discussions over rare earth minerals. A question about how much optimism markets can really take away from this.
What I find interesting, though, is that the Chinese readout didn't talk about the rare earth minerals and the fact that there's the easing of controls, but the White House did. And this was something that they wanted to take away as a massive win. Another thing I think was really interesting is Howard Lutnick is now part of the trade team, and he will be joining Jamieson Greer, USTR ambassador, and the Treasury Secretary Scott Bessent for the next meeting. We don't know where that's going to be. Maybe Switzerland, because that's where they had success when it comes to the Geneva Agreement. But him being at the table now begs the question, is this optimistic if you're a semiconductor company like NVIDIA and you want to get access to Beijing and the Chinese market? Or actually, is it going to be hawkish? Is he going to be the individual at the table that says, no, we're not going as far? And the issue, of course, for China, this is their red line. This is the access they want.
I just want to understand, what are the red lines on both sides and what are the ultimate goals on both sides for what this relationship does look like? And this has to do with U.S. and China, and it has to do with trade partners around the world. Nippon Steel and U.S. Steel are on pace to finalize their $14.1 billion merger. Ahead of a June 18th deadline, the deal would give Nippon Steel ownership of the historic U.S. company, while it retains some measures of American control. The big about face, the deal that will never die, seems to be, at least for now, headed towards some sort of closure.
Right, and they only have a few weeks to go, so you're hoping that if this deal is going to happen, it needs to be done in the next few weeks. I know there was a lot of concern among investors whether or not the CFIUS panel would greenlight this in time. It looks like potentially that's going to be the case. I think we're still waiting to hear a little bit more about exactly what does this U.S. share, this golden share in the company actually look like in terms of the board members. We know it's going to be headquartered in Pittsburgh. These were huge wins for the president. But just taking a step back, what a complete 180. The fact that we're talking about this deal about to be over the finish line this month in just a few weeks is pretty incredible, given the fact that President Trump and President Biden, when he was president, both vowed to not see this deal go through.
Look, there was a lot of hair on this deal. It's hard to use this as some sort of broader question mark around the M&A picture in the United States. This was unique. It had a lot of issues. That said, there is a question about whether there is going to be a softening in some of the mergers and acquisitions that we had expected earlier this year. This was going to be the year of the deal, and we hadn't seen it yet. And Priya, I'm wondering from your perspective how instrumental that type of activity will be to signal risk on, to signal that maybe the ramifications on growth really aren't as significant given the uncertainty that you're talking about.
Sure. So I think it'll help a lot if we start to see deals. Now, why have deals pulled back? Uncertainty, the equity pullback, but also interest rates. This is why I really hope the bond market has a seat at the table when President Xi and President Trump speak. I hope the bond market has a seat at the table when Congress is thinking about this one big, beautiful bill. Because here's the issue. Interest rates have risen, but they've risen led by term premium. They've risen by the led by the long end. Most people, including companies, borrow at the long end. Households borrow at the long end. Most mortgage rates are longer term. So when those long rates rise, then it signals, and it's all being led by the long end. That's why the curve is steepening. I think that's an issue. That's signaling to the rest of the world, we have to pay more for treasury debt. Well, then you have to pay more for that merger and acquisition as well. So I think M&A activity does depend on that long end. The valuation for the long end is getting interesting. The catalyst, not so clear. We have a deficit trajectory. We don't know if the rest of the world is still going to keep buying our treasuries at the same rate. So I think we do need some stability in that long end, and I really hope that everyone's watching. I know you watch the 10-year. I hope everybody in the world is watching that 10-year, and I think, yes, if you do see some stability in the 10-year, lower rates, and I'm not sure the Fed can help there. You actually need it from all of these other factors that are driving that long and higher. I think then you get that M&A, and that's a good sign.
Yeah, and that's something that people are looking for some confidence. Meanwhile, as Yahaira has been talking about, Lululemon shares are plunging in the pre-market. The athleisure maker posting disappointing results for the second straight quarter. Lulu saying it might have to raise prices on some items because of Trump's tariffs, and this has been an ongoing question about how much to pass on to the consumer and how much to really absorb in terms of margins. Elon Musk signaling he's ready to cool tensions with President Trump after their feud reached a boiling point on social media yesterday.
I'm very disappointed in Elon. I've helped Elon a lot. Elon and I had a great relationship. I don't know if we will anymore. People leave my administration and they love us. And then at some point they miss it so badly, and some of them actually become hostile. I don't know what it is. It's sort of Trump derangement syndrome, I guess they call it.
Meanwhile, right now, Bloomberg's Akayla Gardner joins us. Akayla, what do we know in terms of who's talking to who and what kind of ramifications there have been already, both on the White House side as well as Elon Musk?
Well, we can report now that the White House does not have plans to speak to Elon Musk at this time, and no call has already been made between the White House or Elon Musk, and that comes after Politico reported that such a meeting would take place today. And they also interviewed Donald Trump late last night, where he sounded very nonchalant about the debate that we saw amongst them on social media yesterday. But for many people in Washington, this is something that many people expected. A moment would happen that these two leaders would come to a head. Two people with huge egos. You had the most powerful man in the world when it comes to politics, and also the richest man in the world, up until this point, really seeming to kind of break from those expectations, despite some of the negative associations with Doge and some of the inaccurate firings and people who've had to be hired back. They've really survived what has been a tense sort of relationship thus far, and yesterday we saw all of that break down.
Kayla, how are members of Congress dealing with this blow-up?
Well, for the president, his attention has really turned to this big, beautiful bill, which has so many huge accomplishments for him that he has touted on the campaign trail and that he really wants to see get over the finish line, whether it's immigration reform, extending tax cuts, energy reform. And that is where his attention is this morning. He's already posted on Truth Social twice talking about his favorability numbers. One message he posted simply said groceries and energy. So that is certainly where his attention is focused today. And Speaker Mike Johnson has also been calling Elon Musk a friend and saying that policy differences should not be personal.
Bloomberg's Kayla Gardner, thank you so much for being with us. Joining us now is Bloomberg's Ed Ludlow. Ed, I am curious about how important this is as a broader takeaway when it comes to the trajectory for Elon Musk's portfolio companies. We talk about this as this ongoing drama, but it's really important to remember there is a lot of money at stake here. This company, Tesla, lost more than $150 billion of market capitalization yesterday, just in one day, on the heels of this fallout.
Yeah, I mean, like, the stock's up 5% in pre-market, right? Why is that? Is it because it's Friday at the end of a long week and everyone just wants to have a bit of relief and get back some of the 14% drop from Thursday? Or is it literally that a detente or burying the hatchet between the administration and Elon Musk is driving thesis? And what I find so interesting about this, and I spoke to a lot of people in the last 24 hours that are not just Tesla shareholders, but on the private side, SpaceX shareholders as well, right, is that a component of the Trump trade, particularly prior to November, was simple, that it was a friendship between Elon Musk and President Trump that would allow Elon Musk to have the ear of the president, and so therefore influence policy in a way that would be to the benefit of Tesla, in particular in the long run, and keep SpaceX closely aligned, particularly to the defense apparatus of this country. And that, we can go over the reporting of the last 10 days or so, but I think that's particularly true in the case of Robotaxi, right? Because the stock has been volatile on any reporting or signal that Elon can or cannot get some kind of federal level oversight of Robotaxi, which would help Tesla in the long run in that field.
Ed, we spoke to Speaker Johnson yesterday about what was going on between Elon Musk attacking this bill, and here's what he had to say by potentially the reasons behind it.
Sure. I'll let everybody draw their own conclusions about Elon's motivations. I'll tell you that, I mean, obviously the EV mandate going away is I'm sure, a concern for, the leader of Tesla.
Ed, if you look at what Elon Musk has said in the past about EVs, July of last year, take away the subsidies will only help Tesla. December, I think we should get rid of all credits. And then yesterday, he said keep the EV solar incentives cut in the bill, but also cut everything else. Is this really the crux of the issue, what led to the blow-up between him and the President of the United States?
Well, and I believe that the President of the United States also cited, the EV mandate issue in a cabinet meeting in March, and AMH, correct me if I'm wrong, the cabinet meeting in March, which was on camera, he basically said, Elon's never asked me for a thing. I told him I'm going to cut the EV subsidies, which, and I think the president said, I don't know how that would impact Tesla, I'm assuming negatively. But Elon Musk has been consistent about that. His basic argument, which you're right, started next summer and went all the way through to present day, including the election and the outcome of the election, is that he doesn't need the he doesn't need the EV incentives or subsidies because he feels like Tesla, because of its critical mass and scale, will benefit and lead the market anyway, and that those subsidies would hand a greater advantage to others who are not as profitable as Tesla on EVs and things like that. So it's an interesting domain, but again, so is space, right? And the use of the threat of Dragon capsule being decommissioned and then reversing that threat, that there is some fractious points of contention in policy.
Ed, are there any shareholders who are upset by this, who are calling for Elon Musk to take a breather and maybe take a step back from the public spotlight in terms of his political involvement?
Yeah, loads. My phone's been going off for,
well, but that's
12
important,
hours.
right? I mean, ultimately, that he does ultimately have a fiduciary responsibility to people. What do they want to say?
Yeah, I don't mean that flippantly. It's why I brought up the robotaxi thesis, right? So what we reported last Friday is that at the end of last week, Elon Musk and all of his staffers that have some kind of responsibility in DC were phoning up lawmakers to try and influence the content of a bill that is passing through Congress on autonomous driving legislation, right? That is the complete center of the long-term bull thesis. I think Dan Ives was on the network this morning, right, saying that the events of the last 24 hours have not changed the long-term outlook for Tesla. But that's the only question of why we are reporting and discussing a fallout between Elon Musk and the president, because all of that long-term thesis was predicated on the idea that Elon Musk's proximity to the White House would result in policy and legislation that acted favorably in the long term for Tesla, particularly in the field of robotaxi, which is less regulated. And I can tell you that other leaders in that field that compete with Tesla are deeply worried that Musk will do that he will affect some legislation that has a disproportionate boost to Tesla relative to others in the fields that Tesla plays in.
Yeah. Ed Ludlow of Bloomberg, thank you so much for getting up early and talking with us about this morning. It is fascinating, and it raises a question: what was actually behind Elon Musk's dissent from this big, beautiful bill? And Priya, it remains to be a question: was it the EV credits, or was it something else?
I think there was an aspect of the deficit ideology as well. Remember, Elon Musk, I mean, apart from Tesla, he was in charge of Doge, and he tried to do a lot. Now, we can debate, he didn't get his trillion, he got probably 100 billion or so in terms of cuts, but he worked, he was part of Doge. It was right after the inauguration, we had Doge. So I think some of this is, as he's looking at this one big beautiful bill, seeing that really the tax cuts are temporary, which means they're going to get extended. A lot of the spending cuts are backloaded, which means they may not happen. So even the CBO estimate of 2.4 trillion deficit impact, it's likely to be closer to 4 or 5 trillion. That's before the Senate has come in. So is Musk trying to highlight the deficit issue again? I know the market's focused on trade and then deficit, and so he's trying to probably get us back into, we have an unsustainable deficit trajectory. But I'll say one thing, I mean, I've been doing this a long time. We've been talking about the deficit trajectory since 2001, that it's unsustainable, that we have an entitlement problem. Why now? Why is the concern now? Because we're in a strong economy. This is when the deficit to GDP should be lower. There doesn't seem to be any political will to do that. Yeah. And the other big issue is the interest service cost. So if you're paying 4.5% for debt and nominal GDP is 3%, now you've got a problem. So we do need, Secretary Besson talks about this pro-growth. We kind of need to believe that growth will be higher than that interest servicing. And I think the market's losing patience.
Talking about growth, coming up next, we'll talk about payrolls. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump and Canadian Prime Minister Mark Carney have had direct talks about a trade deal. The U.S. has import taxes on Canadian-made steel, aluminum, and autos, and Canada has retaliatory tariffs on American-made goods. Trump is planning to attend the G7 summit in Ottawa on June 15th, and some Canadian officials are hoping to reach a deal before then. Meanwhile, BlackRock is planning its second round of job cuts this year, eliminating about 300 people months after a similar move at the beginning of 2025. It comes after the world's largest asset manager splurged on $28 billion worth of deals to wade deeper into private markets, and that, of course, added to its headcount. And David Beckham is set to be knighted next week. That's according to The Sun. The knighthood comes over 2 decades after Beckham was appointed an Order of the British Empire for his contributions to football and charity. Beckham is an ambassador for UNICEF and the King's Foundation, focusing on education and the environment. His wife, Victoria, will be known as Lady Beckham after the formal announcement. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, counting you down to payrolls.
I think the market gets worried if you get something below 100,000. I think over 200,000, maybe you get a bit more optimism. But for now, you know, there's a very tight range of estimates.
Sarah Wolf of Morgan Stanley joins us next. This is Bloomberg Surveillance.
makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Drama, but in the bond markets, in the stock markets, not so much. In fact, we're ending the week with gains heading into the open, building on some earlier gains. Russell 2000 in particular up 0.5%, NASDAQ up 0.4%, as well as the S&P. We are in payrolls Friday, despite what it might feel like. Under surveillance this morning, counting down to payrolls.
We're at 160. I think the market gets worried if you get something below 100,000. I think over 200,000, maybe you get a bit more optimism. But for now, you know, there's a very tight range of estimates. And we're thinking about what we're seeing in hiring trends, going from about 177,000 the previous month to 160 makes sense in our view.
Here's the latest, less than an hour away from the May payrolls report. The estimate in our survey, 126,000 jobs added. Sarah Wolf of Morgan Stanley falls in line with consensus, expecting exactly bang on the dot 125,000, with unemployment unchanged at 4.2%. Sarah joins us now for more. Sarah, great to speak with you. Thank you for being here. What do you think is going to be the most informative aspect of this report, given the mess that everyone keeps talking about and potential distortions?
I do think that the Fed is going to be looking still at the unemployment rate. And the reason they're going to be more focused on the unemployment rate than the payroll number is because break-evens are coming down. So naturally, we're going to be seeing slower job growth with slower immigration. So break-evens are probably somewhere around 120,000 right now. That is going to fall even further to about 90,000 in the back half of this year because of slower immigration. And so really the Fed wants to be able to gauge the labor market tightness, which is going to take into account payrolls and supply. And that's what's going to be reflected in the unemployment rate, which we're expecting and consensus is expecting to stay at 4.2%.
Sarah, how do you see the rise in the claims data? Over the last 2 weeks, it's picked up. Do you think this is seasonal, or this is indicating that businesses are finally starting to let go of some people?
I think that the claims data is reflecting exactly what we're hearing from businesses, that it's a softer hiring environment. Businesses cannot think ahead because they don't know how trade policy is going to shake out. They don't know the final details of the tax bill. And so they're putting off big investments like CapEx and like hiring. And then they're also starting to shed some workers. And I wouldn't be surprised if the first place we start to see some of this weakness and layoffs, we've already seen it in federal employment, but I expect now to start to see it in leisure and hospitality. You have to remember that the employment report looks to add 400 to 500,000 jobs in leisure and hospitality across May and June to ramp up for the summer travel season. We know that summer travel is likely going to be softer this year, not only because travel inbound from overseas to the U.S. is down double digits year over year, but also because there is this concern among consumers across the income distribution about their finances, and so they're likely going to travel less this summer.
So, it sounds like you're looking for the labor market to weaken and I guess lower numbers going forward. The Fed has this dual mandate. I'm curious your thoughts on inflation. Given that we are living in a 15-20% effective tariff rate, are you seeing signs that businesses are passing these prices along? I mean, in 2018, I remember we had the washing machine tariffs, but dryer prices went up. Do you think businesses will be able to pass it on? And then how do you think consumers react?
Well, this is really the million-dollar question: is can businesses pass through 80% of prices through to consumers, which would be a best-case scenario, or 30%, which is going to make it much harder for businesses. I think in this type of environment, we're definitely seeing some price pass-through, but we have to remember that consumers are quite price-sensitive right now. They just went through 5 years of extremely elevated inflation. Consumers are very attuned to tariff risk and what it's going to mean for prices because we've seen inflation expectations accelerate. We also, in our own consumer surveys, found that over 50% of consumers pulled forward purchases ahead of tariffs, showing that they are price sensitive and they're trying to get ahead of the tariffs. And so as a result, I do think it's going to be difficult for businesses to fully pass through pricing. That doesn't mean we're not going to see inflation, but it might put a little bit of a cap on how much inflation acceleration we do see.
Sarah Wolf of Morgan Stanley, thank you so much for that. And that's something that we've seen ongoing, this question of how much is it going to hit margins and how much is it going to hit the consumer, given the fact that there is this pushback.
But when are we going to actually see it in the hard data? And is today potentially the first time we could see a crack? But as everyone will tell you, one bad data report is not going to be enough for the Fed to really start bringing up rate cuts. They're going to need to see a trend, 2, 3, 4.
And there also is a question about whether we end up with a lower headline payrolls number that's just the new normal based on immigration and demographics. Priya Misra of JP Morgan, thank you so much for taking the time with us today. Always wonderful to get your insights, and hopefully we'll have you on soon. Coming up for the next hour, we do get that payrolls report. Stuart Kaiser of Citigroup, Michael Collins of PGIM Fixed Income, Stephanie Roth of Wolfe Research, and Jeff Rosenberg of BlackRock, as we're expecting 126,000 jobs created with a steady unemployment rate. This is Bloomberg.
We're building another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The labor market's in a bit of a holding pattern.
Demand for labor has actually slowed quite significantly.
The estimates are rather tight. There's a very tight range of estimates.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
It's the labor market that matters most.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to what we can now call Payrolls Friday, expecting a modest slowdown in job creation as companies slow hiring. Getting the latest read on the economy amidst ongoing trade uncertainty, and economic data seems to be trying to claw back the spotlight from the drama that has been unfolding on multiple screens in Washington, D.C.
Good luck to that economic data trying to claw back some of that center stage, because actually what we're hearing now is that there's not going to be this call between the White House and Musk. So potentially we are going to see that implosion continue into a second day. When it comes to the economic data, what I've been wanting to know is what is the number that would actually distract people to care about the economic data and not the implosion of Elon Musk and President Trump. And it seems to be, so far, under 80,000 or north of 150,000.
We can pose that question to our guest host for the hour, Stephanie Roth, chief economist at Wolfe Research. What is that number that would get the markets to pay attention?
You know, I think even if it's 100,000 or below, I think you start to claw back that attention. And then I think on the upside, sure, 150 or so would certainly do it. But the number sub 100, I think, will get people a little bit uncomfortable. Even though we should expect the trend growth in payrolls to slow down throughout the course of the summer, it's just noticeable when it starts to play out.
There is a big question underpinning all of the back and forth of the turmoil that we have seen, which is at what point does it really affect the long-term outlook that investors are trying to cling to, as opposed to getting whipsawed by all of these headlines? Do we have a sense that, as Priya Misra was just talking about, that the long-running uncertainty is having ramifications that we are starting to see in data that for a hot second turned into a positive surprise on the trend, but seems to have really waned over the past couple of days?
Well, now we're starting to get the May data, and May is the period of time where we had the peak uncertainty. As we move throughout the next couple of months, I think that uncertainty will start to wane when it actually gets reflected in the economic releases. But now we're living through the actual economic data that played out during that period of time. So we're going to feel it in the next 4 weeks.
And Anne-Marie, you've just kept pointing out that all of these trade negotiations are going to take quite a bit of time. And it's not like we're going to get some sort of resolution. And some of the tariffs have already started to be implemented. And you're starting to see the ramifications of that trickle through.
Right. And when it comes to the two biggest economies, they're now going to be on a path of negotiations that are going to take months. When it comes to Beijing and Washington, we saw that yesterday with this phone call between President Xi and President Trump. For all the other trade negotiations, reading the tea leaves, they're just not done yet. I just got back from Switzerland. They're very far ahead, but they've been given assurances that if they're not there by July 9th, there will be some sort of extension. This is a country of 9 million people. If you can't get a deal done with Switzerland pretty quickly, then what does this mean for Japan, for India, for Vietnam, for Korea? this is going to be challenging, and the timeline is very, very tight.
Maybe it's all priced in. Right now in markets, you're seeing equities higher, futures higher ahead of the opening bell and ahead of that key payrolls print. We're seeing across the board up 0.5% in the S&P and NASDAQ, 0.6 on the Russell 2000, climbing into the open. A sense of a bid into the bond market may be giving some comfort to those worried about the deficit. We have seen a massive rally in the 30-year yield this week, down 10 basis points just in one day, continuing that this morning, 4.87%, pretty much range-bound across the board elsewhere. And then what you can see for the payrolls expectation coming up, 126,000 in the Bloomberg Economic Survey versus 177,000 in the previous one. Steady unemployment rate at 4.2%. Watch the space. That is what a lot of people say is the important indicator. Coming up this hour, Stuart Kaiser of Citi as stocks look to rebound after snapping a three-day rally. Mike Collins of PGIM Fixed Income on rising expectations for an economic slowdown. And Jeff Rosenberg of BlackRock reacting to payrolls. We begin this hour with stocks higher ahead of the May payrolls report. Stuart Kaiser of Citi writing positive trends in economic data. We'll get a test with payrolls, but we expect data to get a hall pass this month given tariff uncertainty and the FOMC in wait-and-see mode. Stuart joins us now for more. Stuart, a very kind way of saying they just don't matter and people are going to ignore them. Am I correct?
Yeah, I mean, they matter to the extent that they're not, outside of a wide range. And I actually think the downside range is far more important. I'm not sure the market would respond as much to an upside surprise as it would to a downside surprise at this point. But yeah, I mean, the Fed, corporate America, everybody is kind of in this wait-and-see mode. I think they've sort of bullied or convinced investors that that's the way to go. And likely you won't get a big response out of this. But again, if it's surprising, particularly to the downside, and to your point, particularly in the unemployment rate, I think that's where you get a little more convexity into the system.
What do you think about the risks heading into the back half of this year, though? Is it more about economic uncertainty, or is there a chance that tech earnings or AI kind of disappoints from an equity market perspective?
Yeah, I think the medium-term risk is growth, whether that's GDP or EPS. We can sort of debate which is more important. If you look back to Q1 earnings, most two-thirds of companies punted, and I don't think the market or investors are going to tolerate that in the second and third quarter. So I think if you were to get downside over a medium-term perspective, it's much more about growth. And, again, EPS, GDP, I think it depends on who you're talking to at this point.
We've been talking about this implosion between Elon Musk and President Trump all day. There's one tweet that we haven't talked about yet, and the fact that Musk actually said Trump's tariffs will cause a recession in the second half of the year. Do you agree?
I think it's basically a toss-up at this point. I think most people are 50, somewhere between 30 and 50%, chance of a recession. The recession view, I think, is, hey, they're trying to pull back on fiscal. You've got this massive uncertainty shock, and you've got tariffs.
Does it make you think twice, though? This was someone that, as of a week ago, was in all of these meetings and lurking around the Oval Office?
It matters. I'm not sure how well Elon can forecast economic growth, so I think that would be, that would be important too. But yeah, it does matter that he's an insider and he had sort of been drinking the Kool-Aid and pushing the narrative pretty hard. So it matters, but this is not something new. I think most people expected, again, the combination of fiscal and uncertainty and tariffs to really weigh on what was already a late cycle economy. So, recession risks are elevated. I think that's why you're seeing small cap, for instance, not perform well, low quality stocks not perform well. And I mean, this is the medium-term risk. Near-term, it's tariffs and interest rates, and medium-term, it's a growth story.
I'm going to trigger you, so just a trigger warning for Stuart Kaiser. There is a feeling that maybe bad news is going to be good news. I can see you already rolling your eyes. That if you get some sort of softer economic print that actually causes a rally into the bond market, which could potentially be stimulative, and talk about Fed rate cuts, and we have seen that kind of behavior over the past couple of days. Do you reject that outright, or do you see that as actually having staying power, since I know you love that phrase and really believe in it?
I think, if the issue on yields was at the 10-year point, maybe we could have this discussion. But if you're getting weaker economic data, that's not really going to help. That shouldn't really help the 30-year point as much as it would move the 10-year point. But you know me, I'm good news is good news. So I think if you're rooting for softer economic data because you want rates lower, I just think it's the wrong way to kind of approach markets.
But if you take it a step further, is the rally that you're seeing at the long end, after so many people dismissed it as something of a risk asset, nobody wanted to buy it, the fact that it's rallying, is it on the heels of some negativity that you think that the stock market's not paying attention to?
For me, no. I honestly think what got the 30-year moving is, one, Japan started to talk about, getting the supply-demand balance sort of sorted out a little bit, and you got a lot of comments from Secretary Bessent also trying to calm down that long part of the curve. The risk there is what they have is talk. They don't have a lot of tools to really rein in the long end of the curve unless you're going to get really extreme about things and talk about QE and pulling 20-year auctions. function. So, I mean, I think what happened there was much more about Japan yields kind of coming in and that spillover risk kind of getting reduced a little bit. Like our view, I'm not a race guy, so me, 2 years is policy, 10 years is growth, 30 years inflation. I haven't seen a whole lot on the inflation side that would have gotten that 30-year down. The other thing we did see is a lot of real money stepped in once you got a 5 handle on the 30-year. So I think you had a little bit of a step in on the demand side, and then you had Japan sort of signaling a little bit on the supply side as well as Besson, and that kind of stabilized it.
It's been hard to find a compass in this market. It feels a little bit like head on a swivel and hard to figure out whether it's the economic data, whether it's what's coming out of Washington, D.C., or whether it's what companies are saying. What is your compass right now, given all of the noise that we're seeing?
Yeah, it's a tough one. I mean, like on the tariff side, I would say things are getting faded on the tariff side from a market perspective. I think most people are using tariffs as a little bit of a buy the dip. I think that remains in place unless the China-Trump stuff really kind of goes off the rails. Yields, to your point, I think yields is actually right now the biggest risk to equity markets because we still need to deal with this budget deal, and I don't think the Musk-Trump stuff really helps that. But medium term, to the point earlier, it's really about economic growth. So, look, typically you always have something say, I come in the morning, I look at this, and this will tell me, kind of how equities are going. And right now, I think that's yields, frankly. I think if you come in and you see 30 years stable, you're likely in a grind higher U.S. equity market. If you come in and see that rate vol and those rates kind of really moving, that's probably telling you you're maybe having a little bit of a risk-off day. I don't read X as much as the average person, so that's a little off to the side.
We're sitting here at the end of the year, the market's up 15% from here. What was the main driver of it, and what are the catalysts that got us there?
The main driver is, I think, pretty simple. We get some sort of progress on the tariffs. The markets have been very tolerant to a lack of concrete tariff progress, I think. And the second would we just don't go into recession. I mean, what we get there is corporate America kind of punted, tariff stuff eased. We sort of avert a recession, and we get some sort of I don't want to say certainty, some sort of clarity. Let's call it that way on the tariff side. I mean, this is. You came into the year, you had 15% EPS growth kind of priced in. That's got revised lower. If we get a stability in earnings, I think we can kind of be okay on that side of it. And we haven't even talked about budget tax negotiations.
But does it concern you that consensus is basically looking at the fact that trade policy will be wrapped up by July 9th?
Yeah, I don't know if there is a consensus on trade policy. You talk to smarter people on trade policy than I do, but
in the market, they basically think that we can move on after this.
That's the hope. I mean, if you look at the performance of stocks exposed to tariff policy, they've kind of round-tripped all their way back. So, yeah, I think there is a fair amount of confidence that at least the tail risks have been trimmed off, and we settle into something that looks like a 10 to 15% effective tariff rate, which I think if we went back to January, 10% was kind of the base case. So we went from 10.
That's what he campaigned on, yeah.
Yeah, exactly. So I think that's what was kind of priced. Obviously, we way overshot that for 4 to 6 weeks. But I do think the market is settling back into the idea that the number is going to be somewhere between 10 and 15. Therefore, the tail risk has kind of been dealt with. So we can kind of, I don't want to say look past that, but I think there's, at least it's been sort of compartmentalized. It's going to be sort of in this range. It's over on this side, and I can kind of focus on other things.
I'm looking at dartboards, and maybe we should purchase one to spruce up the decorations here on the Bloomberg Surveillance Head. Stuart Kaiser of Citi, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Elon Musk has signaled he's ready to cool tensions with President Trump after their very public feud yesterday on social media. Politico had reported the White House had a call scheduled with Musk today to defuse the situation, but sources telling us here at Bloomberg there is no call scheduled. Meanwhile, Tom Cruise has earned a Guinness World Record for a stunt in his latest Mission Impossible movie. Cruise now holds the title for, quote, the most burning parachute jumps by an individual, with the total count coming in at 16. The editor-in-chief of Guinness World Records said in a statement, it's an honor to be able to recognize his utter fearlessness. That is awesome. And on to another awesome story. The Indiana Pacers won game one of the NBA Finals and did so in dramatic fashion. After falling behind by 15 points in the fourth quarter, Indiana stormed back to bring the game within one possession in the final minute. Pacer star Tyrese Halliburton hit the game-winning shot in the game's final second to stun the Oklahoma City crowd. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And Marie, are you willing to challenge Tom Cruise's record
Absolutely
of 16
not. That is
times jumping out of a
incredible.
plane?
Go watch the entire video. I think I saw it like 15 times yesterday, and now I'm going to see Mission Impossible this weekend.
15 times?
It is incredible that he did this 16 times. It is a parachute on fire. It's unbelievable. I mean, there's no one like him.
Incredible is one word. Up next, the morning calls, plus Mike Collins of PGIM Fixed Income with our final countdown to the May payrolls, which may give us a bit of a sense of what kind of ramifications there are from the tariff effects. This is Bloomberg.
Going to be the consequence for U.S. markets. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. 14 minutes until we get that payrolls number, which might give us a sense of just how much of the economy has really been affected so far by tariffs and trade. Heading into that, you do see a lift to markets, ending the week on a strong note, up about 0.5% on the S&P, on the NASDAQ, a bid into bonds. And what Stuart Kaiser just said is really important. Every morning when he comes, he looks at the bond market to see if there is stability. This morning, there is stability. There was a bid. Now it's flat. Now it's a little up on the front end. But what we're seeing is there has been some sort of floor under how far the 30-year bond price can fall, how high those yields can go. Time now for the morning calls. First up, Goldman Sachs lowering its price target on Tesla to $285, pointing to weak deliveries and consumer survey data across key regions. Next up, Wells Fargo cutting its price target on Lululemon to $270, noting the company's rare cut to its full-year guidance. And finally, Loop Capital downgrading McDonald's to hold, citing negative feedback on the company's new chicken strips. Turning now to the economy, May payrolls just moments away. The estimate in our survey expecting 126,000 jobs added and unemployment to hold steady at 4.2%. Joining us now is Mike Collins of PGIM Fixed Income. Mike, thank you so much for being with us. I want to start on this idea that we have seen some weakness come into the economic data over the past couple of reads, whether it's the manufacturing survey, whether it's the services survey. How much do you expect that to be reflected in today's payrolls number?
Yeah, thank you, Lisa, and good morning, Anne Marie. Yeah, we had this dichotomy between the soft data or the survey data and the hard data or the actual data, and now they're starting to normalize, right? You are, as you said, Lisa, starting to see more evidence of the job market in particular slowing, not just the ADP report, but some of the other key leading indicators for jobs, like, the quits rate. Interestingly, if you look inside that ADP report, Lisa, and you look at small business hiring, it's really fascinating. From 2015 to 19, it was on a downward trend. And then you had the COVID thing, and now it's kind of resuming that trend. So it's really been on almost a 10-year downward trend, which is very natural when an economy like ours matures, when the demographics really start to become a headwind. That natural rate, as you were talking about earlier on your program today, of employment, the natural rate of job gains just comes down, from the 200s to the 100s, and presumably over the next year or so, below 100,000. So part of what we're seeing is kind of just a natural maturation of the cycle. But of course, the immigration debate and the trends there are certainly worrisome for the job market.
So, Mike, let's say we see this trend growth in payrolls run 50 to 75,000 as the economy continues to mature, as immigration starts to slow down, but the unemployment rate starts to edge lower. What does the Fed do in that environment? How do they balance out the combination of a low, steady state payrolls growth with unemployment rate that's falling?
Yeah, that's a dynamic we've really been contemplating recently, Anne-Marie, right? If you have less labor, if the labor force is really shrinking, the unemployment rate might remain really, really sticky. And that is a little bit of a conundrum for the Fed. Obviously, they're looking at full employment. But if you have less people and it hurts GDP and growth is really falling, they certainly have to weigh that. But if the job market continues to be strong or in balance like it is today, it's going to be really difficult for them to move, right? And obviously, on the inflation side, it could take, a quarter or two or three to really see this tariff impact on prices. Obviously, you're getting big pushback, as you see in some of the corporate reports today, on higher end spending. I mean, who the heck can afford a $150 Lululemon t-shirt, right, in this economy? But that is going to continue. So the Fed is really on hold. I mean, it's really hard to see them do anything through the end of the year unless you get a big change in the job market, which doesn't seem to be in the cards, or the inflation rate continuing to come down, which probably is unlikely.
Okay, I want to get your take, though, on this unofficial poll I've been doing all day, because everyone still seems to be distracted by the implosion of Elon Musk and Donald Trump. What is the number that then potentially the news cycle can move on to either a really great standout jobs number or a really low number?
I don't know, the standard deviation, the band of confidence, Anne-Marie, around these employment numbers is gigantic. The revisions are gigantic, right? The ADP and the NFP payroll divergence is gigantic, and then you have seasonal trends. So I don't know. I mean, it's got to be, I think, significantly below 100 to see a big move down in rates, and significantly, above 150 to see a big move up in rates. But it's really, you have to look at these numbers over the long term. The long term is much clearer, that we are on a declining trend in job growth, right? And that really is important, and it shows that we're going to be on a declining trend in real GDP growth. And we're moving from a world of 2.5% to 3% GDP, which we've really enjoyed since the pandemic, to one where we're going to probably be between 0 and 2 for the next few years. And let's hope, we stay above 1.
What do you make, though, of continuing jobless claims continuing to nudge higher? Does that give you pause and concern about today's number?
So way back in the day, decades ago, Anne-Marie, when I was a young quant modeling interest rates, the moving average of the unemployment claims and the continuing claims was actually one of the few decent leading indicators for interest rates, meaning as that number continues to creep higher on a consistent trend basis, it generally points to a slowing in the economy, which generally leads to rates falling, right? So I know there's a lot of panic about the fiscal situation in the U.S., the gigantic amount of supply we have, term premiums going up in the U.S., curves steepening in the U.S. and globally. But you know what? What really matters is growth. and inflation, and if the growth side globally and in the U.S. is flagging, that will certainly put a ceiling on global interest rates, on U.S. interest rates, on real rates. So I'm sticking to our guns here. You know, anything 4.5% to 5% on the 10-year Treasury is the real oversold buy zone. 4 to 4.5, where we're in the area right now, and we're at the high end of that, is still I think over the longer term, a relatively attractive entry point for interest rates.
I'm glad you went there, because you talk about global rates, and rates should get a bid if there is slowing growth. What are we talking about? Is it 2 years and 10 years? Is it also 30-year yields, considering some of the questions around what actually is driving that particular trade?
Yeah, I mean, the curve will steepen, right, in that kind of recessionary, significant slowdown scenario, like it always does. I mean, the curves have steepened a lot already in the U.S. You know, we're 100 basis points, twos bonds, which isn't steep historically. And so, yeah, you could make the case, Lisa, that, if the right now there are 100 basis points of Fed rate cuts priced in for the rest of our lives, right? That's it. And it all happens in the next 12 to 18 months. And then, the forward curves are really, really steep, meaning rates are poised to go up, basically back to 4%, from 3 3/8 over the next, 5-10 years. And part of that is just maybe term premium. But, it's, the bonds are cheap here. And 5-year would fall. That's, typically to 5 and 7 years, the fulcrum point where you want to be involved. You want to have some duration in that point to hedge your equity risk.
Just really quickly here, Mike, a couple months ago when we had Liberation Day, or less than 2 months ago, you came on and said the world has changed. Is the world the same that it always has been? And some of these correlations actually are going right back to where they were before?
Yeah, I mean, I'm not a big believer in the correlations changing. I mean, we've looked at correlations between stocks and bonds for centuries, Lisa, and it's zero, right? And the only time they're positively correlated are when you have inflation going up, which we had in 20, 21, 22, and that's why you had that big sell-off in stocks and a sell-off in bonds. That has happened in past periods when inflation goes up. The other time the correlations change is in a recession.
Yeah.
And in those environments, the correlations almost always go negative, meaning bonds rally when stocks sell off. So that ballast to your portfolio that fixed income provides actually works in a recession. And I firmly believe that will be the case if we have a big global recession.
Mike Collins of PGIM Fixed Income, thank you. We are just about 5 minutes away from the May payrolls report. Coming up, BlackRock's Jeff Rosenberg and Bloomberg's Ira Jersey are here, of course. Stephanie Roth of Wolfe Research also alongside us, which is a wonderful thing. As we parse through those numbers, the expectation is for 126,000.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
25 seconds away from that May payrolls report. Heading into it, we see a lift across the board in equity markets, up about 0.5% on the S&P, still about 3% away from all-time highs. If you look at the bond market, we did see a bid earlier this morning. It has faded as there is a grind higher at the front end, 3.94%. If you bleed it through, you do see a bit of dollar strength. Right now, we are looking at the May payrolls report, just crossing. Michael McKee, Bloomberg Economics and Policy Correspondent. What's the latest?
Well, I feel like Kevin Bacon in Animal House. Everything's fine, nothing to see here. 139,000 jobs created. The expectation was 126. We do see a revision down to the numbers for April to 147,000 from 177,000. So the weakening trend continues, but we're not falling off a cliff, as ADP might have suggested. 4.2% for your unemployment rate out to one digit. We'll check on the three-digit numbers. Change in private payrolls, 140,000. That is 20,000 more than what was expected. The net revision over 2 months down by 95,000. Labor force participation rate is a little bit lower, 62.4%, and the U6, 7.8%. Average hourly earnings strong, up 0.4, which pushes the year-over-year rate up to 3.9% from 3.8%. So stronger, maybe a little inflationary numbers on that side. No change in weekly hours, 34.3. I'll look into the rest of the numbers, Lisa, and get back with you in just a second.
What you can see is not really a whole lot of drama, but you do see in the bond market a lift across the board. Michael McKee, stay close. We're seeing in the two-year space in particular up now 5 basis points to 3.97%. That two-year yield definitely getting a lift. When you take a look at stocks, it does turn out that good news is good news, holding on to those gains as we do see those estimates come in above expectations. That said, the revisions taking notice given the fact that there was a downward revision from 177,000 in April to 147,000. Nonetheless, all of this viewed more broadly as confirming that there is nothing falling apart. Stephanie Roth of Wolf Research is still with us. Stephanie, your take on what we're looking at right here.
I think the thing to remember is this is a period of time that was kind of peak uncertainty for the economy given the tariff headwinds. So now looking ahead, we should anticipate that payroll gains are going to remain fairly solid throughout the course of this year. Now, they're going to slow down given the immigration trend, but we shouldn't expect an environment where the unemployment rate is rising significantly and we're in a real layoff situation. We should expect a steady slowdown in the pace of hiring just because immigration is going to be a big headwind, but the economy is going to be largely okay.
What kind of impact will immigration have?
Pretty significant. So, by the way, this is not getting enough attention, but last week the Supreme Court ruled that they can terminate 530,000 visas for people from Cuba, Haiti, Nicaragua, Venezuela, effectively overnight. So this is likely going to show up over the next couple of months as companies really realize they have to check visas. But we're gonna see a notable headwind, bringing the steady state trend in payrolls growth below 100,000. But what we're learning today is that might be in an underlying economy that's still fine.
And what does that do to the unemployment rate?
it brings it down by a couple of tenths.
So how challenging is that for the Fed to cut?
They can. It's going to be a difficult one. If we're in an environment where steady state payrolls growth is running, call it 80,000, and the unemployment rate is steady to lower, and by the way, inflation is running at close to 3%, they can't do anything. They're going to have to just sit and wait it out. And why would they if the economy is just running kind of fine and the inflation is still, risk of certainly running notably above their target?
There's a real question about how much the actual employment rate and the payrolls figure is a leading indicator or a lagging indicator. There has been a belief that companies will hold on before firing employees for a much longer period of time, especially since the pandemic. At what point is this the last thing that's going to fall apart as we see other ramifications to the economy and other sectors?
Yeah, so we need to keep an eye on profit margins. And the idea here is effectively how much costs can these companies push through when it comes to tariffs. So if we're in an environment where consumer inflation is actually running close to that 3%, in a way that could be an okay thing because that means you're not really feeling the burden from a company perspective. Consumers can probably handle a little bit of goods inflation and they're not going to have to do layoffs because companies are able to pass through a lot of that cost.
And this ultimately goes down to the question for the Fed as well. If you do have companies that are absorbing more of it and not passing along the cost as much, it also would be more disinflationary or less inflationary than otherwise, and it would give them the ability to cut rates into what is, by all other measures, a softening market. So at what point is that going to be the base case at a time where you're looking at 2 rate cuts still fully priced into the market by the end of this year?
Yeah, I'm surprised that the market is still looking for 2 cuts at this point. It's probably just sort of the average of all outcomes, right? There's still the chance that the economy tips into recession as a result. I would say if you survey a lot of investors, they're expecting, call it 1 to 2 cuts. But I think the direction of travel here will be in an environment where the Fed and the market are going to start to price in 0 cuts for this year. Maybe towards the back half of 2026, they can cut 1 or 2 more times, but we're sort of running out of time here.
Why is that, given the fact that the economy clearly is weakening according to a lot of different metrics?
Well, it's weakening because we got hit over the head with a tariff headwind and a ton of uncertainty. But now the uncertainty is likely to fade to some extent. Now we understand this whole taco concept, which is silly, but it's true that Trump doesn't seem to want to intentionally tip the economy into recession, so companies can feel better about investing in this environment. They know there's less likely of a chance that the economy actually goes south, in which case, all right, my business is doing okay, now I just have to continue to invest and grow.
Our intrepid economics correspondent has been parsing over the data. Stephanie Roth of Wolf Research sticking with us. Michael McKee, what do you see as you parse through the data?
Well, intrepidly looking through the data, we see that basically it's as kind of forecast. Manufacturing jobs were down by 8,000. Primary metals, we checked that out. The steel mills, 1,300 additional jobs. And fabricated metals, same number, so no impact from tariffs there. Construction up by 4. Retail jobs fell off by 6,500. Warehouses and couriers, people were looking at that because of the idea of pulling forward orders, and we do see slight increases in the couriers, 6,500, a drop of 5,100 in warehousing. Government, though, interesting number from the federal government, down 22,000. Of course, we have to double check and make sure that's not the U.S. Postal Service, which it mostly is, but federal government except the Postal Service down 15.8 thousand. So we're starting to see some DOGE cuts there. The 3-digit unemployment rates, 4.244. That is up a little bit from 4.187, but not worth even worrying about at this point. The reason it looks like unemployment not changed very much is the number of employed falls by 696,000. The number of unemployed rises by only 71,000, but the labor force falls by 625,000. That may be the story of this report. As immigration gets halted at the border, the labor force, if that continues to shrink, will hold down any changes in the unemployment rate for a while.
Yeah, to Stephanie Roth's point, the idea of just generally lower numbers as the immigration trends really shift. Michael McKee, thank you as always. Joining us now is Jeff Rosenberg of BlackRock. Jeff, we take a look at this report, nothing to see here. Markets are taking it in stride, albeit with a little bit of a lift at the front end of the yield curve. What's your big takeaway as you do see numbers tempering, but not exactly falling off a cliff?
Yeah, I think the big takeaway is slowing, but still a strong labor market. And I think that's why you're seeing a little bit of the bond market reaction here, pricing out a bit of that expectations in terms of the Fed, but it's pretty close to expectations, a little bit on the high side. I think the wage number is kind of the most interesting thing. It doesn't seem to be affected by the wage week. So, this is part of the strength coming into it. But I smiled when you asked the question to Stephanie, what is really the forward-looking outlook here for labor markets? There'll come a point where we'll talk about labor markets and this labor market report, and it will be validating a trend that we may be concerned about. And that will be told to us first by what's going on with profit margins. Absolutely agree with that point. It's really the pausing point that we're at here with this market report, not really moving us either confirming the concerns that we had a month and a half ago around a recession, or validating the response in financial markets that, the peak of uncertainty is over. I think we're still in that uncertainty environment, and the data still that we need to validate whether or not which way that economy is going to go is still in front of us. So this is a little bit backward looking and lagging to answer your earlier question to Stephanie.
So Jeff, let's say we're sitting here in a couple of months, and yeah, maybe payrolls growth are still slowing, but holding in somewhat okay. What would be the driving factor? Is it the reconciliation bill? Is it that tariffs are having less of an impact? What's the upside story to the economy here?
Yeah, and I think it's what you were highlighting before about whether or not this is the peak uncertainty is behind us, and its impact on decision making is not as great as we might have feared in the middle of April. And so I think that's really the determination, is what impact does all this uncertainty, which I think we still have. We haven't resolved a lot of that uncertainty. We could debate that point, but really it comes down to not what do we think about the uncertainty, but what do we do about the uncertainty? Do we press ahead and just make decisions, make investments, hiring, as if nothing had happened? Or is there a cooling effect on all of those decisions, whether they're on the business side or on the consumption side? That's what's going to drive that economy. It's going to drive the consumption side in terms of demand, and it's going to drive business confidence in terms of what we see in terms of investment. And that's, I think, what the narrative is going to be 2, 3, 4 months from now.
Well, do you think the business community will just keep treading water? How do you make those decisions? I mean, just moments ago, Peter Navarro, a trade aide to President Trump, is telling reporters that the China meeting is expected in 7 days. So in a week's time, we could be dealt with a fresh blow of uncertainty, Jeff.
Yeah, I think the honest answer is we just don't know, because the new data that's coming out, whether it's the challenges from the legal perspective, whether it's the change in terms of the negotiations, what is actually in those negotiations in terms of how much they relieve the uncertainty, we just don't know. And I think there is a cooling effect in the interim. It doesn't show up because the data is still lagged, so it'll show up in the next couple of months. So I just think we don't quite know on the trade impact.
Given the lag, do you think then the Fed is going to be behind the curve? I mean, Elon Musk, an insider who's now on the outs, was saying yesterday that Trump's tariffs will mean a recession in the second half of the year.
I think the Fed has been very clear in their communications that the headline is wait and see, and that the economy is in a good enough position where they can adopt that approach. I think if there's one thing to this report today, it kind of validates that approach, right? We're not seeing an aggressive move in terms of the slowdown impact in hiring in the economy. We're not seeing a huge acceleration. I do think there's some strength, some lingering strength there in wages, but not enough to really press on the inflationary concerns. And so the Fed's in a good spot here to wait and see. Will they be lagged? Yes, this is kind of the, impact of moving from forecast dependence to data dependence, is that the Fed has to be reactive. And so they'll be lagged. The issue for the markets will be, will they aggressively catch up if they are indeed, behind the curve in the event that the trade and tariff uncertainty, leads to a bigger slowdown? Then they're going to have to get more aggressive. That's not priced in to the bond market, as we were talking about. It's only 1 to 2 cuts because it's not yet showing up in the data.
I want to take a step back and talk about what you and Stephanie both brought up.
that this labor market information isn't necessarily going to be as tradable as some of the earnings data that we get with respect to profit margins. And I wonder if there's something of a paradigm shift where we were so data dependent and every economic indicator that came out for the past couple of years was a huge tradable moment that was going to give some sort of insight into what the Fed would do. Is that era over? And are we now earnings dependent, not necessarily when it comes to figuring out how much money they're making, but what companies are doing with what we're hearing about in the mess in real time in a way that this data cannot tell us anymore, Jeff?
Yeah, I mean, there's a long history to the payroll report in terms of moving the bond market. Has it lost some of its efficacy? I mean, certainly, we've come out of this period where inflation has been the bigger driver. Clearly, that has been the story of the last couple of years. And so the payroll report isn't really the kind of preeminent data release on inflation. It has an important component with regards to wages and wage inflation, as I was just highlighting. When you think about kind of the demand side shocks that we typically associate with recessions, the payroll report can be, more confirmative on those trends and solidify the expectations for the Fed. That's where the linkages and the importance to the bond market comes from. But when the issues are more supply side, and we can kind of think of tariffs and the tariff shock as more of a supply side, it has both elements of the supply side and demand side. But when you think about economic shocks driving financial markets that are more from the supply side, yes, the labor markets kind of lose their primacy of being kind of the preeminent data release that we focus on.
Jeff Rosenberg of BlackRock, thank you as always for being with us and giving us some insight, pointing to that key metric coming out of the report that the May average hourly earnings rose 3.9% year over year. Stephanie, versus the expectation of 3.7%, even with a work week that stayed steady.
Yeah, I mean, this is an environment where the labor market is holding up okay. We should expect wage inflation to run around 4%. Throughout the course of this year, we might actually see wage inflation run a little bit above 4% as we see a real tightening in the blue-collar labor market. So this could be the start to a trend where we start to see a bit of a tightening, even though the headline jobs numbers are, notably are starting to move below 100,000. This could be a really complicated backdrop from the labor market perspective, and we're just going to have to get used to it.
To parse the complications, Ira Jersey of Bloomberg Intelligence joins us now. Ira, there is a feeling that the Fed is permanently on hold, and you are seeing a reaction in bond markets that reflects that. Do you think that this was an unabashedly positive report that would fuel ideas of maybe the Fed needs to push back their next rate cut?
Well, we've been thinking that the Fed was going to cut not until the fourth quarter at the earliest this year, and because of exactly what you just said, Lisa, which is that the job market is fine, right? So if you think about the two mandates that the Federal Reserve has, we haven't yet seen a significant uptick in inflation because of tariffs, which may be coming and might not be, but at the same time, the labor market hasn't cracked. So unless you wind up seeing a significantly weaker labor market, which would mean sub 100,000 payroll prints plus slower wage growth, like you just noted, we have aggregate labor income. So when you take those weekly earnings numbers, add to that the growth of the number of people with jobs, that's running at 5% year on year. That's nowhere near recessionary levels. So unless you see a significant slowing in this, in the jobs numbers over the next couple of months, the Fed's probably not going to cut until November or December at the earliest.
We did see revisions, though, for the prior 2 months. Does that concern you at all?
Concerns a little bit, because that is the type of thing that happens toward late in the cycle or early in a cycle where you wind up seeing revisions either downward like we just did or upward if you're coming out of a recession. But when you take all the averages and you look, we're still running over 100,000 payroll growth, which is above the replacement rate for the labor force. So as long as we're running above the replacement rate of the labor force, the job market seems relatively tight. And as important, or more important, or at least as important, I should say, is those wage data, right? And when you have hourly earnings growing at 3.9% year on year, and you have a 0.4% month on month growth, that's fine, right? That's showing that the economy and the labor market is still reasonably tight, and you'll continue to have spending growth. So top line numbers for a lot of companies, for example, might still be okay. Now, bottom line might wind up contracting because of the tariffs, but at least from a revenue side, the consumer still has money to spend.
And that is the ultimate question. And Ira, before we let you go, there is a question about if the consumers are still getting paid more and their wages are going up, does this mean that it's not just a one-time price shock, but that potentially in response to increased costs from tariffs and other supply chain potential inefficiencies, that companies could continue to raise prices into the future, that longer-term inflation that really is one key question?
Well, that's very likely, and one of the reasons why you've continued to see inflation, particularly in the services sector, which really has been driving inflation over the last 2 years, is the wage input to those prices. And with wages growing at 3-ish plus percent, then businesses need to pass that along, and that's one reason why I think you've continued to see the service sector contribute so heavily to inflation and inflation gains over the last couple of years. So, you know, this is the same as we've seen basically for the last 18 months, and doesn't seem like it's slowing very significantly, not yet anyway.
Ira Jersey of Bloomberg Intelligence, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Recapping that jobs report, May payrolls topped forecasts with the U.S. adding 139,000 jobs, while the unemployment rate held steady at 4.2%. Data for the prior 2 months were revised downward by a total of 95,000 jobs, signaling employers are cautious about growth prospects as they weigh the Trump administration's economic policies. Meanwhile, President Trump and China's leader Xi Jinping have agreed to further trade talks aimed at resolving their disputes over tariffs and supplies of rare earth minerals. The two spoke yesterday by phone for 90 minutes. Senior U.S. trade advisor Peter Navarro spoke to reporters just a few minutes ago and said the talks would happen within the next 7 days. And four-time NFL MVP Aaron Rodgers is heading to Pittsburgh. The free agent quarterback agreed to a one-year deal with the Steelers, ending months of uncertainty around the future of his career. The 41-year-old is coming off 2 seasons with the Jets, who the Steelers will face in week 1 of the upcoming season. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, for this morning. Have a wonderful weekend. Up next, setting you up for the week ahead, this is Bloomberg Surveillance.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This morning, good news is good news in equity markets, building on gains from earlier after a payrolls report that beat expectations. We did see right now across the board up about 0.8% on the NASDAQ, S&P. Russell flying up more than 1.2%, counting down to the opening bell, 1:30 p.m. Eastern. President Trump signs executive orders. Monday, Apple's Worldwide Developers Conference. Wednesday, we get CPI. Thursday, PPI and another round of jobless claims. Plus, Tesla's robotaxi launch in Texas, which has new focus on it. Stephanie Roth of Wolfe Research, thank you so much for being with us for the hour. What's your takeaway from this payrolls report?
Yeah, I mean, the data was fine. It tells us the labor market, the fundamentals are pretty solid. And by the way, this was the month that should have generated the most uncertainty from an employment perspective. Now, the expectation is Trump's not going to intentionally cause a recession as a result of his tariffs. That said, our medium-term outlook is the economy should be fine. And the risk to growth next year is that we could actually see above-trend growth in 2026 as the reconciliation bill starts to hit and the impact moves from tariff headwind to reconciliation bill tailwind. That said, over the summer, we might be facing some risk for markets. So we have labor data that might not look as rosy as today just because immigration will have a headwind. There's going to be seasonal factors. The tariff negotiations are going to start heating up. Bond yields, maybe volatile as we talk about reconciliation bill and then concerns around data. So in the near term, market risks are a little bit elevated, even though over the medium term, the economy should be fairly solid.
Stephanie Roth, thank you so much for spending time with us this morning. Stephanie Roth of Wolfe Research, excuse me. Thank you. And Anne-Marie, you had this quiz. It didn't meet it. It was not a number that really superseded all the other drama.
The number was kind of boring for the drama. The drama's heating up, and I'm sure everyone will be distracted again today by Elon Musk and President Trump. But the most important headline to come out this hour was that Peter Navarro says within the next 7 days, you're going to have the Chinese and U.S. delegations sitting down. To Stephanie's point, you have the heating up of these trade negotiations, and potentially we could see more of the parameters of what a deal could look like between these two economies.
We'll carry that conversation forward. Coming up on Monday, Keith Lerner of Truist, Abby Yoder of J.P. Morgan, Wei Li of BlackRock, and Vinu Krishna of Barclays. But first, coming up at 9:30 a.m. Eastern, Anne-Marie will get to the White House's reaction to the payrolls report from Secretary Lori Chavez de Remer. Don't miss that as they discuss the road ahead. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, and we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
All right, a rally as they maybe make up 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett. Katie Greifeld is on assignment, and Bloomberg Open Interest starts right now.
Slow but steady, the U.S. added 139,000 jobs in May, beating Wall Street's consensus. And Tesla shares are regaining some ground as the war of words de-escalates between Elon Musk and Donald Trump. We'll tell you all about it. But the day is young and nothing is certain, with reports saying that there are no plans for a makeup call between the White House and Elon Musk. Shonali, what are you... Well, I know you're watching.
I am watching Tesla because even though there might not be a call, Musk is stepping back from that ledge a little bit here. And because of that, you have Tesla a little higher this morning, only about 3.5%. You saw that public spat play out between Elon Musk and Donald Trump, President Trump play out. Those tensions have cooled after Musk saw his net worth drop $34 billion yesterday. And as Matt has pointed out to me, not only did they lose $50 billion in market value yesterday, but almost $200 billion in 2 days.
I mean, that's really all I'm watching as well, but we have to show you other stuff. So here is Broadcom, a chip supplier to companies like Apple. It gave a tepid sales forecast outside of AI chips, and as a result, the shares are down 3%. Shonali, we are focused, obviously, on this Musk spat, but today, the granddaddy of all economic statistics was served to us, and it was going in the right direction.
Yeah, it looks good for jobs. We're going to talk about that May jobs report. Matt had mentioned the U.S. added 139,000 jobs, and that beat expectation. The labor market continues to surprise to the upside, but there are signs of moderation. Take a listen to Stephanie Roth of Wolfe Research.
This is a period of time that was kind of peak uncertainty for the economy, given the tariff headwinds. So now looking ahead, we should anticipate that payroll gains are going to remain fairly solid throughout the course of this year. Now, they're going to slow down given the immigration trend, but we shouldn't expect an environment where the unemployment rate is rising significantly and we're in a real layoff situation. We should expect a steady slowdown in the pace of hiring just because immigration is going to be a big headwind, but the economy is going to be largely okay.
All right, Stephanie Roth there. And by the way, President Trump is tweeting right now. He just posted in all caps, "America is so hot. 6 months ago, it was cold as ice. Border is closed. Prices are down. Wages are up." Joining us now to talk more about that, especially the average hourly earnings part of it, is Michael McKee. He's our international economics and policy correspondent, and he's not wrong. Month over month, wages increased.
He's not wrong. Wages increased, but year over year, they didn't change. So I'm not sure how important that is in the long run. 6 months ago, the economy was in pretty good shape. So we'll just dismiss that and give Stephanie Roth a promotion to playing the role of Kevin in Animal House. All is well. Kevin Bacon in Animal House. All
Some of
is
these
well.
references, Mike, are hitting home with me, but they're flying right over Sonali's head.
All right, we got to get her to watch the movie. 139,000 jobs created, better than expected, and that is a sign that while things are slowing down, they're not slowing down too much. And as Ms. Roth pointed out, 4.244% on a 3-digit rate of unemployment is still very good. It is not anything that the Fed is going to have to worry about. You can see there the average hourly earnings numbers that Matt was talking about. Now, 93,000 jobs taken away over the last 2 months in March and April. That does also feed into the narrative that the economy is slowing but not falling off a cliff. If there's one takeaway from this that I thought was interesting, it was the drop in the labor force, 625,000 drop. That's the biggest since 2023. And the question we have is that because the administration has shut the southern border and we are not seeing a lot of illegal immigrants come in who then get into the labor force and take jobs? We did see a big drop in the number of people who got jobs in the household survey, which is one reason the unemployment rate stayed about the same, but it's an unanswered question at this point. And then finally, what were the biggest movers? Well, federal government finally shows some drops of 15,800. We've been waiting for that because of Doge. And then the rest of it is about as always. Healthcare and social services, the biggest gainer, 78,000. Food services, a healthy 30,000. And manufacturing falls by 8,000, which was hinted at in the ISM numbers. So the economy at this point is hanging in there. We're waiting to see if there are tariff effects, but we're still waiting for a lot of tariffs as well. So the two things combined has, well, put it this way, everybody can go back to worrying about Musk and Trump today and not the labor force.
That's what Matt really wants to talk about. Mike, we thank you so very much. That is Michael McKee of Bloomberg. We're going to be looking forward to the CPI data next week after we saw that wage report as well. Let's bring in BlackRock's Chief Investment Officer of Global Fixed Income, Rick Reeder. Rick, we got a lot to talk about with you today. I do want to point out, it's interesting, you see yields across the curve quite higher. You see the 2-year flirting with 4% again, the 10-year flirting with about 4.5 nearly again, not quite there yet. What do you make of the report this morning and the direction of travel?
So I think there are a couple of things that are you know, as soon as that report comes out, there's two numbers that I look at, and they're a little bit different than others. Is healthcare and education, leisure and hospitality. There's 139,000 jobs created. 135,000 of them came in those two sectors. We have a service economy. You know, the rest of it is sort of a little up, little down, pretty flattish. Yeah, an economy that's doing okay because the service economy is just doing all right. I have to say, I think that we'll start to see healthcare and education come off over the next couple of months. You need to see that, though, to open the door for the Fed to start cutting. But, you know, what markets are doing, they're repricing. You got inflation still above target, and you got an unemployment rate of 4.2-ish%. That is, you know, that's coming along okay. I mean, and, you know, you're not seeing the softness of any savings. Listen, when you say there's no softness, you are seeing some things about, you know, you look at the quits rate, the leavers, the job leavers. You look at the job postings, although JOLTS was okay, you saw the Indeed down a bit. So we are, if you say where we were versus where we are today, the trajectory is slower. The labor market is much more in balance, but it's certainly not deteriorating by any significance. So just, you know, if you're the Fed, you're just sitting on your hands for a while.
I mean, the service economy is the economy, right? I mean, Alan Patrikoff was here a couple of weeks ago, and he was saying manufacturing is something like 8, maybe 9% of U.S. jobs. It's probably not going to go much higher, even if we see some serious reshoring, is it?
So, you know, I think, and we think we talked about last month, the month before, you know, people have been calling. Remember, we were pricing in the Fed cutting 5 times this year. The Fed would have to go 50 in June, and like this craziness. And it seems like every year, people say the economy's going into a recession, it's a deep recession, because I think people look at the analog from 20, 30 years ago, and when you had a more commodity-oriented, manufacturing-oriented economy, service economies generally don't go into a recession. Now, that being said, I did think you would get a month or two of a divot as in the economy because of companies would pull back on CapEx and R&D and see some pause there. But, you know, you're seeing a little bit of that. But, you know, look at these earnings numbers. You know, most are pretty good. Anything around, you were talking about Broadcom. You know, you look at what's related to AI. Boy, I thought those numbers were pretty good for AI. Everything else a little bit soggier. So Anyway, I think the service economy, I think people grossly underestimate the U.S. resilience because it is a service economy.
You know, speaking of the service economy and the point that it's been holding on so far, there's still a lot of uncertainty out there, not just in the job market, but of course with inflation, the tit for tat with tariffs. This week was another kind of wrench in the up arrow story. Right now, we have less than 2 rate cuts priced into the market this year. I recall a conversation a couple weeks ago I had with Rob Kaplan. He thinks maybe 1, maybe 0. Do you think that this is economy in need of rate cuts realistically, Rick?
So over the long term, I unequivocally think the Fed needs to get that rate down because the debt service in the country will be an issue if we don't get it. We keep rolling Treasury bills at elevated rates, so it's increasing the cost of debt to the country. And plus, you take the size of the deficit. So I do think they've got to get that rate down. The question is, when can they get it down? And today, I mean, I think it's really hard. Listen, I still think, and I've said this 2 months ago, I still think they would like to get a couple of cuts done this year. And you got to see that deterioration in some of the labor conditions to see that. But I think they'd still like to get a couple done, and then you get into 26 and maybe have the window to get it down with some lower inflation numbers. By the way, things like productivity, automation kicking in, that'll start to bring inflation down. But, you know, for today, for now, pretty hard to have them do that. But I think they should. It's just, I think it's going to take a bit of time for that.
Rick, hang with us. We're going to talk more with you about tariffs, taxes, and BINC. But right now, I want to turn to the other big story of the day, the public battle that we saw erupt yesterday between Elon Musk and President Trump. There are signs of truce in the drama that unfolded on live television and on Twitter in real time. The dispute began over Musk's displeasure with President Trump's big, beautiful tax bill a few days ago, and it escalated into threats against political and business ventures. Jeffrey Epstein was brought up. Joining us now from Washington, D.C., senior White House reporter Josh Wingrove. Josh, it does look like Elon Musk backed down also publicly yesterday in tweets to, well, one tweet to someone that nobody's ever heard of, and then one tweet to Bill Ackman. But President Trump doesn't appear to have a phone call scheduled for Musk today, as Politico reported earlier. Is that the case?
Young love, guys. It's hard to see it break apart like this. You know, we all remember feeling so strongly at that age. The reporting right now from Politico is that there may be a call between staff and Musk. Our understanding that the president himself and Musk will not be speaking today, and the sort of détente seems to be coming more from one side, from Musk's side, than from Trump, who's like, you know, so over it, to be a little tongue-in-cheek this morning. Apparently, they're trying to figure out where to go from this. You know, on a more serious note, there are open questions here. So Musk has backed off the threat of the space program changes that would raise a lot of questions about the future of the International Space Station. Trump, though, has not really backed off, nor has he advanced his threat about taking a look at Elon's contracts and whether SpaceX or, you know, any of his companies that have federal contracts. So that's sort of a weapon that's sort of hanging in the air here that we don't really know whether Trump will reach for again today. Wall Street Journal reporting that Trump is looking to ditch his Tesla. Remember when he set up that de facto Tesla dealership on the south lawn of the White House? Bit of an unusual moment. He bought one of them, a red one. It's been sitting in the parking lot of the White House more or less since then, still sitting there today, according to some other colleagues of mine at other outlets. So Trump is maybe that's the way he's looking to respond to this, getting rid of his Tesla. But, you know, this back and forth, these two had, you know, a very public-facing alliance, you might call it. You know, I don't even know if it was a friendship. I don't know that anyone knows that. But it really has gone off the rails, obviously. Musk looks like he's more willing to patch it up right now than Trump is.
Well, Josh, you know, and Matt, how much did Musk give to the last cycle again? I feel like
$290 million.
Right. It was a lot of money, and now he's talking about the idea of another political party, and there's a lot of
money to us.
Yeah, a lot
it's
of money.
It's not nearly as much money to him, right?
Right, to him.
It's actually a pittance.
It's certainly a lot of money for the American public. And Josh, I'm really questioning what the intangibles are here. Yes, there are real things that the president could take away from Musk, but there's real havoc that Musk is causing when it comes to perception of certain plans of the Republican Party as well. He says he was going to back off on giving, but are there other ways he could look to influence the tax bill and then, by definition, the midterms too?
I mean, he's trying to get the tax bill derailed right now. I don't see a lot of appetite for that. You know, Musk has a lot of influence and will have a lot of influence. One of his tweets yesterday was, look, Trump's only going to be in office for 3.5 more years. I've got decades left. Republicans should be careful about whose side they choose. But, you know, it's a pretty empty room of Republicans right now who are lining up to align themselves with Elon Musk in a fight with Donald Trump, because Donald Trump can steer your primary very quickly in a way that Elon Musk's money can't, or at least as of now, they don't think it can. So, you know, we'll see whether whether Musk tries to start throwing his weight around in the Republican Party on that. I think it's just too soon to say, but derailing the tax bill, you know, forcing these actual conversations about impeachment, I think that's very far-fetched at this moment. There's just zero appetite among Republican lawmakers in Washington to go down that road, and so Musk might not have that immediate clout here. Trump seems to have a grip on the party.
Josh, I want to do a quick lightning round with you. So just yes or no answers, right?
Uh-oh.
Was there an EV mandate?
Kinda.
Did Trump need Elon Musk's support to win?
He benefited from it. I don't know that he needed it.
Did he ask Musk to leave, or did Musk's time just run out?
That's the multi-billion-dollar question. Right?
Are there really unreleased Epstein files?
I thought you guys knew that stuff. You know?
There seem to be so many questions here that are juicy enough to dig into, but nobody really wants to wade there. Josh Wingrove, thanks very much for your time. Appreciate it. Reporting from Washington. We're going to be back in just a moment with BlackRock's Rick Reeder after the break. This is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
We're going to give you a check on those futures ahead of the opening bell. We are ending the week strong. There was strong economic data. The S&P 500 up 0.9%. A little bit of peace in the office, in the Oval Office for now, sort of, kind of. We are looking at yield soaring as well, not pictured here on the heels of that economic data. But the small caps also just ripping despite those higher yields. We are back now with BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. Now, here's the thing. With Elon Musk's rift with the president, those Doge cuts that everyone was counting on to save all this money in the U.S. government, let alone the direction of the tax bill, how do you feel the prospects of those savings now?
Well, I don't know that that was necessarily instigant to really move the spending. Now, listen, when you look at the bills going through, listen, as a bondholder, you certainly would like to see greater spending cuts. You know, I think we're going down a path of the deficits are too large. What has to happen is we have to outgrow the debt in this country now because we're clearly not making the cuts in spending. Listen, I'm pretty enthusiastic about we are going to grow as an economy. And I actually think as you get in the back half of the year, I am sympathetic to the idea of deregulation, easier permitting, et cetera, will create some motivation to growth. And as I said, I think the economy and the spend on AI and data center and energy, power generally is pretty good. So anyway, but what it does is it says, you got one side of the ledger, that's the spending and the costs. And so now that one is going to be tricky for a bondholder. That one is tricky, particularly for long end interest rates. We just have to now count on the growth. It's got to be better. I have some sympathy for, I think it will happen. But anyway, I always hate when you can only use one side of the ledger, and that's where I feel we are today.
Howard Lutnick had a now kind of infamous banana back and forth with Representative Michelle Dean, and he seemed to be insisting that tariffs are a negotiating tool, and eventually they'll be down to zero. But the CBO said the tariff revenue could be $2.8 trillion over the next 10 years, and it does seem like Donald Trump for decades has wanted tariff revenue to replace tax revenue. So how do you think it's going to turn out? And, if it is revenue additive, isn't that good for reducing the deficit?
So, this is all tricky in terms of the elasticities of where it comes from, which countries, et cetera, how's it implemented. Listen, at the end of the day, there is revenue coming in, and when you look at the tax cuts and then you have most of the cost cutting that's back ended to 2029, et cetera. So yes, you are bringing in some revenues. That does create some offset. There's ambiguity around who pays for it, or debate or negotiation of who pays for it. But yes, it's real revenues. By the way, you've seen it come in. In the last few weeks, we have seen those revenues come in, and they're not nothing. It is real money. So listen, it's it's tricky to figure out elasticities. And I will say a couple of things around the U.S.-China dynamic for markets is going to be a big one because of the U.S. as well as Europe have functionally outsourced manufacturing to China for years. How does that, how do you transition that? How do you transition things like apparel and other places where trade is so acute between those countries? So anyway, we've got a keen eye on the China one. That's the one that's going to be a big deal for markets.
Now, I'm really curious about how you're playing the credit markets more largely. If you look up your ETF on the terminal, BINC US equity, you can look up the holdings, and they're really interesting right now, I've got to say. I think I'm seeing a lot of Fannie and Freddie in here, Rick, in addition to high yields. I'm wondering if you can give us some color behind the trade.
You're pretty laser focused on that. Is right. Listen, I think this is a year, think about today, I don't think we're going to make any money of any significance in interest rates. What we're doing in the portfolios, we're running just under 3 years of interest rate exposure, 3 years of duration. Income works, and what we're trying to do is build a portfolio that's stable. We have added some mortgages, but what that does for us, it's got some spread to it, it's got some yield to it, and it keeps our credit quality high, keeps our liquidity in the portfolio high, but it lets us balance things like securitized assets, high yield. I like high yield, I like being a lender in Europe. If we can swap back assets in Europe, credit, high yield, investment grade, the portfolio is yielding about 6.7% today. And by the way, it's well into investment grade rated. Now, that's a pretty good portfolio as long as you can balance quality with where you're getting some yield, keep your liquidity high. It's a pretty, listen, I think this is as good an environment as I've ever seen to try and generate income in a portfolio and do it with stability. You don't have to be way out the yield curve and take the volatility like you're seeing today. You don't have to be way down the credit spectrum in a triple C high yield, and just, you know, keep good quality, diversify it, and, you know, keep a really nice yield. I mean, think about most pension funds, endowments, foundations. If you can hit 7 in stable fixed income, it's a pretty good opportunity.
Love the detail, great intel. Unfortunately, we don't have time for a lightning round with you, Rick, but thanks so much for joining us. BlackRock's Rick Reeder there talking about the iShares Flexible Income ETF, BINC, BINC is the ticker. Still ahead, the view from the White House. Labor Secretary Lori Chavez-DeRemer joins the show with Anne-Marie Horton. This is Open Interest.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Horton in Buenos Aires, Argentina, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Open Interest. I'm Matt Miller. Quick check on futures ahead of the opening bell, and we're showing some gains here as Tesla powers the S&P higher, futures at least, up 0.9%, up 1% on the NASDAQ. Maybe investors don't want to be even this weekend. They're going in long.
Yeah, they're seeking world peace, at least for the two most powerful men in America. Now, some more movers on our radar. A few other things that are mattering. We were talking about Tesla rebounding, now up 4.4% pre-market, right into the open, following yesterday's massive sell-off. We're going to speak with Pierre Farragut at the open. Circle still soaring, Lululemon down. Stick with us. We're going to bring you all those stocks coming up at the opening bell. This is Open Interest.
this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are seeing a serious rise in futures. Right now, a 1% gain on S&P futures and on the NASDAQ, powered at least in part by Tesla after its massive collapse yesterday. Actually, over the past 2 days, we saw Tesla erase $200 billion in market cap because of a very public feud between its CEO, Elon Musk, and the President of the United States, Donald Trump. Opening bell on the New York Stock Exchange, the Generation Essentials, TGE, ringing the bell there to celebrate their IPO. Down at the NASDAQ, you have Omada, which is like a virtual healthcare stock. They brought the whole family. It's exciting, but no one cares about anything today other than the U.S. economy, right? We got the jobs numbers out, the granddaddy of all economic statistics, and this massive feud between Elon Musk and President Trump.
That feud that really roiled Tesla stock yesterday, now giving up a little bit today as Elon Musk really backs off the ledge here. Tesla is almost 5% right now, 4.7% higher at the market open. Remember, they lost $150 billion worth of market value yesterday on that very public SPAC. Tensions have cooled. Musk saw his own net worth drop $34 billion yesterday. Now, Wedbush analyst Dan Ives was on Bloomberg earlier. He does not anticipate this spat to last long.
It's like a frenemies in junior high school that's essentially going on between Trump and Musk. This is something where the friendship, it doesn't end. In other words, I still believe that this will be resolved potentially by the end of the day or by the weekend. And it's not our view that this changes the regulatory landscape for Musk when it comes to autonomous and the broader vision.
New Street Research Global Team Head of Technology Infrastructure, Pierre Ferragu, is a Tesla analyst and joins us now. And Pierre, this has to be one of those things. I mean, like, even for Elon Musk, it's pretty insane to go up against the president of the United States, especially when that president is Donald Trump. What do you make of it?
Well, you have to recognize, like, Elon is very, very sticking to his style and his character. Number one, he feels very much empowered. He's not afraid of taking any fight, even against, like, the president of the United States. And that's not uncommon. He took that kind of fight with, like, the previous president as well. And then you have also to remember that this is the way Elon Musk, reacts. That's his nature, and that's also the way he schemes up things, like in his business, in the way he manages, influence on the system. He is very, very good at navigating the public opinion, and so the situation today is, bringing this fight on air and in social media and things like that. Part of that is a natural reaction of two people with very, very strong characters, very, very strong independent characters. And it's also a game between the two around, I think, the question that you mentioned, the U.S. economy. Can we have this big bill and like an increased spending, increased deficit or not? And also, of course, like the fact that the influence of Elon Musk in the administration came to a point where there was probably a bit of a pushback on the political side of the administration.
Pierre, to the extent that at least part of this fight was around electric vehicle tax credits, for Elon Musk, is that fight worth it?
So that's very interesting that you say that, because that's an extremely unsubstantiated claim that everybody is doing this morning, making this morning, including Grok and like GPT-4o, but that's not true. Like, we've all known for many years, people who cover Tesla and understand the economics of Tesla, Elon Musk has claimed for many, many years that electric vehicle incentives are not really beneficial to Tesla, and that Tesla would actually be doing much better without them. So I don't think there is like any weight of these electric vehicle credits going away in the reaction of Elon Musk. I think the reaction is much more about his very well publicized concern about balancing out, the spending of the government, reducing the spending of the government. And this big, beautiful bill did quite the opposite.
Pierre, I really appreciate you joining us today at such short notice. Unfortunately, we have to run because we're going to talk to the U.S. Labor Secretary, but that was Pierre Farragut there of New Street Research. You know, Shonali, I was doing some kind of back-of-the-envelope calculations yesterday when Tesla was still worth over $1 trillion. So I looked at the entire auto industry outside of Tesla. Ford, GM, BMW, Mercedes, Volkswagen, Toyota, Honda, all of those together are worth $615 billion in market cap. Combined. And each car that they sell is worth about $16,000 in market cap. Now, Tesla is worth $1 trillion, and each car that they sell is worth about $600,000 in market cap, or was until yesterday's drop.
Yeah, so it's crazy. Tesla had lost a lot of value this year already as well, right? So you could hardly say that this year Trump was really good for it anyways.
That's true. That's true. Elon Musk has lost $100 billion since Trump came into office, just from the moves in the market cap of the caps of the company that he owns. But I just think it's interesting that Tesla is worth more than just car sales. There's something else, and Pierre would have said, and Dan Ives would say, anyone who follows the company, there's something more, a lot more than just car sales here.
And in the next hour, we're going to be covering a lot of more of his private enterprises as well, Starlink and others. Now, we are going to switch conversations. We're going to switch gears. We're going to go to Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Surveillance, with an interview with the Labor Secretary. Listen in.
Well, we'd like to bring in the Labor Secretary now, Lori Chavez de Rima. Thank you so much, Secretary, for joining us as we are on the heels of this May report where the U.S. added 139,000 jobs, beating estimates. But I would love to start with the decline in the size of the labor force, down 626,000, largest drop since 2023. Is this because the administration has shut down immigration?
Well, thank you, Anne-Marie, for having me. We are excited, 139,000 new jobs, and that President Trump, with his dedication and his leadership, really has beat expectations for the third month in a row. Our goal is to grow this economy and grow this workforce, and the president has done a wonderful job in accessing companies to invest in the workforce, and we're seeing it across the country. So while jobs are continuing to grow, and we might see a decrease at the federal level, which is another great thing that we've seen 22,000 jobs leave the federal public workforce, and we're seeing it at the local level. So there's a lot to look forward to. There's a lot that we're excited about, and we couldn't be more excited for this economy in this third month in a row of a growing jobs report.
What do you think is behind, though, the drop in the size of the labor force?
Well, what we want is to grow that labor force. We're seeing increases in construction jobs. We're seeing increases in transportation and in healthcare. While the manufacturing sector is holding steady, what we're excited about is the focus that the president has on the skilled workforce. Again, my part of this equation is to grow that workforce. And as we transition through this process of onshoring, and the president has done a wonderful job in negotiating some of these tariff talks, tens of trillions of dollars are being invested. This workforce is going to continue to grow.
The unemployment rate remains steady. A lot of economists will point to the fact that potentially it's for the wrong reasons, not because jobs are plentiful, but because workers are dropping out. Are you concerned that too many workers are dropping out, especially in some of these areas that are mostly filled with immigrants?
Well, certainly what we have seen in the last few months is that native-born Americans are the ones where the job growth is happening. That's exciting for the American people. We want to make sure that we're protecting the American worker first, and we want that labor participation rate to go up. I will tell you, unemployment is holding steady. That is a good thing for the American economy. We'll continue to focus on that. As the president's executive order, with 1 million apprentices across the nation, and also through an executive order that we're going to have the skilled workforce with AI, I'm telling you, and I'm confident that that workforce is going to continue to grow, and we're going to see these numbers continue to climb and unemployment rate continue to drop.
Do you foresee wage pressures potentially reemerging to fill jobs if there are fewer immigrants coming to the United States, which is a policy of this administration?
Well, I can tell you right now that, wage growth, hourly wage growth is up almost 4%. That's great for the American people, more money in their pockets. And with this one big, beautiful bill that the president is focused on, we are going to see no tax on tips, no tax on overtime. Do you know what that does for a family of 4 who possibly can put more money in their pocket? I can tell you this, one big, beautiful bill equals one big, beautiful workforce. That's what I'm focused on, and I'm going to continue to work hard, get around this country, and deliver for the American people what the president promised them that he would do.
I guess my question, though, is if we have wage pressures reemerging, is there potentially a cycle where we can see higher inflation, makes it harder for things like the Federal Reserve to step in and potentially cut interest rates?
Well, certainly the president, again, is laser focused on growing the workforce. We're seeing unemployment hold steady. It's been holding steady for, really running between 4.0 and 4.2% over the last year. That's exciting for the American people. We are not seeing unemployment tick up. We're seeing hourly wage growth go up. That's, again, good for them. I'll be working with the president on this to make sure that we can continue to hold steady and grow this economy.
The president posted on social media that America is, quote, hot, and he said 6 months ago it was ice cold. But 6 months ago, I'm looking at the non-farm payroll numbers from 6 months ago, we were at 323,000 and an unemployment rate even lower than we are today of 4.1%. That is what arguably many people would call a hot labor market. What is the president talking about when he says we weren't hot?
Well, under the last administration, we saw, for instance, manufacturing jobs take a tank over the last 20 years. That is what the president is bringing back. Hardworking, blue-collar Americans, where he's bringing labor and business together to grow the economy for the everyday average American. That's where the change in the focus has been. And so the labor market is growing steady, and he's correct. It is hot, and it is better than what we had in the past administration, 100%.
But manufacturing payroll numbers dropped 8,000 for the month of May.
But compared to the Biden administration, they've grown. They have continued to hold steady. That is the difference when he stays laser focused on the American people and the American worker. I'm telling you, as I go around this country and I visit, the excitement in the labor force and in the participation rate, we're seeing that increase. Students, young people, they're excited to get back into the labor market. So it's going to take some time, but I can tell you, if we stay focused on the American people, I don't make a decision at the Department of Labor unless I know it's going to benefit the American worker first.
You mentioned federal workers and those employment numbers dropping off. When you think about DOGE working inside the labor force, has it changed given the fact that Elon Musk has now left the administration, and also given the fact that he's having this pretty massive breakup with the President of the United States on social media?
Well, the focus of DOGE was government efficiency. Again, that's what the president promised the American people, that he was going to save them their hard-earned tax dollars. Again, the focus is to make sure that we're being efficient with their tax dollars and still growing the economy. Listen, we can have distractions all day long. This jobs report of 139,000 new jobs, I think, is the primary focus today, because that is what matters to the everyday workers who get up every morning and understand that the president has their best interests at heart.
So even with Elon Musk not at the helm and also having this implosion with President Trump, do you still see DOGE working even inside the Labor Department?
Well, government efficiency, I think, is key. And I think for every secretary of every agency, we're going to continue to DOGE our own agencies. Because, again, for the American people, they want to understand that when we have their hard-earned tax dollars, that we're spending it wisely and we're saving them dollars where there's inefficiencies. And I'll continue to focus on DOGing my own agency to make sure that we're saving the American tax dollars.
Well, we look forward to hearing about those numbers, Secretary. Just finally, the president has taken to social media again this morning, and he's saying, too late, the Fed is a disaster. He's looking at what Jay Powell is doing, comparing it to Europe, which has already cut interest rates a number of times. And he says, despite them, though, our country is still doing great. Why would the Federal Reserve need to be cutting interest rates when you're telling us that this is a really fantastic and healthy labor market?
Well, that's the focus, right? And sometimes you gotta have the stool stand on several different legs. The president does a wonderful job at negotiations. The president will have a conversation with the Treasury Secretary, and he will determine when it's time to put the pressure on to lower those interest rates to make sure that we're still adding to the American economy and protecting the American worker.
Thanks so much for joining us, Labor Secretary Lori Chavez-DeRima. Really appreciate your time. Shonali and Matt, I'll send things back to you.
We thank you so much, Anne-Marie. What a terrific interview, of course. State of the labor market in flux. That was Bloomberg's Anne-Marie Horridren with the Labor Secretary. I want to bring back that quote from the president on Truth Social. Too late at the Fed is a disaster. Europe has had 10 rate cuts. We have had none. Despite him, our country is doing great. Go for a full point, he says. Rocket fuel. I want to pull up also what the market says, because that matters too. You have less than 2 rate cuts actually this year that already priced in. So nowhere near what the president is talking about. Of course, it's because we have still seen an economy that has been hotter than expected. We had also seen a little earlier the president say that the economy is indeed hot. Now people are going to be looking very closely at that inflation data next week. But in the meantime, we are looking at a market that is still ripping. Let's get a check on some of those movers too, because Tesla is helping out that easing of the spat between billionaire Elon Musk and President Trump is now sending Tesla shares about 5% higher, about 4.95%. But big tech also leading the way on a points basis. Nvidia at the top of the group, Apple, Amazon not far behind. On the downside, we do see Broadcom, Lululemon taking a hit, with Broadcom still down about 2.5%, and Lululemon an absolutely bruising nearly 19%, but still a broad-based rally here on our hands. Consumer discretionary leading the way. That jobs data certainly helps, Matt. We are seeing risk on heading into the weekend. That labor data this morning setting the market back on a tear.
Yeah, absolutely on fire today. Shonali, thanks very much for that. Coming up, earnings season finally winds down. Shonali will disagree with me, but earnings season is coming to an end. Shares are soaring today at Rent the Runway as the company's inventory bet pays off. You can see they're going the other way of Lululemon and then some. We speak to Jennifer Hyman, Rent the Runway's CEO, next. This is Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
the theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
And it's time now for our top calls. Some of the analysts' action in focus this morning. First up, we're looking at CrowdStrike being downgraded at Bernstein, saying that the stock is too expensive. The analyst says that investors have crowded into the cybersecurity sector as a whole, perceiving it as a relative safe haven. And next up, McDonald's getting cut at Loop Capital. The reason? Chicken strips. The relaunched menu item has gotten a lot of negative customer feedback. You know, some of us still just like those tendies, I suppose. Finally, Urban Outfitters is getting upgraded at Jefferies. The firm says its brands are still driving sales growth with healthy trajectories ahead, still facing a lot of softness since those earnings. But we're going to talk about a positive story now. Rent the Runway shares just soaring. Subscriber base is growing again. The fashion business is reworking its business model to improve the product offering and boost customer retention. Joining us now, Jennifer Hyman, the CEO of Rent the Runway. What a great morning at Rent the Runway today.
Hi, it is. You know, record loyalty. So loyalty is the highest it's been in 4 years. Record active sub count, record sequential growth in subscribers. We're feeling really, really great about the corporate transformation we put into place.
So something that's funny is Matt, I think, knows this habit of mine. I'm a stress shopper. Whenever I'm stressed out, I go shopping. But the problem is
lately...
She's
stressed a lot.
Yes, yeah, it's a big problem. But there's got to be a limit here. It is not a great moment for a consumer wallet. I'm wondering how Rent the Runway tends to behave in those kinds of environments. Do you find actually increased engagement because people shouldn't be buying as much as I've been buying the last 2 years?
I think the tailwinds for rental and resale are higher than they've ever been because our business is about financial value. The customer is getting thousands of dollars worth of clothing per month for a really low price. Our subscription price points start at sub $100. We have different kinds of programs for different kinds of customers. And I think that for the customer who's still going into work, she has to have variety in her wardrobe. She wants to look great. This is the best way to do it from a financial standpoint. So as tariffs might affect the industry, as people get more concerned with pricing, saving money via rental and resale, I think is going to boost the rental industry overall.
Is this, by the way, a recession play? I mean, is that what's happening here? Because I don't know much about the business of women's fashion, but I look at your stock over the last 5 years, it's been crushed. Over the last 3 months, it's doubled. So is that because everyone's saying, oh, we're going to go into a recession, I can't buy my, I don't know, Dior or, I don't know.
You're on the right.
YSL, right? And so I'm going to rent it instead.
I mean, I think that our business really proved out in 2024 that the unit economics make sense and this business works financially. We brought the business to nearly free cash flow break even. And then 2025 was really about proving to the world that we can grow. And how are we focused on growth? We've doubled our inventory this year, which has led to huge growth in loyalty. We have made huge improvements in product, which are improving the customer experience. And we've kind of driven the business back to a much more authentic way of communicating with our customers, which has driven up social engagement by 163%. So we're not investing more in marketing, but we've changed the way that we talk to our consumers, and that's having a positive effect.
You know what's so interesting to me? When you talk about typical retail companies, you're talking about the brick and mortar presence, you're talking about the same store sales. But when it comes to you, we talk a lot about you like a social media company. The idea here now that you have almost 150,000 active subscribers. What does that look like in 1 year, 2 years from now? Do you have a sense of how far that could go and what that consumer loyalty gets you?
Yeah, one of the most exciting things about the business is that for so many years, we were trying to convince the world, the market, that they should rent clothes. And now this is a mainstream behavior that women are considering for how they get dressed in their daily lives. And so the opportunity to have millions of subscribers in the future to Rent the Runway, I think, is really bright.
Yeah, I see. You gave me an idea to look it up on Instagram, right? You have over 500,000 followers there.
That's where I shop the most.
And probably on TikTok, and I don't know these channels, but can you turn those followers into subscribers relatively easily?
I think that the way to do that is actually via inventory. So we've moved to a place in the market where we're out of the early adopter phase. And now people are choosing where to rent based on the brands that we carry, based on the styles that we have. So really investing in kind of doubling our new inventory, adding 90 new brands this year, kind of more than doubling the inventory from our top 25 brands, and being a partner for our brands to help them acquire new customers. So brands are willing to work with us in this incredible way where 70% of our inventory is either via revenue share or via exclusive designs where we're not paying large amounts of capital up front. So we've really flipped the model of how a traditional retailer might work into one where we're revenue sharing with our partners on the performance of the inventory.
All right. I think it's really a really cool business, and I mean, you look amazing. So I kind of want to Rent the Runway, but you don't have suits, right?
We can up your tie collection.
Yes, you should do a Rent the Runway for ties.
Well, you know what? I want your wife as a customer. I want your friends as customers. Spread the word. I think that Rent the Runway has really grown based on organic adoption from the very beginning, word of mouth, and igniting the authenticity around the brand. The inventory helps do that because you look great, you get a compliment, you say, I rented the runway, and now you're going to be a customer.
All right, Jennifer, thanks so much for joining us. Jennifer Hyman there of Rent the Runway. Another truth dropping just now from Donald Trump, or during that interview that Anne-Marie did with Lori Chavez DeRemer. If too late at the Fed would cut, we would greatly reduce interest rates, long and short, on debt that is coming due. Biden went mostly short term. There is virtually no inflation anymore. But if it should come back, raise rate to counter. Very simple. He is costing our country a fortune.
I want to be very clear that the Treasury Secretary currently is also having to borrow at the short term.
Yes, I know.
Right, like, let's remember that.
Right. And also, if this economy is so hot, if we're running hot, do you want to cut rates? That's not really how it works.
Keeping them too high.
Coming up next, we'll talk to Diane Swank about this from KPMG. She shares her prediction for the U.S. economy. And then we'll talk whether this Tesla drop is an opportunity for Rivian with Charles Lemonides. This is Bloomberg.
have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A standoff between President Trump and the richest man in the world isn't over yet. Sparks flew yesterday when Elon Musk suggested Mr. Trump is in the Jeffrey Epstein files and ought to be impeached. Correspondent Nancy Cordes.
Trump is talking to reporters by phone this morning, telling them that Musk has a problem and that he has no plans to speak to Musk by phone anytime soon. And sources here at the White House tell us that the red Tesla that has been parked here on White House grounds for weeks, they say, well, now Trump is considering selling it.
The president has also threatened to end government contracts with Musk's business enterprises. CBS's Jolene Kent.
There's billions of dollars and services at stake here. Elon Musk's SpaceX has received tens of billions of dollars from the federal government over the last decade. We're talking about $3.8 billion just last year. Another Musk company that is, of course, very important is Tesla, America's largest electric vehicle maker. Tesla gets huge subsidies from the federal government.
Musk has since pulled back on a threat to decommission spacecraft that NASA is counting on for upcoming trips. The Dow is rallying after a stronger than expected monthly jobs report amid fears tied to Trump tariffs. Economist Stephen Juneau.
Job growth is slowing a little bit. Over the last 3 months, we've added just an average of 135,000, but that's really not all that bad considering things. So we're not seeing a sharp slowdown.
Dow right now up 529 points. In Kyiv, they're cleaning up after one of Russia's largest aerial attacks of the 3-year war. Ukrainian officials say at least 3 emergency responders were killed. The BBC's Paul Adams from Kyiv.
In the capital, residents took shelter as air defenses tackled waves of drones and missiles. Over the course of several hours, we heard large explosions and the regular rattle of machine gun fire as the city's air defenses worked frenetically.
Russia says it was responding to Ukraine's drone attacks on its air bases Sunday. Normandy, France now. They're marking the day 81 years ago. U.S. and Allied soldiers landed on the beach for the final chapter of World War II. Defense Secretary Pete Hegseth delivered remarks at the cemetery where thousands are buried.
As I stare at that flag, we are forever grateful to the French government for dedicating this land as a resting place for our men.
The S&P is ahead 66, NASDAQ up 230. This is CBS News. Forty-one-year-old quarterback Aaron Rodgers isn't done yet. He's signed with Pittsburgh.
The Steelers say Rodgers' one-year contract is pending a physical. The New York Jets released Rodgers in March after a 5-12 season. A lot of Steelers fans don't think Rodgers is the answer at QB.
Oh, no. I just can't believe they put money into that guy.
He's kind of old. Like, we know that we're in a rebuilding phase. We should be getting someone that is able, younger, that we can work with.
Other fans approve.
It's about time. It's about time.
As fate would have it, the Steelers open their season against the Jets September 7th. Michael Wallace, CBS News.
Japan's latest attempt to conquer the commercial rush to the moon was a bust. Tokyo's iSpace says its lunar landing crashed after flight controllers say they lost communication. It happened less than 2 minutes before it was supposed to touch down. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube as well. Alex Steele and Paul Sweeney with you. Coming up here today, a lot moving. The markets are moving higher. Lots of economic data to get through. Steve Blitz, Chief U.S. Economist at T.S. Lombard. He's going to check in with us today and give us his thoughts on a job report that came in better than expected. Chuck Lieberman, co-founder and Chief Investment Officer at Advisors Capital, to get his thoughts for these markets. Lululemon falls with a growth plan threatened by Trump tariffs. We'll check in with Poonam Goyal. She covers all the retailers for Bloomberg Intelligence. And then Max Chafkin, Bloomberg Businessweek senior reporter and co-host of the Elon Inc. podcast. I bet she's got a thing or two to add about Mr. Musk and President Trump. So we got a lot coming up in the next couple hours. We're going to kick it off with John Tucker and a Bloomberg Business Flash. John.
And this Bloomberg Business Flash, Paul, being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more at your timetable. Learn more at ibkr.com/around the clock. Risk on rally. S&P 500, 70 points higher. That's up 1.2%. We're at 6,009. And if you're keeping score at home, the S&P 500, 2% below its record close. Dow up 546 points. That's a rise of 1.3%. The NASDAQ 100, 254 points higher. That is up 1.2% right now. Best performing stock in the S&P 500, Airbnb. Those shares are up 4.3% right now. And you mentioned it, Lululemon Athletica, that is down. Hold on to your pants, 18% lower. Wow. Your, what do they call them? The yoga
I see
pants.
what you did there.
Yoga.
That's funny.
Pants.
Yeah, yoga.
Pants.
They are called yoga pants.
Okay.
That is true. Good job.
Just checking. President Trump weighing in on monetary policy after the jobs report. The headline crossing Trump urging Powell to go for a full point cut. The money market's actually trim bets. The Fed's going to cut interest rates twice this year. The job growth moderating in May. The prior months revised lower. The jobs report, of course, narrowly exceeded economists' forecasts. And most active Tesla shares higher after yesterday's plunge. Elon Musk did suggest he's open to making amends with President Donald Trump. That soap opera continues. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Good morning.
Good morning, guys. Happy Friday.
Happy Friday.
We made it, sort of, to the end of the week. John Tucker.
It ain't over yet.
It ain't over yet. Well, Market Drivers is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. I'm Alex Steele alongside Paul Sweeney. Want to get some look at some of the stocks in the move today. Want to get right to Bloomberg's Nora Melinda. Let's kick it off. What are we kicking it off with, actually?
Lululemon.
Okay,
I mean, that's what we're all
it.
talking about today. Of course, this is the worst performing stock by a percentage basis in the S&P 500 this Friday. And this is after the company posted a second quarter of disappointing results. And of course, this has really been fueled by tariff concerns as people are really trying to see how that will affect retailers. But Lululemon has been struggling with this in particular. Their guidance currently assumes 30% tariffs on China and 10% tariffs on other countries. But it really is their shift away from yoga pants that has really been derailing a lot of their plans and how people are really perceiving the company right now. I was looking at a Jefferies note that said Lulu's worsening guidance feels like death by 1,000 cuts. I found that to be quite intense there, but of course shares are falling for their worst day since the pandemic 2020.
Is this a pandemic's like a? Did people stock up on their Lululemons because they were working out from
right?
home
Maybe that's what happened.
But it's kind of it's a little threefold. I mean, there's a lot of competition now, like with Alo Yoga, in a way that wasn't there before.
Right.
Then you have supply chain issues, and then you have overall consumer issues. So it's sort of like a trifecta for Lulu.
Yoga pants are out of favor?
No. There's more competition.
More competition. People are looking to other places, really tightening their wallets. And of course, Lululemon, that's ticker LULU. I'm also keeping eyes on Broadcom. So that's ticker AVGO. We're seeing shares that are down as much as about 4.5% today. Now, the company gave a lackluster revenue forecast for this current quarter, and they're essentially making people nervous that AI spending frenzy isn't as strong as Wall Street actually did anticipate. And of course, we know that people have really been looking at AI spend. And of course, Broadcom did miss some of the loftiest of expectations here. And this is the company that, of course, supplies chips to firms like Alphabet, Apple. So this is something that's really in focus here today as people are really just kind of parsing what's going on in the AI space right now.
To that point, though, you can make an argument that Broadcom was very well owned going into this. So how much of it was real disappointment versus just expectations so high? You were just so owned. You got to diversify. That's really question mark too. All right, let's wrap it up with Circle Internet Group.
Yeah, so of course this is an IPO that happened yesterday, and we're seeing shares that are up as much as 25% today. They're climbing for double digits, but this is after yesterday on the opening day we saw shares that surged 168%. So we're seeing this stock that's really on a tear right now, and we're seeing that the issuer more than tripled from its IPO price here, and this is one of the largest first day pops that we've seen for any U.S. IPO that's raised more than $100 million since Sono Group actually came out in 2021, and that was actually a solar tech company that focuses on commercial vehicles. So really interesting results here.
Yeah, this is a real company, real revenue, real EBITDA, real free cash flow, real earnings. So the market, hopefully this will open the gates a little bit on the IPO market. Nora Melinda, thank you so much for joining us. Equities reporter for Bloomberg News, Nora Melinda. Let's get to this jobs number. I mean, better than expected, as John pointed out. Again, weaker from last period. Let's see what the world of the economists are thinking about this stuff. Steve Blitz, chief U.S. economist at T.S. Lombard. Hey, Steve, what was your takeaway from kind of the various parts of this jobs report today?
Yeah, I actually find the market reaction a bit perplexing because when you look at a lot of the pieces inside of it, it really shows a weakening job market, strengthening one, right? All the job gains really were in restaurants and healthcare services. The rest of it was, added up to pretty much of a flat number. A good part of the decline was in employment. Look at the household survey, was in the 16 to 24-year-olds. So people who are parents who are fretting about their children not being able to find jobs, they're right. It is a bad market for them. But when I look at a lot of the different things, the diffusion index and stuff like that, I see a number that reflects a lot of what ADP was saying, even though obviously ADP is typical of the number. It's very off from the actual number. But it's a weakening trend, especially against the backdrop of the Beige report.
Right. Then you have President Trump saying basically to Fed Chair Jay Powell on social media saying the Fed's got to go for a full percentage point rocket fuel. Is this an economy that needs 100 basis point worth of cuts and rocket fuel?
Well, first of all, you know, a real estate guy wanting lower interest rates is neither news nor novel, right? So, but I think there, you know, the Fed's betwixt and between a tough spot here, right? Because inflation is higher, is running, if you look at it from on a rolling 3-month basis, we're still stuck in this 2.5–3% range on core PCE inflation, where it was under 2%, you know, pre-COVID. So we're still higher, yet we're seeing lower hiring rates and things like that. And the Fed's leaning on the inflation side. Everything the president is doing, all of his policies are inflationary, not deflationary. And, you know, Powell, in effect, has a hall pass here, right? So I think that, you know, he knows he's out of a job in May. We're into legacy building on his part. And Trump said a few months ago, though, you know, it changes every day with him, but he said no pain, no gain on the tariff side. So it's a tough spot for them. I think, though, we're going to get a dovish sentiment coming out of the June meeting. And I think chances of a July hike, well, I certainly don't think they're going to, cut, not hike. I don't think they're going to cut in July, but I think the odds are closer to 50-50 than what the market is priced in.
Steve, is this economy, I mean, how do you think this economy is going to perform in the back half of this year here? Is it a time when maybe some of these tariffs are going to catch up and we will see a market slowdown?
Yeah, because there's a couple of things here that, you know, we're in a bit of a sweet spot. And I look to the third quarter, one, firms are just beginning to find out how much of these tariffs they can pass through to the final price, right? I mean, we saw this surge of buying, so they've got a lot of stuff in inventory pre-tariff. They're going to sell it tariff plus their markup. What can they get through? How much can they get out? And then once they know that, then there's going to be a payroll question. Do we now have too many people? Do I have to shrink my firm? Whatever. We're going to find that out in the next few months. At the same time, you're getting the debt ceiling is going to get lifted in July, either as part of the budget or as a one-off, and then it'll be part of the budget later, a few months later. And that means that we've got to return to Treasury borrowing and Treasury borrowing plus, because they're going to borrow for the deficit in Q3, and then they're going to also have to borrow to put money back in the savings account, and that's going to put upward pressure on yields at a time when you don't really have a lot of sponsorship for the 10-year. So really yields are going to get pushed up. And also what I found is that there's a tailwind to the economy when you have a debt ceiling in place, because Treasury's spending money they're not raising. And you get the reverse of that in the third quarter. So there's a lot of things coming in Q3 that are more likely to slow growth than speed it up. And, you know, so what the Fed does in reaction to that, we'll have to see.
All right, Chuck. Sorry, not Chuck. We're going to speak to Chuck. Just kidding. Thanks a lot. We really appreciate it, Steve. Steve Blitz joining us from TS Lombard. Thank you for breaking down that jobs number for us. The markets, though, obviously looking at this in a very positive way, with the NASDAQ up 1.3% and the S&P up 1.1%. And I just did a deep tease Chuck Lieberman now will be joining us, co-founder and chief investment officer at Advisors Capital. He will break down what to do with this market. I mean, if we close at these levels, we are now in quote unquote a bull market. Bull bear, like, does that mean anything for us? I don't know, but that's going to be a headline. Also, Poonam Goyal, a senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. She's going to talk to John Tucker about what it means about Lululemon yoga pants.
Yes, okay, that should be in the
where his discount should be and like where you can get the best product
I have a
here.
pair. Not Lululemon, but like
that's
can you picture that?
I don't know what to say.
Silence.
We just gave you dead air for that, so you're welcome. Happy Friday. This is Bloomberg Intelligence.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Stocks rallying. Bond prices are lower with the more policy-reactive two-year yield pushing above 4%. The S&P 500 up 68 points. That's a rise of 1.1%. 6,008. on the index. The Dow Jones Industrial Average of 547 points. That's a rise of 1.3%. NASDAQ 100, 250 points higher. That is up just about 1.2%. You have 10 of the 11 major industry groups in the S&P 500 are up right now. Communication services, that's the group that's in the lead. And the individual names that are leading the index higher, Palantir, Tesla, and Micron Technologies. We did get the all-important jobs report this Friday. Non-farm payrolls expanded by 139,000 jobs in May. But you also had the downward revisions from the previous months. That resulted in net job gains of just 44,000. So the details show an ongoing softening of the labor market. The unemployment rate, that held steady, but that was driven by sharp declines in the labor force. Worst performing stock in the S&P 500. Again, Lululemon Athletica posting a second straight disappointing quarter. Those shares down over 20%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Alex and Paul.
All right, thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through a lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. So as John Tucker was just reporting, if we close at this level, we are now back in a bull market. That was a whippy 6 months of the year. Chuck Lieberman, co-founder and chief investment officer at Advisors Capital, joins us right now. Are we in a place where we can just start talking about record highs again? Is that the right thing to be talking about right now?
Thanks, Alex. Well, the economy continues to grow. The pace of growth is a bit slower, but that was to be expected. And profits are rising. So sure, why should stocks not continue to move up?
Chuck, it feels like we still have some tariff. I don't know, the tariff, actually the prices and the tariffs themselves to find their way into this economy, which could, I don't know, put pressure on growth, put pressure on inflation. It seems like the market's not too concerned about that at this time. Are we getting a little ahead of ourselves?
Well, there's no doubt that inflation pressures are going to rise because of tariffs. So that's still ahead. But if consumers adapt to it, as they typically do, they might buy more, for example, American cars instead of imports. That will provide a boost to the economy, not a drag. There are lots of ebbs and flows. So you really have to look at the underlying trends, which I think are still very, very good. Job growth is solid. They did revise down the prior months. But if you look at the underlying trend, it's still solid. It's still well above the growth rate of the native-born supply of labor. So you have to distinguish between immigrants and labor that comes from the U.S. Growth in population. And that growth rate is low. And so we relied on immigrants, legal and illegal, especially illegal, to boost labor, boost the supply of labor, and firms went out and hired like crazy. So that enabled the economy to grow quickly over the last few years. That, of course, has slowed down. So now we're relying only on domestic labor sources, and that is more moderate, but we continue to hire.
That's good context, Chuck. So based on that, if we were looking at a portfolio allocation, whether just in equities or if you want to wrap in, say, what a bond and alternative assets would look like, what's the best one right now?
Well, I still lean towards the stock market. I think you have to look beneath the surface there because of the Mag 7 and the top 10 PE multiple stocks. When you do that, the rest of the market is pretty cheap. And I think that's why there's this underlying bubbling up of demand for stocks. You can find a lot of companies, whole industries, that trade at PE multiples of under 12 or in some cases even under 10. So that's a real tailwind for stocks. The bond market is a tougher call because inflation is probably not going to moderate. In fact, may lift a bit in the coming months. Average hourly earnings were up 0.4%, 3.9 year over year. That's solid. And that's got to be a concern for the Fed. So the views that it expressed in its last minutes about inflation on the one hand and growth on the other, those are concerns. And for that reason, I expect them to sit around and wait for more information.
Chuck, are there any sectors that screen well for you and your team these days?
Well, I'm a guy who likes to buy cheap stocks. So I like the banking sector. I think they're still very cheap. I love the money centers. I think they offer great potential as well as great value. They took them out and shot them back in 2008. And then they did it again after Silicon Valley in 23. So they're out of favor, and I love out of favor sectors. So I like the money center banks, everything from Bank of America to Citi, which is my favorite, to Wells Fargo, which just got taken out of the Fed's doghouse. I think there's great value there. Another area that I like is insurance. I own Lincoln Financial, a life insurance company. They own a lot of bonds, and they got hit, but they're cheap. And there are a lot of other parts of the economy. Real estate is another area that I think is attractive, especially nursing homes, because of what happened during the pandemic. They're all recovering. The people are getting older every day, unfortunately, including me. So there's still more demand for nursing homes. They're seeing increased occupancy, increased profits, raising dividends. There are lots of attractive areas to invest in if you look.
If rates, though, are structurally higher, particularly on the longer end because of fiscal budget deficits, does that crimp some of the areas that you just spoke of?
That's a great question, Alex. And yes, you're right. But higher interest rates are a problem for the entire market. And theoretically, they're more of a problem for growth stocks than they are for value stocks. Growth stocks, by definition, have a lot of their value in future years. And if those future years get discounted at higher rates, then they're worth less. So growth stocks are more vulnerable to rising rates. But the whole market is. If interest rates were to go up, the whole market would weaken.
Chuck, thank you so much for joining us. Always appreciate getting a few minutes of your time. Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management in lovely Ridgewood, New Jersey. I love that golf club over there. Let's talk to Lululemon Athletica. LU is the ticker. It's off 20% here today. It's off 31% year to date. Tough quarter. Tariffs are taking effect. The consumer, all that kind of stuff. It is a challenge for a lot of these consumer companies. So we talked to Poonam Goyal. She covers all the retailers for Bloomberg Intelligence. Poonam, what's the Lululemon story that we heard this quarter?
Yeah, it's the guidance. They slashed guidance and they're expecting margins to fall, all largely due to tariffs. The hardest hit quarter will be 2Q because they're unable to mitigate a lot of the tariff headwinds until 2H. And along with that, they're going to have more promotions. They did say that traffic was lighter in stores. That's not something new. We've heard this story for quite a few quarters now. And it just means that they really need to step up their game to get traffic back to stores, be the Lululemon that we knew where, the stores would be crowded irrespective of what was going on inside the malls.
What does this do for the supply chain? So that's the consumer part. In terms of their supply part, what are they dealing with?
Sure. So when you think of Lululemon, the one thing that I think we should note is they don't make product in China. So they do not have product exposure to China. They do source raw material from China, for which there will be some exposure. But the largest hit that they're going to face is from the other countries in Asia, where the tariff is at 10% right now until early July. So they have that 10% headwind, and we do think that they'll be able to mitigate that in 2H. And they said they would too, largely through a combination of supplier negotiations, some select price increases, and then internal efficiencies.
The ability to pass along cost increases, it sounds like Lululemon does not maybe have the pricing power that maybe some of the other retailers you follow have. Talk to us about Lululemon and that side.
Sure. So one thing is that Lululemon does have the more affluent customer. So they can, sell things at relatively higher prices than other retailers that sell athleisure. That said, if you're used to paying $120 for a pair of yoga pants, and you see the price go up to $130, you may start to wonder. The way to take up prices here for retailers like Lululemon is on new product because you don't have a price set in mind for what that product should be. So if they introduce a new legging, if they introduce a new silhouette, and they price that a little higher, the customer may not even notice. So I think that would be the smarter way to do it.
Oh, I see what you're saying. And I'm 100% not paying $103 for a pair of pants I'm going to sweat in. That just can't.
They look good, though.
Never. No. I mean, I literally just work out in my bedroom. Anyway, moving on. Not about me. What about the competition? We were talking earlier about that, and I was saying, well, now you have Alo Yoga, you have a lot of other competitors in a way that we didn't have about 10 years ago or so. So how is that affecting Lulu?
Yeah, competition is definitely getting tougher, not just from the likes of Alo, but also from the traditional legacy athleisure players like Nike, Adidas. You know, they're all making a big push, especially into women's, and focusing on the same segment that Lululemon sort of made its money on.
So, Poonam, sense of timing for tariffs here. What are your companies telling you about when they think they will really start to see their costs increase, and then they're going to have to make a decision? I mean, is that happening now? Is that something that'll happen in the fall?
It's happening. It started to happen. Costs are going up, and they can only mitigate so much. If you have a 10% headwind and you have low to no exposure to China, I could see you mitigating most of that for some of our companies. But as soon as you add China to the mix, where you need China to get product to the U.S., it's much, much harder, and the margins will be pressured. You know, these retailers, Paul, they have margins that are in the single digits. So even a 10% increase in cost is a big increase. We're all thinking 10% is okay. You know, it's not that bad when we heard the 135% with China, but it's still a big deal. It's a large increase for them to have to absorb or deal with.
Poonam, 30 seconds. Top retailer right now.
Amazon. You know, we like Amazon as a long-term play. We think their cloud business, their advertising business, they have a lot of runway, even on the retail side, to really grow. And in this environment, scale matters. Scale is where you get pricing power, and we think Amazon, out of all the retailers that we cover, have the largest scale.
Yeah, absolutely. Good stuff. Poonam Goyal, thank you so much. We appreciate that. Poonam Goyal, senior retail analyst, covering all the retailers for Bloomberg Intelligence down there in Princeton, New Jersey. Again, Lululemon, disappointing quarter, and as Poonam was mentioning, more importantly, perhaps disappointing guidance. They've got some pressures there, and the stock market's telling you that right now. The stock's down 20% today. This company's got a $31 billion market cap, so some big money being lost there. S&P 500 up 61 points. This is Bloomberg Good Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Risk on rally in the markets today. The S&P 500, 65 points higher. That's up 1.1%, 6,004. So that would place it about 2% below its all-time high. The Dow Jones Industrial Average, 492 points higher. That's up 1.1%. The Nasdaq 100 up 245 points. That is a rise of 1.1%. The two-year yield, 8 basis points higher, just above 4%. Now, Tesla, the leader in the S&P 500 in terms of index points, those shares also among the most actively traded, 5% higher right now after yesterday's plunge. And we're still trying to ascertain if the Musk-Trump feud has cooled or not. Circle Internet, the ticker symbol there, CRCL, they debuted yesterday. The company raising $1.1 billion in what we call an upsized IPO, a signal that the stablecoin issues are becoming a little more widely accepted. It's up another 18%. Yesterday, we had a 168% pop for this stock. Job growth moderating in the month of May, and the prior months were revised lower. Well, the unemployment rate was unchanged, indicating employers are cautious about job growth prospects as they weigh the Trump administration's economic policy. The non-farm payrolls increasing 139,000 last month after a combined 95,000 downward revision to the prior 2 months. Oh, by the way, McDonald's says the new Hershey's S'mores McFlurry scheduled to hit menus starting June 10th. Only 460 calories.
What's in it again?
S'mores. So it's Hershey's milk chocolate, graham crackers, marshmallows, a chili version of the campfire cooked snack.
Oh, love that for me. Love that for me.
We check the markets for you and other stuff right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Alex and Paul.
All right, thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. I feel like yesterday will go down in the analogs of history as where were you when, ... The tweet fight between President Trump and Elon Musk, arguably two of the most important people in the entire world, started on social media and then erupted overnight into full public display. Elon Musk, Donald Trump's alliance just ended with that public spat. Now, the latest read is that Musk has backed down after Tesla's stock price just tanked. His net worth crumbled $34 billion. Max Chafkin is Bloomberg Business Week senior reporter and the co-host of the Elon Inc. Podcast. He joins us now. Who has the upper hand here? Quote unquote, who won?
Donald Trump has the upper hand here. He's the president of the United States. He controls a lot of aspects of Elon Musk's businesses. He also is the more important cultural figure. The fandom around Donald Trump, as popular as Elon Musk is, the fandom around Donald Trump is much more intense, and he's much more influential. That said, nobody's won yet. I mean, this has been just disastrous for Elon Musk, especially not ideal for Donald Trump. I think he'd prefer to just have the big, beautiful bill, his tax bill, the extension of the tax cuts with a bunch of other stuff swirled in, just sail through the Senate rather than have this very influential, very loud, rich guy, banging on Twitter, suggesting he should be impeached and so on. So I'm not sure there are any winners. I will say I was shocked by this because, and I wrote a piece a week ago basically saying, for all the talk of a breakup, you shouldn't bet on it because there are so many reasons why these two guys need each other. And of course, that's looking like not the right take on this. And it just seems like Elon Musk at his most erratic, most self-destructive, taking the opportunity, he had the chance to exit the White House, gracefully, maintain his contact, his influence with Trump, while also keeping investors happy by spending more time with his companies. And that all feels like it's out the window. He's not spending time with his companies. He's spending time on Twitter. Obviously, investors are not going to be thrilled with the stock price. I think they're hoping against hope that he somehow backs down and they're able to resolve this.
Personally, I saw this day coming the first day they got together, said this is exactly how it's going to end. This is how it always ends when someone gets close to President Trump, either in his political life or in his personal life. That's been well documented. Didn't Elon, what was Elon thinking? Didn't Elon know it had to end this way?
Elon Musk is not a man renowned for humility, right? This is a guy whose whole thing is doing more than anyone can do. I think the big surprise here for Elon Musk was that he wasn't able to control Donald Trump in the way that I think he imagined. And you see that come out in that very surreal Oval Office meeting with Friedrich Merz yesterday, where Trump is talking about EV tax credits. He's talking about the ways in which he wasn't delivering for Elon Musk. And I think ultimately that is a big part of this. Of course, there's also ego, that there is like kind of what you're alluding to here, Paul, the two alpha guys who can't handle, playing second fiddle. And I think that's another factor.
What on the flip side, though, one can make the argument that the U.S. government really does need Elon Musk when it comes to SpaceX.
Absolutely.
Without that, I mean, I realize that Musk has backed down on his threats to pull SpaceX in the government, but how important is that to our government? What does it mean if Musk did pull out? What would that look like?
I mean, it was that honestly, it was probably the most shocking thing that happened yesterday. It was Elon Musk threatening to cancel its Dragon spacecraft. That is the vessel that is used to bring cargo and astronauts to the International Space Program. He's effectively saying, I am going to end the U.S. support for the ISS, which, obviously the ISS is not like a military program, but that's the kind of thing that I think the Pentagon probably would react very negatively to. And you're right, there aren't really any other aerospace companies that can do what Elon Musk can do. But you immediately saw people in MAGA world talking about nationalizing SpaceX. And honestly, I don't think that is the craziest. Like, I think you would have seen that start to bubble up if Elon Musk tried to make good on this threat, because the Pentagon has put itself in a position where it really is dependent on SpaceX. Long run, the U.S. government has a lot of money, and there are other big defense contractors, and they also have launch vehicles. So I think it's not like Elon can just dictate policy to Donald Trump because of his position in the aerospace market, in the launch market, but his position is stronger because of that.
Hey, from the peanut gallery, a question. Can these companies survive and thrive someday without Elon?
I've been talking to Tesla investors, and one of the interesting things you hear before this happened, there were people saying, hey, Tesla will be better off without Elon Musk. But it was really a kind of a rump coalition, right? It's basically the people who are really upset by his behavior, who see him walking away from EVs, and the sort of like robo-taxi, Elon Musk as a visionary. Those folks really saw Elon as being 100% linked with the success of Tesla. Like, there would be no way for Tesla to succeed without him. I'm starting to hear little murmurs of, hey, actually, our robo-taxis are pretty good. We wouldn't necessarily need Elon Musk. I think if Elon Musk were ousted from the company tomorrow or today, the stock would instantly plummet because the shareholder base is very much behind him. That said, if enough things like this happens, crazy things can happen. And this is an important company. This is a company with, a huge amount of market cap. There's a lot of money on the line. And anytime when there's a lot of money on the line, opinions can change very quickly.
All right, Max, thanks so much. Appreciate it. Max Chapkin, Bloomberg Business Week senior reporter and co-host of the Elon Inc. podcast. If anybody knows what's going on inside the head of Elon Musk in this building, it would be Max Chapkin.